Hi, and welcome to OPMT 1110, Introduction to Business Math. Today we're going to start at the very beginning. What is the point of business? The point of business is profit. Of course, there's other reasons to be in business, lots of other reasons, but in the context of a business math class, this is what we care about. Mathematically, profit is defined as sales minus costs. Sometimes instead of sales, we say revenue, and instead of costs, we say expenses. In the context of this class, those are going to be interchangeable terms, revenue and sales. We also sometimes talk about this as money in, money out. And that's going to come up a lot throughout this course. What do we know about profit? When profit is a positive number, that means bigger than zero. That is a good thing. On the other hand, when profit is less than zero, that's a negative number. I'm going to write that that is less than. That is going to be bad. Finally, when profit is exactly zero, that is what we're going to call the break-even point, and we'll get back to that in a couple of weeks. But the word for a profit of exactly zero when sales equals cost is break-even. To understand the different types of expenses and the different types of profits, we're going to go over an example. Example number 1. To run a lemonade stand, Charlie and Sam spent $20 in building a booth and $100 on lemons and sugar. They brought in $300 in sales. Find their cost, net profit, and gross profit. Here, we have two types of costs. We've got fixed cost. This is also called operating expenses. And some books call this OP for operating, or FC for fixed costs. We also have variable costs. And those are also called costs of goods sold. Sometimes COGS and sometimes VC for variable costs. In this case, we have both types of expenses. Our operating expenses here are the $20 on the booth. We spend that once, no matter how much lemonade we make. So that's a one-time expense. That's what makes it an operating expense, as opposed to our lemons and sugar, which is $100. So every time we make a batch of that much lemonade, we're going to have to spend an equal amount of money on lemon and sugars. So what's our total costs? $120 or 100 plus 20. That is our two types of expenses. So now what we can do is look at what we call an income statement. We write down our sales, then we subtract the cost of goods sold, and at the end, what we get is called a gross profit. So in this case, we have $300 in sales minus $100 which gives us a gross profit of $200. That's the gross profit, and it is sales minus cost of goods sold. Now we're going to subtract those operating costs. So we spent $20 on that booth, and at the end, what we're going to get is $180, and that is our net profit. Net profit is going to be all of our sales minus all of our expenses. $180 is how much money we end up with in this. This, I'm going to scan this up, is the bottom line. Net profit. So in the end, we have $180 in profit. Let's sum up just the different equations that we went over. We've got sales is money in is revenue. We have costs. That's money out is expenses. We have profit. That is sales minus cost. We have net profit. Sorry, we have two types of costs. We have cost of goods sold. And we have operating costs, OP, or fixed cost, and that is the cost of things that we are spending one time. Finally, we've got gross profit is going to be sales minus cost of goods sold. And then we have net profit, which is going to be gross profit minus operating expenses. Hi, now we're going to talk about ratios, fractions, and percent. Proportions and percent. Let's write that all down. These are different ways of looking at the same problem. A fraction is given as an amount over a base. Mathematically, you might have heard this as the numerator over the denominator. It's a hard word to spell. A over C. I'm going to give the example of 3 over 25. That's a fraction. A ratio, in a ratio, we're going to express that in two parts, 3 to 22, or A to B. This is a way of comparing the two parts. I've broken my fraction that has 25 pieces into two bits, 3 and 22. When I add those together, I get 25. So a ratio is a way of breaking our fraction up. Let's look at the same thing in decimal. In decimal, 3 over 25 is equal to 0.12. That's the same as 12%. Which means we have many ways of saying the same thing. 3/25, 3 to 22, 0.12, 12%. Those are all the same, but we use them in different ways. Often, the one we like best is percent. We use percent a lot in business because it's easy to understand. 12% just makes a lot of sense. However, ratios do come in handy when we have lots of things to compare. So I might say A to B to C equals 1 to 3 to 2. That means I've broken my whole into 6 parts. 1, 2, 3, 4, 5, 6. I am going to color one of them, A. I'm going to color 3 of them, B. And I'm going to color make this green. The rest of it, C. 2 parts are C. 1 part is A. 3 parts are B. Question 2. Detailed information about the Minute Maid Lemonade Company is supplied below. They have sales of $20 million. Cost of goods sold, that's things like lemons and sugar and cans, are $12 million, giving them a gross profit of 20 minus 12 equals $8 million. Their operating expenses, that's things like salaries and factory costs, are $5 million, leaving them with a net profit of $3 million. This is an income statement, and this is how we often write our expenses. Sales minus cost of good is gross profit, minus operating expenses equals net profit. The net profit is the bottom line. What we're going to do is create a common size income statement. That means that each line is as a percent of sales. So we take each line and we divide it by sales. So our sales line is going to be $20 million. I'm going to write million. That's okay because I can cancel it out. 20 million over 20 million equals 100%. So I write 100%. Our sales line is always 100%. Next, we do our cost of goods sold, and that's going to be $12 million divided by $20 million. Cancel out those millions, and we end up with 60%. We have 2 choices for the gross profit. We can observe that gross profit is 100 minus 60 equals 40%. But we can also observe that $8 million divided by $20 million equals 40%. So either way works. Next, we're going to do our operating expenses. Operating expenses is $5 million divided by $20 million is 25%. Subtract again, and we end up with 15%. The important things are these 2 numbers. Gross profit divided by sales is called something special. It is the percent gross margin. That's going to be the gross profit divided by sales. The one at the bottom here, this is called the percent net margin. and that's going to be the net profit divided by sales. Sometimes we call this PGM, and sometimes we call this PNM. And these are both examples of profit margins. Important thing, when you hear margin, we always divide by the sales. Question 3. Finally, we're going to use the concept of percent net margin or profit margin to be able to compare our two lemonade stands. So let's remember back to the last video when we had Sam and Charlie. Sam and Charlie had sales of $300 and they had a net profit of $180. That gives them a percent net margin of, I'm going to write the formula again, net profit divided by sales is 180 divided by 300. This gives us 60%. Minute Maid has a PNM, as we already calculated before, of 15%. So we've got 15% and we've got 60%. Which one is better? I'm going to go with Sam and Charlie. So Sam and Charlie have a much smaller business, but they have higher profit margins because they're keeping more of their money. For every dollar in sales, Sam and Charlie keep 60 cents. For every dollar in sales, Minute Maid keeps only 15 cents. They keep less of their money. 85 cents goes to expenses. Now, which one is the better business? That's harder to compare. Sam and Charlie, with their small stand, probably can't compete with Minute Maid on an international basis, but just based on margins, they're keeping more of their money. Hi, now we're going to do a more complicated example. Sarah likes to keep the investments in her RRSP, that's a registered retirement savings program, in a ratio of 1 to 3 to 2 in cash, bonds, and stocks. Last year, she invested $12,000 in total. How did she invest her initial $12,000? First, this is a ratio problem. We have cash, let's switch colors, to bonds, to stocks is equal to the ratio of 1 to 3 to 2. That means that our total is $12,000, which is going to be in how many parts? It's going to be 6 parts, 1 plus 3 plus 2. We add those together to get the total number of parts. So each part is going to be $2,000 because $2,000 times 6 equals $12,000. So we start with $12,000. I'm going to do our initial percentage as a fraction instead of as a percent. Cash is going to be 1 over 6. Bonds are going to be 3 over 6. And stocks are going to be 2 over 6. When we add those up together, they add up to 6 over 6, or 100%. I've already said that one part is $2,000, so I'm going to fill that in here. 3 parts then is going to be 3 times $2,000, which is $6,000. And finally, 2 parts is going to be 2 times $2,000 is $4,000. When I add those up together and try them, they do add up to $12,000. Over the year, her cash investments rose by 3%, her bonds by 8%, and her stocks lowered by 2%. That means she lost money. What was her profit or loss over the year? For part B, we're going to look at percent change. So start with 3%. So percent change is always done by the old value times 1 plus the change, I'm going to call that R, equals the new value. So for cash, we end up with $2,000. 1 plus 0.03 equals 2,000 times 1.03, which is $2,060. That's today's value. Another way to do that would be to find the interest. That would just be that $2,000 times 0.03, which is $60. So we would put $60 in here. For bonds, let's do the interest instead of the total. We'll end up with $6,000 times 0.08, that's 8%, and that gives us $480. So I put that in there, which means that I have a total of $6,480. Finally, stocks is a loss. That's okay. We can just still multiply $4,000 times negative 0.02, which gives us a negative number. That negative number is 80. So she lost $80. To show how the stocks would look like when we do the total, or the new value, we would say $4,000 times 1 minus 0.02, which is going to be $3,920, or $4,000 minus $80, giving us a total of $460 worth of interest. 60 plus 480 minus 80, giving us now a total of $12,460, or $12,000 plus 460. Now we get to part C, the final and more difficult part. The problem with this is that now we have more money, but her money is no longer evenly balanced. Because Sarah lost money in stocks, she doesn't have a ratio of 1:3:2 anymore. When she invests her $25.40, she's going to add that to the $12,460 she already has, giving her a total of $15,000. So her new total is $15,000. That's how much money she has in total, with last year's $12,460 plus her this year's $2,540. So what we're going to do now is do the same thing we did before and break that into parts. So this is 6 parts is 15,000. That means that 1 part is going to be equal to $2,500. And I'm going to do that math. So 1 part over 6 parts is equal to something over $15,000. When we cross multiply, we get X equals $15,000 divided by 6. And then when we get that, it is $2,500. That means that Sarah wants to have $2,500 in cash, meaning she needs to invest an additional $440, which is $2,500 minus 2060. She's going to invest an extra $440 in cash. For bonds, we have three parts, is going to be 2,500 times 3. Or if you prefer this, it's going to be $15,000 times that ratio of 3/6. It doesn't matter which way we do it, we still get $7,500. And stocks, we're going to take that 2,500 times 2 and end up with $5,000. We check. When we add those together, 2,500 plus 7,500 plus 5,000, it actually does equal $15,000. Let's finish our differences. Subtraction tells us we need to invest $1,020 in bonds and more money, $1,080 in stocks. I'm actually going to check and add those together, and not surprisingly, it still adds up to $2,540. So once Sarah invests her money this way, she will end up with an evenly balanced portfolio. Let's talk about markups and markdowns. Goods travel through many outlets. Before they reach the consumer. I'm going to draw a graph of one item. Let's say this is a watch. We've got the manufacturer. We have the wholesaler. We have a retailer. And we have me. I'm the consumer. What happens with this watch as we go through? The watch costs the manufacturer $100 in materials and in operating costs. Let's just go with materials, cost of goods sold. Then the wholesaler is going to pay more for that. They're going to pay $145. That means that the manufacturer used a markup of $45. They bought it at $100 and they marked it up or have a profit of $45. And here we're going to continue to just talk about gross profits. So $45 happened there. The retailer, well, the retailer is not going to pay $145. The retailer paid $175, meaning we have a markup of $30. Finally, I pay more than $175. I'm actually going to pay $200 for this watch, meaning the retailer marks it up by $25. So markup in dollars and I'm going to explain why I keep on saying in dollars in a moment, is actually equal to the gross profit per item. So for one watch, the manufacturer makes $45. That's their profit. The retailer, their profit is $25. Here, the total markup from start to finish on this watch, on this item, is $100. That $100 is divided up. $45 goes to the manufacturer. Next, $30 goes to the wholesaler, something like Costco, where the retailer shops, or a person who buys from factories then sells just to store. The retailer makes $25, and that's the store at the mall where I bought my watch. I make no money because I'm now wearing the watch. So that's our total markup. When I add those together, it adds to $100 total. And the profits are divided. Like we talked about before with margins, it makes sense to talk about percent. Percent markup is equal to markup over cost. And we sometimes call that the gross profit per item over the cost, or cost of the goods sold. So that's the markup. Here, our percent markup, and sometimes we just call that markup, is $100 in profit over $100 in cost is 100%, or 1. But let's look at each individual one. So we have the manufacturer. Remember, the manufacturer made $45 over $100. That was the cost, is going to be a 45% markup. When we go to the wholesaler, let's just change colors there because why not? The wholesaler made $30, right? $30, but they also paid more. They paid $145 because their cost was more. That's going to be 20.69% markup. And finally, let's go to the retailer. Well, their profit, that was $25, but they paid more. They actually ended up paying $175, which gives us a markup of 14.29%. The denominator here changes because it was the cost at each step. What happens when I add these things together? I end up with around, that means around 80%. I'm going to cross that out. Don't add these. When you add them together, you end up with nonsense, something that doesn't make a lot of sense. And that's because those bases were different. The denominators of those fractions were different, and that's what's giving us a problem. The total markup, as we know, is 100%, even if those numbers don't add that way. And that was because $100 profit over $100 cost equals 100%. Okay, let's talk about margins and markups. Percent margin versus percent markup. Margin is based on sales. Markup is cost as a base. Those are different. Margin is equal to gross profit over sales. And this is the percent gross margin, which is the one we're normally worrying about right now. And here, percent markup is the same amount or numerator, but a different base. Try to figure out a way to remember this. I tend to use markup has a k sound, cost has a k sound. Margin, no k sound, sales, no k sound. That's my mnemonic for remembering why margin goes with sales and markup goes with cost. That may or may not be helpful to you. Let's go through one example of this, a different example. So let's pretend an item costs $100 to buy in a store. The store paid $40. The gross profit is going to be $60. So I bought groceries for $100. It cost the store. And then we have store's profit. Using this basic, we can do both the percent margin and the percent markup. Percent margin is profit over sales. Here, that's going to be $60 over $100, and that equals to 60%. Percent markup, on the other hand, well, that's equal to profit over cost, which is still $60. The cost is only $40, which gives us 150%. That's okay. I'm going to note that markup can be very big. However, margin is always going to be less than 100%. Let's do an example. This is question 1. Arizona Computers marks up merchandise by 25%. Part A. If a laptop costs $500, how much would it sell for? I'm going to write down some formulas to start. Let's remember that percent markup equals profit over cost. I like to start all these questions by writing down an abbreviated income statement. Sales minus costs equals profit. Here we're talking about gross profit, but in essence it doesn't matter overly. We're just going to say sales minus costs equals profit. Now I'm going to fill in the things I know from the problem. I know that markup is 25% or 0.25. I know that sales is what I'm looking for, the sales price. I know that cost to the store is $500. And I know that profit is, well, I don't know that yet. So I'm going to have to find that out. Let's look at this expression. I've got profit equals cost times 0.25. This is a formula. In fact, I can write here that profit equals cost times the percent markup. Remember that one. I can also write this. Sales equals costs plus 1%, sales equals cost times 1 plus the percent markup. Here, I'm going to fill in what I know. The cost is $500 and the markup is 0.25. That means that the sales is going to be $625. I can write that in here. If we needed to, how much would the profit be? The profit would be $625 minus $500 equals $125. Also note, if I use this equation, $500 times 0.25, I'm going to come up with exactly 125. That's the profit. Let's continue on with part B. Now we're talking about a different object, a desktop that sells for $750, and we're going to find the cost. I'm going to remember that percent markup equals 0.25. And I'm going to write that same expression down. Sales minus cost equals profit. This time, I know just the sales price. And I'm trying to find the cost. So what we are going to do now is solve this problem using the expression. Earlier I said that sales equals cost times 1 plus the percent markup. If I divide both sides by 1 plus the markup, I'm just going to say %m for now. This will cancel out as long as it's not equal to 0, and I end up with this expression. Cost equals sales over 1 plus the percent markup. That's another good formula that we can use anytime we need. All I have to do is plug in the numbers that I know. Sales is 750 and markup is 0.25. So I get 750 over 1.25, which equals $600. I put that in here. So now we know the cost, and if I need to know, $150 was the profit. Let's do a check. Profit over cost equals 150 over $600, which is exactly 25%. That's always a good thing to do. Check to make sure that our work is correct. Now let's go on to part C. The company had total sales of $150,000 for the month. Calculate the cost of goods sold and gross profit and percent margin. So now we have a lot more information about this company. I'm going to scroll this up, but I'm still going to remember percent markup for this entire problem was 25%. That's important to know. And as usual, let's just start with the same income statement. Sales minus cost equals profit. Instead of one item, now I'm talking about many items, but it doesn't matter because the math is exactly the same. I know I have sales of $150,000. So what is my cost of goods sold? There's one there. It is, I'm correcting that. Okay, so COGS is the same as cost. And we're just going to say that's sales over 1 plus the percent markup. In other words, we have $150,000 over 1.25, which is $120,000. So $120,000, and that gives us a gross profit of $30,000. We also needed the percent margin. And that's going to be percent gross margin because we don't have any information about operating expenses. So the margin is always going to be equal to profit over sales. So here we have $30,000 over $150,000. Same numerator as the markup, but a different denominator or base. This gives us 20%. So that is our percent margin. Let's go back to that finding a percent margin. I'm going to go based on my laptop. Remember the laptop that we worked on in part A. So our laptop had sales minus cost equals profit. And in that case, it was $625. Our cost was $500, leaving us with a profit of $125. Here, the percent margin would be 125 over 625, which equals 20%. Let's do it one more time. change colors because I enjoy that. Desktop, we've got sales, cost, profit. Here, the sales price of a desktop was $750 and the cost was $600, giving us a profit of $150. So our percent margin is 150 over 750, which equals 20%. No matter how we do this, these are all the same, 20%, 20%, 20%. That's because the markup and margin are always travel together. I'm gonna scroll down here and just say a markup of 25% is always equal to a margin of 20%. Those things travel together. Continuing with question 1, we're going to start talking about markdowns or discounts. Remember, Arizona Computers marks up its merchandise by 25%. That means the percent markup, which equals profit over cost, equals 0.25. Now we're going to talk about a discount. The company is having a sale where all goods are marked down by 10% of their selling price. If a tablet is on sale for $200, how much did it cost? So let's talk about this problem. Again, we've got a markup of 25%, which means that we have a margin of 20%, which is what we found out in part C. I'm going to use the following formula, and that is going to be new price equals old price times 1 minus the discount. We usually call that D. When I divide both sides by 1 minus the discount, or move it around, I end up with old price equals new price over 1 minus the discount. Okay, this is a two-step problem. So step 1 is find the old price. Once we have that, we can start working on the cost. So we know that new price equals $200. And we know that the discount is 10%, 0.10 or 10%. That means that the old price equals new price. Instead of writing new, I'm just going to put in $200 over 1 minus 0.1, which is the same as $200 over 0.9. Here, when I run that through, I'm going to come up with $222.22. I'm going to round this. Originally, there was a bunch of 2s. Rounding, that could be a video all on its own. I can't sell something for a fraction of a cent. That's against the law. A cent, or 1/100th of a dollar, is the smallest proportion I can use. I'm going to round that. So now I've got part 2. I'm going to find the cost. So I've got sales minus cost equals profit. The original price was $222.22. And I know that the markup was 25%, which means that cost equals sales over the markup, 1 plus the markup. Run that through my calculator, and I'm going to end up with $177.78. That was the original cost. I'm going to write a sentence to finish that one off. Okay. Let's talk a little bit more of markups and markdowns. I'm going to go through an example. I'm going to scroll this up. I'm going to buy a pair of Apple brand AirPods for $200. So I get those into my store. Now, my store is going to have a 15% markup. Today only. There is a 15% off sale. Sale is the same as a discount or markdown. What's our profit on a pair of AirPods? Well, let's run through using our formulas. The original price is actually $200 times 1 plus the markup. I'm going to write down the formula underneath, and that gives me a normal sales price of $230. But now I've got a discount. So new price equals old price times 1 minus the discount. Let's write down that formula, and then let's put in our old price is $230, and our discount is 15%. When I run that one through my calculator, I'm just going to note that 1 minus 15% is 0.85. I end up with $195.50. So what was my profit? Well, it's not a profit, it's a loss. I lost $4.50 for every set of AirPods I sold. That's not good for my business. As soon as I'm having a loss or a negative profit, we're in trouble. I'm going to write the moral of the story, and that is 15% markup plus 15% markdown is not 0. Why isn't it? And that has to do with the same reason when we were adding before, when we talked about markups. Our base is different. The base being 230 is different than the base being 200. Let's do one more question to learn more about markups and margins. Arco Fine Handbags prices its products to give a 40% margin. What rate of markup do they use? Let's remind ourselves first of what our formulas are. Percent margin, no k sound, is profit over sales. Percent markup, with that k sound, hard K, is profit over cost. Those are the two formulas we're going to use. I'm going to put in something that we're going to use throughout this course and also in math. When there are no numbers and there's no cost, sales, or profit, just make something up. We can do that because, as we saw in our last example, proportionately the markup and margin are always the same, so it doesn't matter what we do. When we know the margin, I like to set sales to be $100 because $100 is easy to use. So let's pretend we have sales of $100. So we've got sales of $100 minus some sort of cost over profit. Well, what's our profit? Profit is 40% of sales. Or 0.40 times sales. And that comes from this formula. Percent margin equals profit over sales. Multiply both sides by sales, and we come up with profit equals percent margin times sales. So our profit here is going to be 0.4 times $100, which is $40. Okay, fill that one in. If I made $100 in sales, my profit was $40, all I need to do is subtract to come up with a cost of $60. So my percent markup is going to be 40 over 60, or 2/3, and I'm going to round that to 66.66666, or 66.67%. When in doubt, 2 decimal places after the percent sign. Here, we could have set sales to be anything we wanted. Had I set sales to be $1, I would have 60 cents worth of cost and 40 cents worth of sales. I also could have, worth of profit. I also could have set sales to be 237, but that makes the arithmetic harder. 1, 100, 10, 1,000, those are easier numbers to work with. I'm going to do parts B and C together because they really travel together. Our company had profits of $600,000, so what was their cost of goods sold? Well, let's go back to our percent markup. Percent markup is profit over cost. So 0.6667 is equal to the profit, $600,000, over cost, or we end up with cost equals $600,000 divided by 0.6667. I want to make a note. If this algebra is tough for you, that's a good reason to go back into the homeworks and look at the introductory lesson 0 homeworks. There's lots of good algebra there. I'm going to go back to this question. All we have to do is say that this is actually $900,000. Let's go into part C right away. I wanted to do these together because what I really want to do is an income statement. Sales minus cost of goods sold equals gross profit, minus operating expenses equals net profit. This is always a good way to start. Okay, they had profits of $600,000, and here I'm going to note it doesn't say so, but this must be gross profit or it doesn't make sense. So under gross profit, I'm going to write $600,000. I'm going to write in my costs of $900,000, and then I'm going to go upwards and note that sales must be $900,000. So I'm going to use K for 1,000. Plus $600,000, and that ends up with 1.5 million. Let's write that in. Okay. Operating costs, net profit. Right now, right next to this, I'm going to draw a common line income statement. 100%. I know the gross profit is 40% because that's the margin. We've already done that one, and we know here then that the cost of goods sold is 60%. What do I know? The operating expenses are 5% of sales. 5%. That means that OP is going to be, take that sales and multiply it by 5%. That gives us $75,000. I put that into here. Now I have 2 options. I can do just subtraction. That gives me a net profit of $525,000. But I can also subtract these together. 40% minus 5% equals 35% net margin. It's difficult to know whether people are talking about gross margins and net margins. When in doubt, always try to clarify. In case we want to check our work, we can note that 35% of 1.5 million is equal to 525,000. So we get the same answer either way. Finally, let's do part D. The most recent shipment of bags had a cost of $270,000. What is the selling price? Well, this is back to the basics, and we have sales equals cost times 1 plus the percent markup. When I put this together, I end up with $270,000, and I know my markup. It's 1 plus 0.666666667. In general, it's better not to round, but rounding in this case won't come up with a really big problem because we end up with sales of $450,000. Hi, today we're going to talk about trade and cash discounts. A trade discount is a different way of looking at markups. Instead of looking at it as marking up, we're going to look at it backwards. So let's look again at some sort of item going through the chain, the supply chain. Let's start with the manufacturer. This time we're going to go straight to the retailer and skip the wholesaler step, and then the consumer. So we have a good, it travels from the manufacturer to the retailer to the consumer. At each step, someone is paying money. Let's look at the retailer. The retailer purchases it for $200 from the manufacturer, and they're going to go ahead and sell that item to me for $250. So the retailer makes $250 every time they sell an item. Each item costs them $200, and then we have that gross profit per item, or markup in dollars, which is $50, and that is, let's call that markup in dollars, or gross profit. When we look at this as a percent, we can see that markup is going to be gross profit, or markup in dollars, over cost, which is $50 over 200, and that is 25%. So the markup is $50 or 25%. That's one model of looking at how the retailer buys it when the retailer sets the price. We have another model. I'm going to call this the Apple model because it's the way that Apple sells their products. In this model, the manufacturer sets the price, not the retailer. Let's write that down. They set the price, not the retailer. The store then bought an item, let's say those AirPod earbuds or some sort of Apple product. They bought a $250 item with a discount. And I'm going to call this a trade discount because that's the discount for being a retailer of $50. So they had a $50 discount. And that's going to be what percent? Or that would be $50 over $250. That's a 20% discount. So they bought that $250 item at a discount. Let's look at the supply chain from the way the retailer buys it. We're going to say the retailer, they buy from the manufacturer and then they sell it to the consumer. And on the way, they mark it up by 25% from 200 to 250, or they mark it down by 20. And that is going the opposite direction. So, moral of this story is a 25% markup is the same as a 20% discount. That's how that trade discount works. Now let's talk about chained discounts. That's going to be when we have more than one discount. And we're going to see in our examples, this happens all the time. So let's say you go to a store and they have a sale, 25% off, plus today only an additional 5%. That's a good sale. What we do is we apply one discount, then the other one. So let's look at pretending that we have something that's worth $100. So if we have our original price is $100, then our new price is going to be $100 times 1 minus 0.25, or $75. Then we apply the next one, today only. So today's price is going to be $75 minus 5%. That is $71.25. That's the price we're paying today. But wait a second. 25% plus 5% equals 30%. $100 times 1 minus 30% is $70. So this is not the same. And we've seen this before. The moral of the story is never add. Because we are really using proportions with different bases, this doesn't make sense. What we're really going to end up doing is multiplying them together. We could do this all in one stage. Question 1. A company makes snowboards that retail at $1,250. The company offers chain discounts of 30% and 5% to its retailers. Calculate the price a retailer would pay for the snowboards. Why are there multiple discounts? Sometimes that's everybody gets 30% and 5% is for clients who pay on time or clients who have a long relationship. There's many reasons to have a chained discount. The price that the consumer would pay is called the list price. Here it's $1,250. Our cost is going to be our list times 1 minus the discount 1, 1 minus discount 2. And all we have to do is put our numbers in there. Our list price is $1,250, 1 minus 0.30, and 1 minus 0.05. I'm going to simplify that before I put that in a calculator, just because it's easier to put in a calculator when we simplify it a little bit. Running that through, we end up with $831.25. That's what a retailer is going to pay, even though the consumers are going to pay a lot more for their snowboard. A good question to ask is what single discount or single equivalent discount is equivalent to these two discounts? That's a lot of words. What that means is instead of saying 30% and 5%, we could just say one number like 38% or 40%. One thing to remember from before, we know it isn't 30% plus 5% equals 35%. That's definitely not going to be the answer. Let's put an X right through that. But we're going to still use two different methods. So method one, we're going to take the old price and the new price as a proportion. So we take the new price or the cost over the old price or the list and look at them as a proportion. So I've got $831.25 divided by the list price of $12.50. And when I put those together, I have 0.665. That means that we paid 66.5% of list. Or we had a discount of 1 minus 0.665 equals 33.5%. Let's just scroll down a little bit more. Now let's try another method. Either of these works. There's more methods even than I'm saying. That's one of the things with the algebra, but whatever method you're using, you want it to work. I'm going to take the price and I'm going to put it on both sides of my equation. Then I'm going to use a different color and you'll see why. Price times 1 minus our discount. I'm going to call our single discount X because X often stands for unknown. It's the same as price 1 minus 0.30, 1 minus 0.05. Let's just erase that. Because we have price on both sides and our price is non-zero, we can just cancel those numbers out. So now I have 1 minus X equals 0.7, 0.05. Sorry, 95. I multiply this through and I get 1 minus X equals 0.665. That's familiar, which means X equals 0.335 or 33.5%. Notice that both methods are giving us the same answer. This one is more algebra, and this one uses the numbers you already know. Now let's look at what the percent markup is to the retailers. Well, this is something that we know how to do. Percent markup equals profit over cost. I know that the sales price or list price is $12.50. The cost is going to be $831.25, which means that my gross profit per item must be $418.75. When I put this together, let's change colors because why not? I end up with $418.75 over $831.25, which gives me 50.38% markup. A nice, healthy markup. Now, part D. Due to a slowdown in sales, the manufacturer would like to increase the total discount given to its retailers to 40%. What additional discount must they offer? This is asking us to find one more discount, D, so that I can come up with this equation. I'm going to say $12.50, 1 minus 0.30, 1 minus 0.05, 1 minus D, and I don't know what D is equal to, right in that $12.50 again, 1 minus 0.40. Once we have it written out this way, there's lots of ways we can solve it. I like to observe that that $12.50 is the same on both sides, so I don't actually need to know what that is. I also know what 1 minus 0.3 and 1 minus 0.05 is. That is the same as 1 minus 0.335 because we've done that. 1 minus D equals 1 minus 0.4 is 0.60. So now I can divide both sides by 1 minus 0.335. And that's just 0.665. We know that, and we end up with D equals 1 minus 0.9023, or the discount is 9.77%. 3 discounts, 30%, 5%, 9.77%. When I add them together and chain them properly, that is the same as 40%. Just one note on these videos. I'm not as amazing at arithmetic as it looks like. I pause these videos to use my calculator, and I encourage you to do the same. Get out your calculator and use it to compute as you go along. Okay, now we're going to talk about cash discounts and payment terms. These are things that are going to incentivize us to pay early, or to pay in cash instead of credit. You might have seen this before. You go to a restaurant and there's a cash discount of 5% if you pay in cash and don't use a credit card. So let's put not credit. This is good because it incentivizes our customers to do the things we want. When we write down payment terms that include our discounts, it looks kind of like this. 3-10. I'm going to write some more things here. N45. And there's some other stuff here. This means there is a 3% discount if you pay within 10 days. Otherwise, the net, that's where the N comes from, the net or everything, all the money is due in 45 days. 3, 10, and 45. 3% discount, 10 days. Net, everything due in 45 days. Then we put some extra terms here if we need it. There's other abbreviations that you can always look up. So this bill is due in 45 days. I'm just going to put a little asterisk here. Any discount is for goods only. Not on your tax or your delivery, etc. That goes to a third party. So you don't get a discount from the post office for paying early. Let's look at a sample invoice. Here we have an invoice. It's dated. It looks like it is dated May 12th, 2020. That's right around the time that I'm recording this video, coincidentally. And it is from BCIT, and it's to me, Amy Goldlist. It has some important things like addresses, BCIT's logo, importantly, my customer ID. And over here, we've got our shipping method and our terms and our delivery date. This should not say 2016. Let's change that to 2020. First, let's look at these terms. 115 and 30. So let's interpret that. Over here, actually, let's just write over here, 115 and 30 ROG. 1% discount if paid within 15 days. Or the whole thing is due in 30 days. The 30 days is from the receipt of goods. ROG stands for receipt of goods. You can look up different abbreviations. That's not super important for this class. It just means that if you don't get it until September, even though we ordered it in May, it's going to take us, we don't have to start paying until 30 days after September 16th, even if it took 6 months to ship. And it looks like we've got 2 calculators and 5 sets of course notes. Looking at this, you can see how much it costs, $41 per calculator. Multiply that by 2 because there's 2 of those. And course notes, $31. We multiply that by 5 because there's 5 of those. We end up with $237. We add in our tax, we add in our delivery on top of that, and we end up with $30.44. Authorized by and date, I could sign this one myself, even though it's shipped to me. The important thing is this starts on September 16th, 2020, so it's due on October 16th, 2020, 30 days later. Now let's do a long question that has all the discounts and payments that we've done so far. On November the 3rd, the Springfield Power Plant receives 10 fuel rods. The rods have a list price of $20,000 each with discounts of 5 and 10% and payment terms of $210, $115, net $30. What's the last day the invoice can be paid? How much must be paid? So first, let's talk about how much we owe. Well, it starts on November the 3rd, and we've said net 30, and that is the same as saying N30, but often we do just write net. The last day that we can pay is December 3rd, 30 days after November the 3rd. If you're interested in date counting, we will be looking at that in the BA2+. So look forward to a video about counting dates with your BA2+ calculator. Well, how much are we going to pay? Well, we have 10 fuel rods. Each fuel rod costs $20,000. And we also have some discounts. One is 5% and one is 10%. We put all of this together, dump it into a calculator, and we end up with $171,000 even. So we have 2 discounts here. What's the last day the 2% discount may be taken? And how much must be paid? Let me just say we have 2 discounts. We actually don't get them both. We get 2% if we pay within 10 days or 1% within 15. We never get both discounts. So 3%, not going to happen. We only get a 1% or a 2% depending on how much we pay and when. So if we add 10 days, we end up with November the 3rd plus 10 days equals November the 13th. Easy. How much do we pay? Well, it's $171,000 is what we're supposed to pay, but we take a bit of a discount off of there. 2% to be precise, which gives us a payment of $167,580. That's a big discount. If we look at it, the amount of the discount is $171,000 times 0.02, 2% of that is $3,400. So that 2% is worth getting if we're going to save ourselves $3,420, almost $3,500. Let's go back to this problem. We actually can't pay the entire thing at once, but the supplier offers cash discounts on partial payments. So what we're going to do is pay what we can and then pay the rest later. So after 5 days, we pay $100,000. And after another 15 days after the invoice, we pay another $50,000. Now we want to know how much we owe. To do this, let's start with a balance sheet. So November 3rd, that's our original. I'm going to say within 10 days and within 15 days. Those are our different categories. Here, if we pay within 15 days, we get a 1% discount. And if we pay within 10 days, we get a 2% discount. So let's start with what we owe. We owe $171,000. We make our first payment within 10 days. That payment is $100,000. When we tried to do the discount, we multiplied it by 1 minus 2%. The opposite is dividing by 1 minus 2%. When we go this way to the left, we're going to divide. So $100,000 divided by 1 minus 0.02 is the same as $102,040.82. This is a credit. So we have a credit of $100,002,040.82. That's what comes off our account, which means we now owe less money than if we'd made that $100,000 later. We actually only owe $68,959.18. Now let's make another payment. This other payment is going to be $50,000. So let's write that in. But this payment was within 15 days. So we get a 1% discount. So we're going to divide that by that 1%. So 50,000, I'm just going to simplify 1 minus 0.01% to 0.99. And it turns out that the credit for that $50,000 is $50,505.05. When I subtract that from 68, we owe $18,454.13. That's going to be the amount of the final payment. Okay, let's just write down what we did. The credit is the payment over 1 minus the discount. The payment that we have to make is the amount we owe, or the credit that we want to get, times 1 minus the discount. I'm going to write that we never ever see 1 plus the discount. We're never going to multiply something by 1.02 or divide by 1.02. To finish off, let's do one more partial payment problem, but a difficult one. An invoice for $10,000 has payment terms 310, 220, and 45. Discounts are allowed for partial payments. The company made a payment of $3,000 9 days after the date of the invoice and a second payment 18 days after the date of the invoice that reduced the balance owing to $2,000. What was the size of the second payment? Whew, it's a difficult one. So let's look at our invoice. Our original one is due within 45 days. If we pay within 10 days, we get 3% discount. And if we pay within, it looks like 20 days, we've got a 2% discount. At the beginning, it looks like we owe $10,000. Let's make a line here. We owe $10,000. Now let's put in our first payment. Our first payment was $3,000 and it was 9 days later, so it got that discount, which means we actually end up with a credit of $3,000 over 1 minus 0.03, or $3,092.78. Notice that I'm rounding here. The rounding is a little bit contentious. Some people round at the middle, some people round at the final step. Here you'll have to figure out from the supplier what they would prefer, which means that now we owe $6,907.22. Let's make our next payment. Our next payment is something. If it's something, I like to call it X. That X payment is worth more than it is because we get a 2% credit. When I subtract this, I end up with $2,000. So let me write that as algebra. I'm going to scan this up a little bit. And I have $6,907.22 minus X over, I'm going to simplify that to 0.98 equals $2,000. Now I've taken my partial payment problem and I've made it an algebra problem, which is easier because we know how to solve algebra problems. X over 0.98 equals 6,907.22 minus 2,000. I'm going to scroll up a little bit. X equals 4,907.22 times 0.98, and that gives me $4,809.07. This is the size of the second payment. Hi, today we're going to talk about currency conversions and along the way other types of conversions as well. We're going to jump straight in with question 1. How many Canadian dollars will it take to buy 500 rubles? I'm going to go over here and highlight the exchange rate, and we'll look about that in a second. First, let's look at some rules for converting. The first rule is to multiply by 1. Multiplying by 1 changes nothing. And that's because whatever number we have, let's say $5 times 1 equals $5. It doesn't change anything. Here, I know that 1 ruble over here is the same as 0.1783 Canadian dollars, or 17 Canadian cents. You can look up the exchange rate every day that you do calculations. I've fixed these ones in time, but normally this is something that changes day to day depending on what's going on in the world. Because these two things are equal, when I put 1 on the top and 1 on the bottom, always using those units and putting them in, it just equals 1 because the two things are equal, top and bottom, numerator and denominator. Again, it also doesn't matter if I reverse that and put the Canadian dollars on the top and 1 ruble on the bottom. All of those fractions equal 1. And that leads me to rule number 2. Always show units. If you don't show units, then these fractions aren't true. So if I say 0.1783 over 1 equals 1, that would be incorrect. It's the units, the Canadian and the rubles, that make this equation correct. Okay, so now let's actually solve our problem and write down our 500 rubles. Well, that equals itself. Now I'm going to multiply it by a fraction. So I'm going to put that over 1. I'm going to actually write that in a different color, but you can always divide something by 1. It doesn't change anything, but it does make it easier to understand the fraction. I'm going to multiply that by this fraction over here. So 0.1783 Canadian divided by 1 ruble. Now, when I look at this, I've got a ruble on the top and a ruble on the bottom. I'm going to cancel those out. So the only units left are that CAD or Canadian dollars. That means this is the same as 500 times 0.1783 Canadian dollars, or $89.15 Canadian. That is our equivalency. So we can buy 500 rubles with $89.15 Canadian. And we can put that dollar sign in or not, since we have the CAD. Okay, let's do the second question. This time we're going to convert 500 euros into Canadian dollars and see how much money we would need to buy 500 euros. If I look at this expression, I'm going to write this a different way. 1 euro is equal to 1.4245 Canadian. When we're working with only $1, I can use the dollar sign to mean Canadian dollars. This is the euro sign. It looks like a C with a line through it, and I can use that as well. We are going to see in our next two questions, when we have two currencies that are both named dollars, like Canadian and US, it's best to just use the name of the country. But let's start with this. So 500 euros is equal to 500 euros. Let's multiply that by a fraction. I've got euro on the bottom, so I can cancel that out, and I've got dollars on the top. I don't need to put the 1 underneath there if I'm comfortable with cross multiplying, but you're welcome to. Cross off the euros, and I am left with 500 times dollar sign 1.4245, which is the same as $712.25. It takes $712 to buy 500 euros. And that's because in this exchange, euros are worth more than the Canadian dollar, while rubles are worth less. So 500 rubles is only 89 Canadian dollars, while 500 euros is 712 Canadian dollars. Now we're going to do a more complicated and bigger problem. In this problem, we're not just going to convert currency, we're also going to convert our units. One note, in Canada, we use the metric system, while in the United States, they use the imperial system. However, because the US is our closest trade partner, we often use US measurements like feet and miles and pounds when we should be using metric, like meters and kilometers and kilograms. That's why if you're going to work in Canada, it's really important to be able to convert Canadian units. So this time you have decided to visit the Thrifty Market in downtown Bellingham, which is just across the border in the United States. You purchase a quart of black cherry pop for $1.25 per bottle, US. Is this a better deal than Canadian pop, which sells for $5.10 per 6-pack? Solve the problem by changing the US price into Canadian price per 6-pack. I'm going to highlight those. You can see here that we've used dollar sign for both Canadian dollars and US dollars. That's confusing. That's why we're going to use CAD for Canadian and USD for US dollars. And here are our measurements from above. 1 US dollar is $1.12 Canadian. Right now, as I'm filming this, both of our dollars are in free fall and nobody knows what will happen with the economy. So I'm going to stick with numbers that got pulled out about 10 years ago. Okay, let's start with this. So the price for the US one is $1.25, and I'm going to write USD per 1 quart bottle. I'm going to say QT means quart. Okay, so it's $1.25 per quart. Let's start multiplying it by things. First, let's get rid of that US dollar. To do that, I want a fraction with US dollar on the bottom. If I put US dollar on the bottom here and the top there, they'll cancel off nicely. So 1 US dollar is equal to 1.1218 Canadian. When I do my calculations, you can see that US dollar, those nicely cancel. Okay, now let's get rid of quart. So what I'm going to do is put quart on top. I know over here that 4 quarts is 1 US gallon. 4 quarts is 1 gallon. I'm just going to say gallon and not US gallon. That should be clear. So now I have quart on the bottom, quart on the top, nicely canceled out. Let's add to this. Let's get rid of the gallon now. I know that 1 gallon is equal to 3.7843 liters. I'm just going to use a capital L for liters. Okay, now I can cross off gallon. Now I have something that's in Canadian dollars per liter, but I actually want this to be in Canadian dollars per 6-pack. The good thing about the metric system is that it's pretty easy to convert. 1 liter, let's just change colors there to make it clearer. 1 liter is equal to 1,000 milliliters. Liter disappears. Now we have a price per milliliter, which is useful, but we want to get this into cans. In Canada, cans are about, or at least in this case, they're 355 milliliters. Milliliters is on the top to cancel out the bottom, and that's 1 can. We want this in a 6-pack, so let me just cross out milliliter. And I want to get one more thing here. I have 6 cans is a 6-pack of pop. Can. Okay, I'm going to have to rewrite this whole thing because it's a big equation. 1.25 times 1.1218. I'm going to leave that Canadian till the end of there, but I am going to put it in. I'm just doing things on the numerator of the top. The 1 here, I don't have to put that in. 1 here, I don't have to put that in, but I do have to put 355 and 6 cans, and that is CAD, or the units. Now let's do all the denominators. 1, 1, 1, 3.7843 times 1,000, and now that's just 6-pack. And there we have it. Our units, the only ones that were canceled, were Canadian dollars per 6-pack. So we have this in here. Now we just plug this into a calculator. I'd like you guys to do this at home. Just so you know, when you're doing these videos, it's best if you're following along with your calculator. You can pause me whenever you want and make sure that you got 3.16, once we round it, Canadian dollars per 6-pack. If you didn't, that's something you should come ask me, and we'll talk about your calculator and we'll go over some calculator techniques. So what is it cheaper in? So this is the US price, remember? And the Canadian price for Canadian pop is $5.10 per 6-pack. And that's Canadian. Which one would you prefer to buy? Well, spoiler for all of these problems, things are almost always cheaper in the US. So don't be surprised if this is what happens. This type of problem where we're converting both units of measurement and units of money at the same time comes up a lot in Canada. Gas in the United States is measured in gallons and it's measured in liters here. So it's important to be able to do that conversion. But using this method and multiplying through and keeping careful track of our units, you should never make that many mistakes, only small arithmetic ones. But once you get good at this, you won't make mistakes.
Hi, let's format our BA2 Plus calculator correctly. You'll notice that my calculator is probably a different version than yours, but they all work the same way. Notice that it says 0.00. We want it to not show 2 decimal places. We want it to show all the decimal places. And we're going to check to see how it's doing arithmetic. If I put in 3 plus 2 times 10, I expect an answer of 23, using order of operations to know that multiplication comes before addition. If we don't use order of operations and we do it incorrectly, we end up with the number 50. Checking out our calculator, the 3 plus 2 times 10 Without putting the equals in between, we get 50. That's the incorrect answer. So we're going to change the formatting on this calculator. We go to second, and when you go to second, now you get access to all the things on the top. On top of the decimal place is the format. Press that, and now it says decimal is 2 places. We don't want that. 9 is the biggest we can have, and if we don't put 0.0, it means when there's 9 decimal places, it will show 9, and when there's 0, it will show 0. So I'm going to press enter. Now I'm going to scroll up using the arrows to scroll around till I get to the CHN mode. That's chain mode, and that's what's giving us the incorrect answer of 50. Since I want algebraic order of operations or order of symbols, I'm going to go to second, then press that enter again, and now it says AOS. Once I clear, I can try that question again. 3 plus 2 times 10 is 23, what we think it is. Let's just go over a few more settings. Decimal places, we've seen that one. If I scroll down, we get degrees. If you're going to be doing calculus or engineering math, you might need to know the difference between degrees and radians. Not necessary for this course. This is our date mode. If you are European and you're used to day, month, year instead of month, day, year, you might wish to change it. But our textbook and all of the notes we do are going to assume we're using US mode. Next, US mode shows a comma as a thousand separator, and a decimal place separates the fractions, or a fraction of a cent. We could set this to European mode, which uses space as a thousand separator and the comma for decimals, but in Canada, we use the US mode. Finally, we get back down to AOS. Clear out of that, notice it doesn't say 0.00, and our calculator is set correctly.
Final question, question 3. You are planning a winter surfing vacation. You will begin on the North Shore in Hawaii, try to catch the 50-year storm at Bells Beach, Australia, and finish your trip with a little longboarding on New Zealand's North Island. You estimate you will need $500 in each currency. How much Canadian will you need to spend? I'm just going to separate that. I've highlighted the currencies that we're going to use. Canadian, Australian, New Zealand, and USA. Unfortunately, they were all dollars, which is why we're going to use the abbreviations, and those are official abbreviations. So let's start with how much we need. So we need 500 US dollars. We need 500 Australian dollars, and we need 500 New Zealand dollars. We can do all of these, and we're going to put this all together into one equation and do it all at the same time by multiplying each one by a fraction. 500 US dollars times, well, we've done this one before, 1.1218 Canadian dollars equals 1 US dollar, plus 500 Australian dollars, well, that is 84 cents over 1 Australian dollar, plus our 500 New Zealand dollars. And we know that 1 New Zealand dollar is equal to 71 Canadian cents. Let's work this out. All we have to do is cancel off those units and do some multiplication and addition. I'm going to dump that into a calculator and come up with $1,340.45 Canadian. Looking at these currencies, which one is more valuable? Well, that's going to be the US dollar. The US dollar is worth more than the Canadian dollar. The Canadian dollar is worth more than the Australian dollar because 1 Canadian dollar is 84 cents Australian, but 1 Canadian dollar is $1.12 Canadian, and Australian is stronger than the New Zealand dollar. That's because 84 Australian cents is equal to 72-ish New Zealand cents. Okay, now let's do part B. When you land in Auckland, New Zealand, you discover that you still have 65 US dollars and 90 Australian dollars in your wallet. And you'd like to exchange that for New Zealand currency. Since we don't have exchange rates from from US dollars to New Zealand dollars, we're going to have to do an intermediate calculation to Canadian. So let's write what we have. We have 65 US dollars plus 90 Australian dollars. And we're going to convert that. I'm going to zoom this up. So 65 USD, and I'm going to multiply that and change it into Canadian because that's the only thing I know how to do. But I'm also going to change it into New Zealand. So let's change that in from Canadian to a New Zealand dollar. We know that 1 New Zealand dollar is 71 cents Canadian. And when I look at my conversions, US cancels, Canadian cancels, and I'm left with just New Zealand on the top. I'm going to do the next one in the exact same expression. I've got 90 Australian dollars, and I'm going to change that from Australian into Canadian. And here, this is worth 84 cents. Now it's in Canadian. Now I'm going to change that the same way I did before into New Zealand. 1 New Zealand dollar is 71.68 Canadian cents. I go through Australian, Canadian. I'm just going to rewrite this expression because it will be easier. 65.1.1218 over 0.7168 Canadian, sorry, not Canadian, New Zealand. That's what we were left with here and here, plus 90 times 0.8423 divided by 0.7168 Canadian. I put that into my calculator and end up with $207.48. And that's New Zealand dollars. Just one more note here. We've simplified things a little bit. When you exchange money, the bank takes a cut. So you're not going to get the exact amount. A little percentage is going to go towards whoever is exchanging the money. That's the reason they do it. We're going to ignore that in this instance because we're looking at a little bit simplified, but think of that as more of a fee. Hi, we're going to use the BA2 Plus calculator to compute some dates. We're going to start with an example. An invoice dated June 1st, 2010 is due in 45 days. Find the due date. Let's highlight that. Okay, so first thing we start by going second and then the date. Date is on top of 1. We're going to put in the date 6.0110. I'm going to write this down. So 6 stands for June, which is the 6th month. June 1st, note that we have to put a 0 there if it is 1 digit long, and this is the last 2 digits of 2010. Okay, so to put that in, we go 6.0110, and then we have to press enter to store it. Now I want to know 45 days later. I'm going to scroll down to DBD. DBD is days between dates. So the days between dates here is going to be 45. Enter. Now let's go and back up to date 2. And all I have to do is press compute to find out that it was Friday, July 16th, 2010. Let's do another one. Let's figure out how old a person might be in days. So let's say, go back up to date 1. Let's say someone was born on September 15th, 1990. In that case, their date would be 09 or just 9 for September, 1590. So I'm going to go 9.1590, enter. And today's date, I'm going to go down. Today's date is actually May, which is 5.17th, 2020. Press enter. When I scroll down to days between days, all I have to do is press compute to find out that it's 10,837 days. Finally, what day of the week was I born, or a fictional person? Scrolling back up to date 1, we can find this very easy. Once we have 3 things in here, we can just compute the other one, and it tells us that September 15th, 1990 was actually a Saturday. Finally, let's look at the last item, DBD down to ACT. And if we go one more, we're back to date 1. ACT stands for actual. That's a 365 days plus leap year every so often, every 4 years. The other calendar we can do is 360. That's going to be a calendar that has 12 months of 30 days each, or 360 days. We don't use this one because the Earth takes 365 and a bit days to revolve around the sun, even though 360 would be easier math. So we keep that at ACT. I'm just going to write 360. That's a fictional calendar. And that is, Hi, we're going to talk about cost equations today. A cost equation is linear. So it's of the form y equals a plus b x. And just so you know, if you learned this in high school, you might have seen this as y equals mx plus b. Same thing, different words. I like to say y equals intercept plus slope times x. Okay, for costs, we have an equation that looks like cost equals fixed cost plus variable cost per item times the number of items, or C equals FC plus VCX. I'm going to draw this. Here we've got our axes, and we're going to draw a line. We have our intercept A here, and we've got a slope. So our line looks something like this. Let's just turn that ruler around and draw in a line. Okay, the slope is the variable cost. Let's jump into question 1. You're concerned about your cell phone bill for this month and you can't remember how your plan actually works. You've been careful to keep track of how much data used each month, and this month you've used 160 megabytes. Using the payment information from your online banking, you compiled the following. What is the independent variable and what is the dependent variable? So here, cost equations are easier in that cost is always going to be the dependent variable, and X is the independent. I like to say that Y depends on X. Here, cost depends on data used. The more data you use, the more expensive it will be. To put this into a function, we have cost equals, we've got some sort of base rate. no matter what, we're not going to get away with using it for free. We're going to pay a certain base, plus we have some sort of price per megabyte times the amount of data used. So cost is going to depend on the data used. Part B, use a graph to determine the amount of your cell phone bill for this month. I've gone ahead and put a graph in here. Usually we use computers for these, or graph paper works perfectly well. I'm going to put in my points. X is the megabytes used, Y is the cost. So we have our points. When we used 120 megabytes, we spent $40. Let's put that MB in there. When we used 80 megs, we ended up spending only $30. And when we had 200 megabytes, we ended up paying $60. So those are our 3 points. Line is determined by 2 points, so 3 is just extra. Drawing this, I've gone ahead and labeled all my axes and I've used units. And I know I don't have the neatest handwriting, but I try. So let's draw in these plans. Let's use red. So what we're going to do is put in those points. So 120, 40. 120 on the x-axis, 40 on the y-axis. 80, 30. That's going to be halfway here. Finally, we have 260. That is over here on this. And when I line those 3 points up, they look like a line. I'm going to use a ruler to try to get this perfect. And again, when you're freehanding it, it doesn't matter if it's perfect, but it's a nice thing that we can do. There's our line. So looking at that question, what do you think the amount of our cell phone bill is this month? Remember, this month, we used 160 megabytes. So what we're going to do is look over here, and I think this month, right around there, I'm going to assume it's around $50. Looking at a graph isn't precise, but often it's good enough for whatever we are trying to do. Part C, determine the slope of the line in the graph and describe the slope in the words of the problem. This is a review from high school work, which you might remember. Slope is defined as rise over run, otherwise known as the change in y over the change in x. We can look at that as any 2 points, we take y2 minus y1, and we divide that by, that is an error, x2 minus x1. Lovely. This is going to be our variable cost. In this case, let's pick 2 points. I'm going to pick 2 of them that look easy enough. I'm going to choose as my 2 points the following. For point number 1, I'm going to say 80, 30. When we used 80 megabytes, it cost us $30. And for point 2, I'm going to say that when we used 120 megabytes, it cost us $40. Those are the points I'm going to use. So the slope is going to be the rise, the change in the money or cost, 40 minus 30, over the run, which is going to be 120 minus 180. Make sure that your units match up there. Okay, when I put that in, I get 10 over 40, or 0.25. I'm going to write that in the words of the problem. For each additional megabyte I use, I'm going to pay an extra 25 cents. I'm going to make a note here. Let's say we had flipped our y1 and y2. In that case, I'd end up with 30 minus 40 over 80 minus 120 megabytes. In this case, what I end up with is negatives here. I have -10 over -40, which still equals 0.25. The order doesn't matter as long as I am consistent. If we don't pay our cell phone at all for the month of October, how much will you have to pay? Well, let's scroll up and look at that. For 0 megabytes, we have what is the intercept. It looks like somewhere around halfway between 0 and 20, so I'm going to go with around $10. I'm going to call this by inspection, which means I looked and I didn't do any actual arithmetic. Finally, let's determine the equation of the line in the graph. Looking at it, we know the slope, and we know that we will end up with costs equals fixed costs plus variable costs times x. We suspect that the fixed cost is somewhere around 7, and we know what the slope is. I'm going to put in one of the points, and here I just choose any point that I would like. 80 megabytes cost $30. Either of these points is fine. So I'm going to put that in here, knowing that the variable cost is 25 cents. Now I'm going to put in 30 for C and 80 for X. I'm just going to leave off the megabytes because it's not necessary. But now we have this. It ends up being FC equals $30 minus 0.25 times 80. And we can just run that through a calculator and we get $10, which is actually what we guessed in the previous examples. So that is true. D. Now let's look at how much C is our slope, and that is already there. So now let's just check our work by putting in every single point. So X equals 120, cost equals $10 plus 25 cents times 120, that's $40. Correct. Now let's put in X equals 80 megabytes. Now our cost is going to be $10 times 25 cents times 80. And that is $30, just like we want it to. Finally, our last point was 200 megabytes. Cost equals $10 times 25 cents times 200 megabytes, and we end up with $60. Those are the points that we're looking for. Finally, I want to just verify part B. So B said, what happens when we make 160? So when we use 160 megabytes, our cost should be $10 plus 25 cents times 160 megabytes. Running this through a calculator, it equals $50, which is the amount that we estimated. Hi, continuing on with question 1, let's look at a different company. Remember, the cell phone bill on the company that we have is, the cost is $10 connection fee per month plus 25 cents for every megabyte used. Part F, another company offers a cell phone plan that costs $20 per month and charges 15 cents per megabyte. Determine the cost equation and graph it using the same grid. This time, instead of having 2 points, the line is given to us in words. We can look at this and say that cost is going to be $20 fixed costs plus 15 cents times X, where X is the amount of megabytes used. Remember the line that we found in part B, and we graphed that on the line? Now we're going to graph this second cell phone plan on the exact same line. I'm going to do that by finding 2 points. This time, I wasn't given any points, so I'm going to have to find them. Usually, using the intersection point, or when x equals 0, is going to be the best choice. When x equals 0, the cost, or y, is equal to $20. So that gives me the point 0, 20. Let's put that in. Purple. Okay, now let's think about one more point. Here we can choose anything we'd like, but it makes sense to come up with a simple number to use. I've chosen to use x equals 200 here because I think it will be fairly simple. When x equals 200, the cost is going to be $20 plus 15 cents times 200. Put that into a calculator and it comes up with $50. That gives me the point 250. Easy enough to use. 200, let's find 50 right over here. So now we have 2 points. All we have to do is connect them with a straight line. Perfect. Let's put a bracket there. Now we have our 2 points together. Now what we're going to do is compare our 2 plans. Sometimes one of them is cheaper and sometimes another one of them is cheaper. So let's look at plan 1. If we are going to spend 175 megabytes, then our cost will be $10 plus 25 cents for each of those 175 megabytes, which is $53.75. Plan 2, on the other hand, is more expensive for its connection fee, but cheaper. Otherwise, only 15 cents a megabyte. So when I put that in, I get $46.25. I can kind of see that. Let's look at 175. It's about here. I can see that plan 2 is cheaper. It's lower on the line than plan 1. Let's mark in that plan 1 is in red. Different prices. What's happening here is that if you don't spend any, plan 2 is going to be more expensive. If we don't use it at all, it's a $20 fee as opposed to $10. But if we spend 200 megabytes, it will be $60 on plan 1, but only $50 on plan 2. What we're going to look at is the point at which they're the same. By inspection, looking at this, it looks like somewhere between 80 and 120, somewhere around 100, our 2 plans will have the same cost. When we spend less than this amount, use less data, plan 1 would be cheaper. If we use more data, plan 2 is cheaper. To find that point, what we're going to do is solve some equations. I'm just going to highlight over here in G that plan 2 was cheaper. So what I'm going to do is solve a system of equations. Cost 1 equals cost 2, and I'm going to solve for x. Cost 1, well, that was $10 plus 25 cents a megabyte. I'm going to change colors here to say cost 2 was $20 plus only 15 cents per megabyte. To solve this equation, I'm going to move all the x terms to the left and all the constants to the right. Now I get 25x minus 15x, 15.15x equals 20 minus 10. Notice that I'm leaving all those units in there. That is 10 cents times x equals $10, or x equals 10 over 0.10, which gives me exactly 100 megabytes. That was what this looked like. By inspection, this looked to be at about 100. The cost is the same there. So, in conclusion, if we average more than 100 megabytes per month, plan 2 is going to be cheaper. If we average less than 100 megabytes per month, plan 1 will be cheaper. So the conclusion is we're going to take our use patterns and figure out which plan is best. Question 2. Let's do one more linear equation that is a costing equation. Babysitters R Us charges a flat booking fee plus an hourly rate. On a normal workday, I hire a sitter for 9 hours and I pay $123.50. On Saturday nights, I usually hire a sitter for 4 hours while I go to the movies, and I pay $66. Find a linear equation giving cost in terms of the number of hours. So this is a question where we have 2 points, and we're trying to find the linear equation between them. So first of all, the independent and dependent variable. Cost is always the dependent variable in a costing equation. So we have here cost depends on time. Time is always independent. Costing is dependent. Remember, we say Y depends on X. Cost depends on it. Time is never the dependent variable because it's strange to say that time is going to change based on other things, unless you had a time machine, which would be very cool. So what we're doing is this, and we have an equation that looks like cost equals intercept plus slope times X. Our intercept here is going to be our fixed cost or booking fee. So let's say, actually, I'm going to call this a booking fee. That's our fixed cost here, plus our hourly rate times the number of hours. So that's what I'm trying to find. Let's look at our 2 points. I'm going to draw these here. Points, and let's put X, comma, Y. Well, I know 9 hours on a work day gives me a fee of $123.50. I know that on my movie day, only 4 hours, I only pay $66. That means that I have my Y values are in money and my X values are in time. So first, let's find that slope. So slope again is rise over run, or y2 minus y1 over x2 minus x1. Y's over x's. Putting those in, I'm going to start with this one because they're bigger numbers, and I always like to put the bigger numbers first. $123.50 minus $66, 9 minus 4. Putting in the units really ensures that you don't mix things up. If I run this through a calculator, we come up with $11.50. That is our hourly rate. We pay our sitter $11.50. We're going to assume that they get some of that booking fee to bring them up to minimum wage. So let's look again at our costing equation. Cost equals our booking fee, or I'm going to call it this time fixed cost, FC, plus $11.50 times X. So we can plug in any one point and that will help us solve. And we can choose either of these points. I'm going to choose the second point just because it's smaller numbers, and I find that often smaller numbers tend to be a little bit easier to work with, but not always. So our cost is $66, and that equals fixed costs plus $11.50 times 4. When I move this around, and this is something where if this is not easy for you to solve this, that fixed cost is $20, come talk to me. Send me an email, go over some algebra things, and we will get that nicely sorted because this is an important thing to know. Another important thing to do is to check. So I put in the second point, so let's try the first point. So if I put in 9 hours, the cost will be, I've said I had a $20 flat rate. plus 9 hours times $11.50. And when I dump that in, it ends up being $123.50, just what we wanted. And just to check, even though we used it, we can always just check the 4-hour cost. So $20 plus $11.50 times 4 is equal to $66. That's correct. If we got the wrong answer here, then we would know to stop and redo our arithmetic. Okay, let's describe the slope in the words of the problem. We know that the slope is the hourly rate. So I'm going to say 1, slope equals hourly rate. So for every additional hour, we have to pay our sitter an extra $11.50. Notice that I used the following, the actual slope, the word additional hour, and what's going on. We're paying an extra $11.50. We're paying that flat rate plus what we paid before, and every additional hour costs us $11.50 extra. Finally, part C. If I hire a sitter for 6 hours, how much will it cost me? Well, I'm going to write down our cost equation again. Our cost is going to be $20 no matter how much time I use. You have a babysitter come for 5 minutes, it's going to cost you at least $20 plus $11.50 per hour. So if X equals 6 hours, then our cost is going to be $20 plus $11.50 times 6, which equals $89. That's how much we're going to pay our sitter. Hi, today we're going to jump right in to Lecture 6, Break-Even Analysis, by going straight into a problem. Break-Even Analysis is sometimes called CVP. The C stands for cost, the V stands for volume, and the P stands for profit. Break-even is what our calculator uses, and we're going to learn more about that later. So let's jump right in. The Hungry Days Ice Cream Company has fixed costs of $30,000 per month. Each case of ice cream costs $4.50 to make. Write an equation giving total cost as a function of the number of cases of ice cream made. We're going to graph that in the space below. Well, we know from last time that our cost equation is fixed costs plus variable costs times X, where X is the quantity. So in our case, we have $30,000 plus $4.50 for every carton case of ice cream. Let's write that in. So I'm going to scroll a little bit, and by the way, K, little aside, 60K is 60,000. K stands for kilo, which comes from the Greek word for thousand. I use that when I draw legends because I don't like writing all those zeros. My hand gets tired. A computer, besides one that I write on, would be very helpful. I've gone ahead and labeled this because I know what the axes. When you're doing this in the real world, you'll often be using Excel or a graphing program. So I'm going to label it. Every 5 is going to be $10,000 on the y-axis. Costing is always on the y-axis. And I've put $2,500 for every 5 blocks on the x-axis. So let's start with cost. Our intercept is going to be 0. When I have 0 cases of ice cream, our cost is $30,000. So 0, $30,000. Now I'm going to come up with something else. I've chosen 5,000 because that seems to be a nice easy number. Then y, or the cost, equals 30,000 plus 450 times 5,000. And when I run that into a calculator, I get the point 5,000, 52,500. Okay, let's put that on. 5,000 is a nice dark line, and 52,500 seems to be right about here. Now I've got that on my list. On my chart, I go ahead and put in a nice straight line. And I can even label that as my cost equation. Okay, part B. The company sells ice cream for $12 per case. Give an equation for the revenue function and graph the revenue below. Here, price, actually I'm gonna switch this to purple. Why not? Price is $12 per case. Revenue is the same as sales. And that's always going to be defined as price times quantity. Sometimes quantity is done as Q for quantity. We often use X because that's what's used in algebra for unknowns. When I put in what I have for this, I end up with revenue, I'm calling that R, is 12X. If I sell X cases of ice cream, I make 12 times X in price. Scrolling up, I'm going to write this again over here. Let's put this on the exact same chart. The intercept of revenue is easy. If we sell no ice cream, we make no money. Expect 0, 0 to be a point on every revenue graph. Now I'm going to go with something that looks equally easy. If I sell 5,000 cases of ice cream, then I make 12 times 5 is $60,000 in sales. So 5,000, 60, right at the top. Again, all I have to do is put in my ruler, line everything up. The nicer you line this up, the easier it is to really see what's going on. And now we can see where these cross. Okay, let's label our graph. This is the important part: profit, loss, and break even. I'm going to go back to what we talked about in the very first lecture, and pretty sure in the very first video. Profit is revenue or sales minus cost. When profit is greater than 0, we're in a profit situation. When profit is less than 0, let's put that as a $sign, we're in a loss situation. And when profit is exactly 0, this is what we call the break-even point. This is what the purpose of this lecture is. We're always going to be trying to figure out what the break-even point is. The minimum sales to not lose money. It's okay if we make a little bit of money, but if we lose money, we're in a bad situation. We want to be in a positive situation. Okay, so looking at our graph, this time we're just going to eyeball it. I'm going to go ahead and highlight this. I'm even going to put a little line there right at that point, and it looks like it's a nice even point. And we have on the yellow side, over here, our costs are higher than our revenues. So I'm going to write revenue here in purple. When our cost is higher than our revenue, this is a loss situation. When our revenue is higher than our costs over here, this is a profit situation. So if we sell more than somewhere around 4,000, we'll be in a profit. And if we sell less than that, we will be in a loss. Okay, part D. Let's calculate the break-even point. We're going to express it in multiple ways. So looking at our chart earlier, scroll up, we think it's somewhere around 4,000, but now we're going to look at that algebraically. So the break-even point comes when profit equals 0. And since profit is revenue minus costs, that's the exact same as saying that revenue and costs are equal. So we're looking from when those two things are the same. So I'm going to put in our equations. Revenue was 12x and cost was $30,000
plus
450x. Solve this. I'm going to move everything over to the same side. I've got 12x minus $4.50. X equals $30,000, or 12 minus 4.5. I'm factoring out the x. So I end up with 7.5x equals $30,000. So x is 30,000 divided by 7.5, which is the same as 4,000 cases. That's our break even, and that's what it looked like on our chart. So let's write that down. Break even is 4,000 cases. In sales, we would need to sell, well, it's $12 per case. So if we sold $48,000 worth of material, worth of ice cream, we would be at break even. So we need to sell 4,000 cases of ice cream, or we need to bring in $48,000 worth in sales. And at that point, our costs are also going to be $48,000. Let's look at this capacity. We cannot sell 1 million cases of ice cream. We can't because our factory won't work. So we have a capacity. We always have a capacity. So our factory and our staff and all the materials we have can only make 16,000 per month. And there's always a limit. If you think back to the very first day, we talked about Sam and Charlie and their lemonade stand. They can't suddenly sell 200 million liters of lemonade. They are just two kids with a stand. So our factory can only make 16,000 per month. After that, our calculations change because our fixed costs will change. We will need to upgrade our factory. We will need to hire more people. Things are going to change. So what we're going to do is say we need to sell 4,000 of our 16,000 maximum, or 25% of capacity, to break even. This is a good thing to look at. If it turns out we need to sell 90% of capacity, that doesn't give us a lot of room to get to sell more. And we have to sell quite a lot. That's not a great business case. If we only need to sell 5% of capacity, then maybe we're in a good position. We need to know these numbers. Okay, going back to this problem, let's calculate our profit or loss if 4,001 cases are sold. So profit equals revenue minus cost. This time, I'm going to write this with variables before I put in our numbers. Profit is revenue. Revenue is price times quantity, and quantity is X. Cost is going to be fixed costs plus variable cost times X. Moving this around, I end up with price minus variable costs, X. I've moved it around and I factored that out, minus the fixed costs. One thing to make sure of is the minus here in the brackets distributes. I'm going to write that down because it's an easy thing to forget. So price minus variable cost times X minus fixed costs. We've seen this before. In our case, we got to the point where 12 minus 450 x minus 30,000. That number, price minus variable costs, is something that we call the contribution margin. Another way to think of that is the gross profit per item. That's what we were looking at in Chapter 1. Anytime we calculated our margins and markups, we were usually looking at that gross profit per item or markup in dollars. Those all mean the same thing. That happens a lot in business math. We end up with the same idea but expressed differently. In this case, we had 750x minus $30,000. That's the profit equation for Happy Days ice cream. 750 is our profit margin. Okay, where am I going with this? Let's go back to profit or loss if 4,001 cases are sold. So if X equals 4,001, there's an extra zero there. I have profit equals 750 times 4,001 minus $30,000. Putting that into my calculator, I end up with 30,007.50 minus $30,000, which gives me 750. That's the contribution margin. That isn't a coincidence. So I'm going to say the first 4,000 cases pay off the fixed costs. Every additional case contribution, $7.50 to the net profit. And in this case, we are talking about net profit because we're subtracting the fixed costs. That means if we sell X equals 4,002 cases, our profits, net profits, are going to be 2 times $7.50 or $15. Okay, let's calculate the profit or loss if 3,250 cases are sold. I'm going to scroll back up to look at our chart. If we look over here, our break-even point was at 4,000 cases. 4,001 gave us a profit of 750, but anything below 4,000 was a loss situation. We know before we do any arithmetic at all that we're going to end up with a loss. So we know going in, no matter what happens, we're going to lose money. But anyways, we're going to go and work this out. Our profit, we've already said that. Once we've come up with this equation, 750x minus $30,000, we can just plug this in. So 750 times 3,250 minus $30,000 is going to give us negative 5,625. So anytime we have a negative profit, we have a loss of $5,625. Once we have that profit equation, we can use it to solve all sorts of things. Let's say our company wants to make a profit of $75,000. How many cases must they sell? First of all, we know it's going to be more than 4,000 because 4,000 had a profit of 0. So let's just write that in. We know it's more than 4,000 cases. But what we're going to do is set profit equals revenue minus costs equals 75,000. In our case, we know what profit is. Profit is that contribution margin times X minus the fixed costs. 750X minus 30,000 equals 75,000. Moving over the $30,000, it moves from a negative to a positive. We end up with X equals, I'm going to write this whole thing in, 105,000 over $7.50, which is $14,000. Sorry, 14,000 cases. I'm going to say this is possible. Since it is under capacity. If we needed to sell 20,000 cases, I'm going to write down we can't do that. Anything over 16,000 is impossible because our factory only fits 14,000. Finally, we're going to play around with the structure. Hungry Days is considering dropping its prices and would like to make a profit of $82,000 by selling 16,000 cases. What should the new price be? What is the break even in units? So now things are changing. Our price is not $12 anymore. Our price is something different. So we're going to need a new profit equation. Always start with profit equals revenue minus costs. What I'm going to do over here is write down all the things we have. Fixed costs, variable costs, price, quantity, and profit. I'm going to write Q or X, and that's because we're going to talk about how the BA2 Plus calculator does this later. Our fixed costs didn't change. Our variable costs, well, those also didn't change. Our price is what we don't know. X, well, we want to sell 16,000 cases. So I'm going to put that in as 16,000. If we sell our full capacity, our profit will be $82,000. Once I have 4 out of these 5 items, I can just solve for the rest using the profit equation. So my profit is $82,000 equals revenue. Well, revenue is going to be price times X, and X is 16,000 minus the costs. Well, that's going to be $4.50 times 16,000 minus, because I don't actually, let's put brackets in here, then that's going to be plus $30,000, our fixed costs. Once I put this together, what we're going to do is clean up this equation. Moving the sides over, I'm going to say 16,000 times price minus what goes in this whole bracket. Dump that into a calculator and it's 102,000. That equals 82,000. So now I have price equals 82,000 plus 102,000 over 16,000. Putting that into a calculator, that is going to equal 184,000 over 16,000, which is $11.50. So our new price is $11.50. To find the break even in units, all we have to do is the break even equation. So break even is just revenue is the same as costs. Our revenue is now $11.50 times X, but our costs remains the same at $30,000 plus $4.50 times X, giving us $11.50 minus $4.50 as our contribution margin equals $30,000. That is going to end up with $11.50 minus $4.50 is a contribution margin of $7. So we have X equals $30,000 divided by $7,000. Again, noting those dollar signs disappear, and we get $4,285.71428. Let's stop and look at that number. Can we sell 0.714 of a case of ice cream? Not really. We're not selling carton by carton. We're selling an entire case to our distributor. So we have a key here. Always round up. Never round down. If we round down, we end up with a tiny loss. That is not okay. Losing 5 cents is a loss. A tiny profit is okay. So we would prefer to end up by 5 cents than down by 5 cents. So we're always going to round up and say we need to sell 4,286 cases of ice cream. Let's do one last question. Question 2. Rain City Umbrellas does a thriving business in selling umbrellas. Each month, they spend $1,057 on rent for their prime umbrella kiosk and $2,000 on a salary for their salesperson. Just highlight those numbers. They also buy umbrellas wholesale for $7.50 per umbrella. We've got a different color. And then they sell each umbrella for $26 to wet tourists. Find their break-even point in sales. So let's start by writing out all the elements of our formula. We've got our fixed costs, our variable costs, our price. So fixed costs here is going to be, there's actually two things we're going to add together. Both rent and salaries gives us $3,057. Our variable cost is going to be $7.50 per umbrella. That's how much it costs. And our price is going to be $26. Those are the variables we have. Our revenue is then $26 per umbrella. X is the number of umbrellas. Our cost is going to be that $3,057 plus an extra $7.50 for every umbrella we make. To find the break even, we set profit equals 0, or we just do revenue equals costs. Those are equivalent. So let's do revenue equals costs. We have 26x equals 3,057 plus 750x. We move things over. $26 minus 750, x equals 3,057. That's the same as x equals 3,057 over 1,850. And just to write down, 1,850 is our contribution margin, or our gross profit per item. That's nice to know. It's pretty healthy profit margins in umbrellas. Solving this, we end up with x equals 165.24. We know we can't sell a quarter of an umbrella, so let's look. If we sell 165 umbrellas, then our profit is going to be, well, that would end up being negative $4.50. And that's by putting in just our revenue minus costs. So I'm writing in the equation, put an extra minus there, 3,057. If we sell 166 umbrellas, our profit ends up being exactly $14. Here we have something going on. This is a loss. Losses are not good. If we sold 166, that would be a small profit, and that's okay. So we need to sell 166 umbrellas, not 165, or because the question asked for sales, we need to make $26 times 166, which is the same as $4,300 or $4,316 in sales. Hi, welcome to Lesson 7, Simple Interest. Today we're going to start talking about time value money, how money changes over time. And the key here is time value money. I'm going to write that down because this is going to come up again and again, and that's the shortcut on our calculator. This works via interest. Interest is money that you earn on investments. In that case, high rates are best. Or interest is the money that we pay on loans. In that case, low rates are best. In which case, every problem we have, we're going to have to decide, am I borrowing money or am I investing money? And that's how we're going to pick the basic, which one is better. So let's look at the two basic types of interest. And those are simple and compound. They're used for different things. Simple is what we're going to do today. And in our next lesson, we're going to talk about compound interest, which is used more often. However, starting with simple, we're going to come to a basic equation, and everything we do is going to stem from this. And that is going to be I equals PRT, where I is the interest earned, P is the principal, whatever we invest or borrow, and R is the interest rate. I'm going to put annual there because that's important. We're going to see this. And T is time in years. To illustrate what I really mean by time value money, I'm going to give you a choice. Would you rather have $100 today? Or would you prefer to have $100 next year? Same amount of money, different time. Well, I don't know about you, but I would prefer to have money today. That's basically what we're doing. We're trying to figure out today versus next year, but let's change this now. What would you prefer? $100 today or $200 next year? This is a harder question. Me personally, I'm okay with waiting till next year, but you might need the money now. That's what's going to do. How much does something have to be worth in the future to make it equally valuable? So for the rest of the course, we're going to be dealing with this question. What's better, money now or money later? If we have less now and more later, when are those things going to be the same or equivalent to us? We're going to jump right into a problem. Question 1. You deposit $1,000 into a bank that pays 10% simple. How much interest would you earn if you left the money in for 2 years? For this whole question, we're going to be using the equation I equals PRT. Our P, or principal, is $1,000. That's how much money we're investing today. Our R, sorry about that, is going to be 10% simple, which is the same as 0.10. And our T is going to vary. So part A, 2 years, and since T is measured in years, T is going to be 2. In this case, I'm going to set this up. I equals P RT is $1,000 times 10% times 2. And when I put that in, we have made $200 in interest. Let's write that down. We have $200 in interest. We have a future value. This is something we're going to be talking about a lot, of FV equals, well, we have the $1,000 we had, and then we add $200, which means now we've got $1,200. Okay, let's go on to part B. What if T is 6 months? In this case, what we're going to do is translate T into years. And we can do this by using our conversions from chapter 1. There are 12 months in a year. So 6 months times a year divided by 12 months equals 6 over 12 years, or 0.5 years. For a lot of these unit conversions in time, it's going to be simple to do it in your head. 6 months is half a year. But for other questions, when we start talking about quarters and days, it'll be easier to do an official unit conversion. So be aware of that. I'm going to cross off those months just so this looks good. So let's look at how much interest we have. I equals P R T. Our principal is still $1,000. Our R is still 0.10, but our time is now 0.5, which means we have made $50 in interest. Let's try that one more time. What if T equals 9 months? In this case, that's the same as 9 over 12 years, or 0.75. You should have I equals $75. One of the important things about simple interest is that we often use things on a daily rate. So we end up counting days a lot. In the review for Chapter 1, there's a video on how to use the date calculator for your BA2+. I encourage you to check that out. So what we're going to do is go from March 3rd to November the 7th. So March 3rd, on our calculator is going to be March, that's the 3rd month, 03, 3rd day, and it doesn't matter what year we choose, so I'm going to choose 20 because that's this year. November 7th, well, that's going to be the 11th month, the 7th day, and again, I'm going to go with 2020. Going over to our calculator, I'm going to go to this date function, which is above 1, and set my first date as 3.0320, enter. Scroll down, my second date is 11.0720, enter. I'm going down to DBD, which was days between days, and I'm going to press compute. That tells me that it's 249 days. So in that case, I have T is 249 days. And in order to change that into years, I'm going to remember that 1 year is 365 days. We're just always going to stick with 365 days for this class. If you're doing something where you need to worry about leap years, you'll be using a computer. So what I'm going to use is 249 divided by 365 years as my t value. And I'm going to leave that as a fraction. So now I have I equals P RT. Again, for this whole question, it's 1,000 times 10% times 249 over 365. Putting that into a calculator, and I'm going to do that. Clearing out of my dates, 1,000 times 0.1 times 249 divided by 365. That is $68.22. Okay, I'm going to make some notes about dates. One of the notes is save all of our digits. The best practice is to just use a fraction in our calculator. That's why we didn't compute what 249 over 365 is. Leap year. Let's write this down. Every 4 years, we have 366 days, and it's even more complicated than that. Every 100 years or so, we skip the leap year, and every $1,000, we skip the skipping. $1,000. It's 1,000 years, guys. Okay, and I'm going to say in this course, we will always use 365 as the base or denominator. Don't worry about 366. For today, for this course, we're just going to ignore leap year, and I'm going to make sure that no calculations take place over leap year. What I would like you to do now is to pause this video and do the next 3 questions. Okay, you should have, for these questions, T equals 261 over 365. T equals 123 over 365, and T equals 328 over 365. That should give you the following interest calculations. $71.50, $33.70, and $89.86. One thing I'm going to note, every time we do something like this, that is not what I was trying to do. Let me try that again. Good enough. Okay. Here, our interest is linear. If we get $100 after 1 year, we get $200 after 2 years and $300 after 3 years. Now that we know how to find the interest, we're going to solve for other variables. First, we're going to start with finding the principal. On December the 1st, your 1-year term deposit comes due and you collect the principal plus $120 in interest. The term deposit paid 6% simple interest. How much money did you deposit? Let's start with our equation. Everything we do starts with this. I equals PRT, a linear equation. Solving for P means moving R and T to the other side. P equals I divided by RT. I is $120. P, well, that's what we're looking for. R, that's going to be 6% or 0.06, and T is 1 year. Putting that together, we end up with P equals 120 divided by 0.06 times 1, or 120 divided by 0.06 is $2,000 even. So we invested $2,000. Let's try that one more time. 18 months ago, you purchased a bond that paid 7.5% simple interest. You cashed in the bond and received the principal plus $337.50 in interest. Find the principal. Again, pause and work this out. Okay. P equals I divided by RT. $337.50 divided by 0.75 times 1.5, putting that all in, $3,000. Now we're going to solve for time. On May 31st, you decided it was time to start a new life in the palm trees. You emptied out your bank account. You received your principal of $1,750 and interest of $437.50. How long had your money been in the bank if the account paid interest at 5% simple? So let's write this down again. I equals PRT. When we solve for T, we end up with I divided by P times R. So let's look at all the things we have. IP equals PRT. Our interest is going to be $437.50. Our principal is $1,750. Our rate is 5% simple. And time, well, that's what we're going to solve for. So now I put this into my equation. T equals I divided by P times R. I'm going to put this into the calculator so you can see how I do that. 437.5 divided by 1750, and I like to press equals and then divide by 0.05. And I end up with 5. And T is always measured in years. Does it matter that it's May 31st? Not really. Let's do this again. Question 5. On your 65th birthday, you eagerly cash in one of your RRSPs, or retirement savings plan. You receive a total of $4,295. Your original investment was $3,000 and your interest was paid at 7% simple. How many months was your money in the RRSP? This is a slightly more complicated problem because we don't have our interest. Instead, we have a future value of $4,295. That is principal plus interest together. Our principal is $3,000. $3,000 plus what equals $4,295? Well, we know that we must have made $1,295 in interest, which is 4,295 minus 3,000. Our interest rate is 7%, and our T is what we're looking for. And we're looking for it in months, which we're going to get to at the end. I'm going to scroll up a little bit and start again with T. By our formula before, T equals P over, I over P times R. I will fix that. So when I put that in, I end up with $1,295 divided by 3,000 times 0.07. Let's look at that on the calculator. 1,295 divided by $3,000 equals. I'm going to divide that by 0.07, and I usually like to do my division in 2 steps like that, and I end up with 6.166667. And remember, this is in years, 6 and a bit years. To get this into months the way we want, well, I'm going to have to remember that 1 year is 12 months. Writing down this formal calculation helps us to make sure that we divide and multiply properly. So I'm going to multiply this times 12. And once I do that, you'll see that it is exactly 74 months. Finally, in time, we're going to look at this question. How long will it take to double your money at 8% simple? Well, I've got, let's start with I equals PRT. I know that R is 8%, and I know that T is what I'm looking for, but I don't know I or P. So my tip is going to be pick any P. Just like we did in chapter 1, when we don't know a number, we can make something up because everything is proportional. I always use $100 when I can. 1,000, 1, all good answer. If I invest $100, then to double it makes I going to be also $100, or future value is $200. 100 plus 100. So if I make $100 in interest, I've doubled it. So I've got T equals I over P times R, or $100 divided by $100 times 0.08. Notice that the $100 is the same on the top on the bottom. No matter what number I chose, it would end up that way. So all I have to do is take 0.08 and say 1 divided by that. There's a handy button for this on the calculator. 12.5 years. Now we're going to solve for R. Same equation, exact same thing, except this time I equals PRT. We're solving for R. When we rearrange this, we get R equals I divided by P times T. On March the 6th, you deposit $3,000 into a bank account. You withdraw the principal and interest totaling $3,123.29 on December the 31st. What interest rate was paid? So what we're going to do is see which things we need to do. Here, we deposited $3,000. That's the principal. Our interest is going to be $123.29, or the future value minus the principal. $3,123.29 minus $3,000. I'm just going to re-highlight that. R, well, that's what we are solving for at this time. And T, I'm going to put this in already, but I would like you guys to take the time, pause if you'd like, and show that you can do in the calculator, finding out that March the 6th to December 31st is 300 days. I'm going to remind you that date 1 is March the 6th, 3rd month, 6th day. Let's pretend it's 2020. Some people like to pretend it's 2000, then you don't have to put anything in at all. And it goes until December 31st. And you're computing days between days. So you can go ahead and do that on your own. Let's put this in. R equals $123.29 divided by 3,000 times 300 over 365. This is a little more tricky to do. I'm going to show you how to do this on the calculator. If you're familiar with algebra, you might want to simplify this expression. But what I'm going to do is start with the bottom. Putting this into the calculator, 300 days divided by 365 equals, I'm going to multiply that by $3,000. That's the denominator. Now what I'm going to do is use that 1 over x button to put it on the bottom, and multiply it by 123.29. That gives me almost exactly 5%. That's a nice even number, forgetting about the round off. One more. On December 16th, 2011, you withdrew your entire Christmas fund of $2,098.63 from your account. You deposited $2,000 on February 19th, 2011. What simple interest was paid? I want you guys to pause. I'm writing that down, and then I will show you the answer. Ready? Here's the answer. We end up with 6%. Make sure that you can count those days and get 300 days. If not, this is a really good thing to talk to me about during lab. Okay, finally, we're ready to solve for the future value. The future value is the principal plus the interest, how much money we have in the future. You've decided to start a new car fund. You deposit $6,000 into an account paying 10% simple. How much money will you have in 50 months? Okay, so let's look at this. Future value is principal plus I. I equals PRT. That means that future value is principal plus principal times RT. What we can do is factor out this P. And we get 1 plus RT. This is a formula that we're going to see a lot of. And if I want to go backwards, because we're going to see this, P equals FV divided by 1 plus RT. These are new equations that we're going to see are sometimes easier to use. In this case, I never need to solve for I. So FB, P, R, T. Future value is what I'm trying to find. The present value is $6,000. R is 10%, and T is 50 months, which is 50 over 12 years. And I'm going to leave that as 50 over 12. So the future value equals the principal times 1 plus 0.1 times 50 over 12. I'm going to put that into the calculator now. Let's pull up our calculator. And I like to work from the inside out. And you can use your brackets to do this any way you want. 50 divided by 12 is this, times 10%, add 1, equals, now I'm going to multiply that by 6,000. And I end up with $8,500. I don't have the interest here. It's easy to tell that the interest is going to be future value minus principal, which is $8,500 minus $6,000 is $2,500. But it's good to know we don't need that intermediate value. Okay, let's do another one like this. On December 31st, you repaid a loan to the Hammerhead Finance and Loan Company. You repaid $6,000, which was principal and interest on a 5-year loan at 10% simple. How much money did you borrow? Well, in this case, I don't know I or P. I need to use this future value. 1. P equals FV divided by 1 plus RT. So let's write that down. P, FV, R, and T. Principal's what I'm trying to find. The future value is $6,000 because that was principal plus interest. The interest rate is 10% and the time was 5 years. Putting that into our equation here, I get P equals $6,000 divided by 1 plus 0.1 times 5. This time I'm going to simplify the denominator. I think that ends up being easier to put into a calculator. Well, 0.1 times 5 is 0.5, so I end up with 6,000 divided by 1.5. Well, that is exactly $4,000. So that's how much we borrowed. I'm going to do a little calculator note here. 1 plus 0.10 times 5, with our brackets the way they should be. Multiplication before addition is 1 plus 0.5 is 1.5. If I do this wrong, 1 plus 0.1, addition first, and then multiply it by 5, that's chain mode. I end up with 1.1 times 5, which is 5.5. This is wrong. This is not the way we should be doing things. So pay attention to the algebra and how you put things in the calculator. It's okay to use extra steps. Hi, and welcome to Lesson 8, Compound Interest. Let's start by remembering simple interest. When we talk about simple interest, we are only, I'm going to erase. We only earn interest on the principal. So only on the principal do we earn interest. With compound interest, it's different. What's happening with compound interest is every time we get interest, we add that back to the principal and we earn interest on it. Let's look at what these look like as a graph. Okay, simple interest looks like a line. So I'm just going to do this. There we go. So this is simple interest. And what we're looking at here is the future value. And over here, we've got time. The more time we spend, the more money we get. Compound interest is a little bit different. Instead of being a straight line, it's going to end up looking like an exponential curve. I have to draw it in this way. There we go. Exponential versus linear. Exponential grows really, really fast over the long term, while simple interest, a linear curve, stays the same. That's the difference between it. So what we're going to do is look at a very simple example. So let's invest $1,000 at 25% simple. One note, you're going to see throughout these lectures and throughout this entire course, I often use really big interest rates. No bank out there is paying 25% simple, but big interest rates make the math and the arithmetic easier to see, and that's why we use it, not because there's an investment that actually gets 25% simple. So let's do that for a year. In that case, our future value is going to be principal times 1 plus RT. Our principal was $1,000. 1 plus 0.25 times 1. Once I dump that into a calculator, I get $1,250. Okay, let's reinvest. So we're going to take that money and we're going to put it in for another year. Now our future value is going to be 1,250 times 1.25. That's the same as up here, and that gives me $1,562.50. Okay, what about simple for 2 years? So if I just did this for 2 years, instead of taking that money out and then reinvesting, I would end up with $1,000, 1 plus 0.25 times 2 is $1,500. So in this case, I've got 62 extra dollars. We have an extra $62 because we took the money out and reinvested. And otherwise, we got interest on the interest. And our interest, to remember, after the first year was $250. So if I look at that, $250 times 0.25 and times 1, that ends up being $62.50. So what I've ended up with is exactly the interest on the interest. Scrolling down, that leads us to a formula. So after many years, when I'm compounding this way, every year I'm taking it out and I'm reinvesting. After 1 year, I have 1,000 times 1.25, 2 years, 3 years. Well, let's multiply it by 1.25 again. And I do that a bunch of times. So after n years, where n is a big number, or any number, future value equals 1,000, 1.25 to the power of n. I'm multiplying this together n times. That's an exponent. So now I have an exponential equation. Let's look more about how often we compound. How often did we compound? In that example, we compounded annually. And that means once a year. So something like a GIC will be annual interest. Semi-annually, that means twice a year. That is going to be what we're going to see later on in the course is mortgages in Canada are compounded semi-annually. Quarterly. Quarterly is something that you haven't probably seen a lot, but what is used a lot in business. That means 4 times per year or every 3 months, which is confusing. 3 months in a quarter because 3 times 4 equals 12 months in a year. Quarterly is how businesses file their reports and do their financial statements. Monthly. This is probably what you've seen the most, and I'm just going to write that 12 times per year. And this is something like your credit card or your bank account. This is one of the most common. Monthly, and then we have weekly. This isn't really used very much, but it's nice to know. I'm actually going to put bi-weekly because we're going to see that in mortgages. And that's 26 times per year or every 2 weeks. And a lot of you, if you are working, will be paid bi-weekly or every 2 weeks, in which case you need to know that. I'm going to add in daily. That's every day. Some bank accounts work that way, etc. I could compound 1,000 times a year. We don't do that very often, but it's possible. Okay. We compound, and compounding means to compute interest, add it to the principal. Okay, so we compute it and we add it to the principal. How many times per year? I'm going to come up with m times per year. I'm also going to write this. Actually, I'm not going to say P. Let's say CY on the calculator. And we're going to see this later on, but the calculator uses that. I'm going to write in some m's. I'm going to scroll up here. And I'm going to write m equals 1, m equals 2, m equals 4 for quarterlies, m equals 12 for monthly, m equals 52, m equals 26 bi-weekly, and m equals 365 because I'm ignoring leap year. That's probably all the ones you will see. Okay, let's do some terminology. Nominal. That's the English word for in name only. And we call that J with a little m subscript. And I'm just going to write in name only because we don't use it to compute. So let's look at an example of nominal. So my bank pays a very large J12, a nominal rate of 24%. That means it's a monthly rate. So the interest is paid into my bank account once per month. This actually means how much per month? %. 24 over 12 is 2% per month. So nominal is not what we're going to use in our computations. 24 isn't going to go into our math, 2 is. And this is called the periodic rate. I'm going to rewrite that that's 0.02. And that's called the periodic rate. And that's the rate per period over that time. This is a formula. It's fairly easy to remember, but when in doubt, look something up. So nominal is JM, then the periodic is I, and we call it I, equals JM divided by M. So if our nominal was J12 equals 24%, then I equals 24% over 12 equals 2%. I think we have most everything we need now to be able to share the formula for compound interest. And this is the important one. You'll probably end up memorizing it, but you can always look at it on tests. And this is going to be FV equals PV 1 plus I to the power of N. Explain what these things mean. FV, we've seen that. That's called future value. When we talk about compound interest, we use PV to be the opposite of future value is present value, what we have now, and that's the same as P for principal. They're the same thing. I is the periodic rate. So that would be JM over M, if we had that, and N is the number of periods. So the number of months or weeks, depending on how we're compounding it. Okay, let's start with question number 1. We're going to invest $100 for 1 year with a nominal rate of 24%. And now we're going to look at a whole bunch of different kinds of compounding. So starting with M. M is how many times per year we compound. For annually, this is 1. For semi-annually, this is 2. What I would like you to do is keep on pausing this video and fill things out. So fill out quarterly and monthly now. Okay, hopefully you paused and came up with 4 quarters per year or 12 months per year. Now I'm going to write in the nominal rate. Annual means J1 equals 24%. Semi-annual, J2 equals 24%. Pause. Hopefully you have written in J4 equals 24% and J12 equals 24%. For the periodic rate, what we do is we divide it. So remember, I'm going to write up here, I equals JM over M. So if M is 1, we're just dividing by 1. That makes this really easy. Semi-annual, we're going to divide it by 2. So 24 divided by 2 is 12%. You guys try it. Pause. Hopefully, you have I equals 6%. That's 24 over 4. And I equals 2, or 24 divided by 12. How many periods are in a year? Well, how many years are in a year? That's actually fairly easy. 1. How many years, how many half years are in a year? That's going to be 2. How many quarters in a year? 4 quarters in a year and 12 months in a year. So now we're going to do our future value computations. I'm going to write over here. FV is 100, 1 plus 0.24 to the power of 1, because it's 1 year. That gives me $124. For semi-annual, well, I take that $100 and it's 1 plus I. That's 1.12, but it's happening twice. When I compound it twice, I get $125.44. Your turn. Well, hopefully you paused it and came up with FB is 100, 1.06 to the power of 4, which is $126.25. And finally, $126.82, which is the same as 100, 1.02 to the power of 12. Look at these. One thing you should notice is that the future value is increasing. The more you compound, the bigger it gets. If you want to know the limit, the absolute biggest it can be, we'll talk about that a little bit later, but you can use your calculator to compute that fairly nicely. So, the more we compound, the more money we get up till a certain point. Compounding makes a huge difference. In our equation over here, we use I, not that nominal rate. We only use the 24% when we're talking about annual. Okay, let's start with question 2. You have $5,000 and you deposit the money in a mutual fund that has an average return of 9% compounded annually. How much will you have when you retire in 25 years? Okay, so let's look at all the elements of our equation. I'm going to rewrite the compound interest equation. Future value equals present value 1 plus I to the power of n. Future value is the thing we're trying to find. Present value here, that's $5,000. Average return of 9%. That's going to be 1 because it says annual. That annual means it's J1 equals 9% or 0.09. That means that I is going to be 9% divided by 1, which is just 0.09. That's the good thing about annual and why people use them. Let's change colors so we can see it a little better. N is going to be 25 years. Here, N is counting years because it's the same as annual. Those things go together. If it was a monthly, we would talk about months. So our future value, actually, let's write this at the bottom. We end up with future value equals 5,000, 1 plus 9%, which is 1.09 to the power of 25. I'm just going to show this on the calculator because sometimes it can get difficult. 5,000 times 1.09 to the power of, that's this y to the power of x, and then I write 25. And I should get 43,000. It's a big number. If you're getting the wrong answer, and I'd like you to try this, it's a good chance that your settings are wrong. So go back to week 0, look at the video on how to do your settings, and make sure that it's on AOS mode, not CHN. Just to check, what if I had done simple interest? I would have started with $5,000, and I would have added 1 plus 9% times 25 years. Dumping that into a calculator, I would have had $16,250. What would you prefer, 43,000 or 16,000? This is definitely better. To practice this, I'm going to give you a nice little bonus. Redo with your age, so that's 65 or whatever retirement date you want, minus your age. And I'm going to say, let's use J1 equals 6%. That's a more conservative estimate of how you can do in the market over the long term. Okay, let's do another one. You deposit $10,000 at J4 equals 12% for 54 months. How much money will you have? Let's go back to finding all of our items. Our present value, what we start with is $10,000. J4, that's a quarterly nominal rate, is 12%, or 0.12. That means that I equals 0.12 divided by 4, or 3%. That's what we're going to use in our calculation. N. N is 54 months. But we don't want it to be monthly. We want it to be quarterly. So we're going to use a unit conversion, just like we did in Chapter 1, to change it from months into quarters. And I'm going to do this the long way. Once you're more comfortable with it, you can do this quickly. You can sometimes do it in your head. But I'm going to go very slowly. I'm going to note that 1 year is equal to 12 months. Now I cross off my months. I'm also going to note that 1 year, and I put that on the bottom, right? Because I want to cancel things off, is equal to 4 quarters. So what I have here is 54 times 4 divided by 12 quarters, or 18 quarters. I'm going to write this one more time. You might look at me and say, hey, but you already told me that there are 3 months in a quarter. That's right. 54 divided by 3 is 18 quarters. Either way, one of the strange things is that quarters seem to be hard. It's hard to remember it's 3 months. Your brain thinks quarter 4, it should be 4 months. That's incorrect. Okay, back to our equation. Future value is present value 1 plus I to the power of n. Present value is $10,000. I was 3%. N is 18 quarters, and that gives us $17,024.33. That's how much money I have. How much interest did I make? We can use the same thing we did before. Interest is the difference between how much money we have and how much money we started with. In other words, I have $17,000 and some change. I started with $10,000. So now I must have made $7,024.33 in interest. Question 4. You would like to save $20,000 so you can take a year off in 42 months. How much should you deposit today if money earns 4% compounded semi-annually? Okay, let's note that we have the same formula we start every single example with. This time, we're trying to solve for present value, not future value. So I'm going to divide both sides by 1 plus I to the n and come up with this formula. present value equals future value over 1 plus I to the n. That's important. It's a formula that you are going to see many times. We'll go put a box around it. Let's look at what we have in this problem. We're trying to find a future value of $20,000. We have a semi-annual interest rate of 4%, which means that I is going to be 0.04 over 2, or 2%. N is 42 months, and I want to get that into half years. Most people can remember quite easily that 1 half year is exactly 6 months. So in the end, we end up with 7 half years. Going back to this equation, our present value equation, PV equals $20,000 divided by 1.02 to the power of 7. Put that in. I'm going to go with 1.02 to the power of 7. Solve for that and use that 1 over x button. Multiply it by $20,000. And I end up with $17,411.20. One more question. How much money do you need to invest to earn $1,000 in interest in 18 months if the interest rate is 8% compounded quarterly? This is going to be a weird one because we don't know the present value or the future value. Instead, all we know is the difference between those things is $1,000. That's why this is a tricky question. Quarterly, N is 18 months. And I'm going to go ahead and say that's 6 quarters. But if you need some help getting from months to quarters, go back and watch the other videos and do a proper unit conversion. I'm going to use a few of these equations. Future value equals present value plus interest. And present value equals future value over 1 plus I to the n. Putting those together, I end up with present value equals future value. Still don't know what that is. What was my interest rate? 8%. Well, let's just remember that it's 8% quarterly, so it's 2% as our periodic rate, and this is going in for 6 quarters. Okay. Put this together, and I know what FB is. So what I'm going to do is substitute this into that. I'm going to write that again. PV equals PV plus I, and I is $1,000, divided by 1.02 to the 6th. This looks confusing, but we can solve this with algebra. With algebra, I know I'm going to multiply both sides by 1.02 to the 6th, and I could work out what that is, but I've decided to leave it for the moment. And I get 1.02 to the power of 6 times present value equals present value plus 1,000. Well, that's easier for me to handle. Moving this around, I end up with 1.02 to the power of 6 minus 1 times the present value equals $1,000. Well, divide both sides. And then dump that into a calculator. And we get 7,926.29. I'm just going to show you over here on the calculator. I'm going to go with 1.02 to the power of 6 minus 1 equals a big thing. I'm going to store that. Store 1, clear. And you can notice when I press recall 1, there it is. So now I'm going to say 1,000. That is 10,000. Let's do 1. I hope you were having better luck with your real calculators as opposed to this silly emulator. Recall 1, And we get the same thing I have over there. BA2 plus calculator time. It's time to learn about TVM, time value money, and you'll see that on your calculator. And if you look at the instruction manual that came with it, you'll see all the things that I'm doing. We're going to illustrate this with an example as usual, and you're going to see this chart written again and again and again, typed out, handwritten all over the place. I'm going to be writing the same thing every single time. So Maclean's magazine estimates that it will cost $130,000 for a 4-year university education when children born this year reach university in 18 years. You have $10,000 to invest today. What annual rate is required to reach $130,000? I'm going to write this in as an equation. We know our present value, future value equation is future value is present value 1 plus I to the power of n. The future value I want here is $130,000. That equals present value. Sorry, we know what that present value is. It's $10,000. 1 plus I, and I don't know what I is, to the power of 18. That's a difficult equation because I'm going to have to take an 18th root, which I can do with a calculator. However, it's easier to use the TVM functions on your calculator, and that is this line over here, NIY, PV, PMT, FV. And I'm going to see NIY, PV, PMT, FV. I'm going to enter it in the order that I like to put it in the calculator. N is the number of periods. NIY, PY, CY, talk about that in a second, PV, PMT, FV. N is 18. So what I'm going to do is write this underneath, 18. IY, that's what I'm going to try to find. CPT, if you remember, means compute. PYCY, that just means M. So M here is how many times per year, and I'm looking for an annual rate. That means that my PYCY is Y is 1. I'm going to show you how to enter that in a second. Present value, I started with $10,000. Payment, we're going to talk about this later on in Chapter 5. We'll talk about annuities, and then I'm going to explain what it is. The important thing is to put 0 in. For future value, I'm going to put in $130,000. To make it balance correctly and not get an error, one of present value and future value needs to be negative. I'm just going to make that negative, and we're going to talk about that a little bit more later. Let's put this in to the calculator. The way you do this is you type 18 first, then you press N. IY will leave. PYCY, that's above the interest rate. So I go second, interest rate, and it says PY equals 1. 1, enter. If you want, you can scroll down and see that PY and CY are both there. We'll explain the difference later, but they're both 1. Present value is $10,000. Let's go enter. Not enter, sorry, present value. Payment is 0, so I press 0 payment, and I'm trying to get $130,000, and again, I said I had to make that negative. So now I say compute IY, and I come up with IY, which is the nominal rate, is 15.31498%. Let's see what happens if I put 130,000 positive into my future value. Now when I compute IY, I get an error. So you know that you made a mistake. If I want to check out what's in there, I press recall and then the number. Now I can say, oh, I wanted that to be negative, and now it is in correctly. Okay, part B. How much do you need to invest if you can only expect a rate of return of J2 equals 12%? So I'm going to write everything again. Well, and I'm going to fill in the things I know from before. How much do I need to invest? That means I'm computing the present value, and my future value still needs to be that $130,000. Payment is 0 for this chapter. PYCY, however, is now 2 to show that it's a semi-annual rate. IY, this is important. We put the nominal in there. We're putting our nominal rate in for IY because the calculator knows to divide it by 2 to come up with 0.06. We also put this in percent, not in decimal, so it's 12 and not 0.12. N, well, it's going to be 18 years times twice a year. That's 36. Important to note. So let's put those things in. I type 36N, 12 IY. I go second IY, and now I make 2, enter. Scroll down a couple times and it's 2. I'm pressing clear a few times to get rid of that. Now, PV, I'm going to leave that alone. Payment, still 0. Future value, I'm going to say recall future value. It's the same, so I don't need to re-enter it if you're doing the same problem. Clearing everything, I go compute present value, and I come up with 15,956.30. And I could have done this with a formula pretty simply. That would have been FV over 1.06, because that's I, to the power of 36. You can confirm that that is the same thing, but the calculator is easier and faster. Final part. You deposit $12,000 and invest in bonds that pay 6% compounded semi-annually. How old will your child be when they can start university? What we're trying to do here is solve for N. So let's write down all of the items that we're looking for. PY, CY, present value, payment, future value. I like to change colors, but truly it doesn't matter. Note that I'm computing N. 6% computed semi-annually. Present value is now $12,000. Payment is still 0, and my future value remains $130,000. So let's put that in. 6 IY. Second PYCY is the same because I haven't changed it. $12,000 is now what I started with. And I'll press recall. Future value is still negative 130. Let's compute N. Well, it says N equals 80.606, and that's in half years. So to get that back into years, I'm going to have to divide by 2. That is about 40.3 years. So not really ideal. Let's play around a little bit. I'm going to go back to my future value, $130,000, and make it positive instead of negative. Now let's compute N. Error 5. Good thing to know your errors. When you get an error 5, it's probably a sign error. You can also get an error 2, and you might end up with a negative N. We'll see that later on. If you get a negative N, you also made a mistake, and you know to fix your mistake. I'm just going to note what the formula for this is. If I was trying to solve this, it would be 12,000, 1.03 to the power of N equals $130,000. To solve this, I'm going to need to use logarithms. So if you remember your logarithms really well, go ahead and do that. I'm going to stick with using my BA2 Plus calculator. Today we're going to talk about equivalent, effective, and average rates. First, I'm going to define one term because we're going to see this a lot. Effective rate just means an annual rate. And we already know that means that it is J with an underscore of 1 or compounded annually. So when we use that word, that's all we mean is an annual rate. Compounded, sorry, let's put it once a year. Equivalent rate is our other term. And equivalent really means that things are the same. And I'm going to put that in quotes. Mathematically equivalent, and we often use some curly brackets to mean equivalent, that means things that are the same in the way that we care about. Sometimes you will see as well, because the curly can be approximate, 3 lines instead of 2. But it means the same in the way we care about. In terms of interest rates, the thing we care about the most is how much money we get out of them. We don't care how often the bank compounds. We care that they give the same future value. Let's say we put $100 in each one, and after a year, we have the same future value. That means they're equivalent, because as long as we care, as far as we are concerned, we don't care how often the bank is doing accounting, we care that we get the same amount of money. And we usually measure after a year because that means that whether it's monthly, biweekly, daily, we're going to get the same result. Let's jump right into a problem. The humongous bank believes in offering its customers choices. A banker offers you two different options for your investments. The premium growth account offers interest at J2 equals 10%. I'm just going to write that here so we can see better. And the accelerator is an effective rate of 10.25. What should we choose? Well, what we're going to do is invest $100 in each, just like we said before. And you could put any amount here. I just find 100 really useful, and we're going to see that. Most of the reason is because 100 makes the math easy. So in each account. So let's start. I'm going to scroll down a little to J2 equals 10%. That's the premium. Spell premium correctly. Okay, so after 1 year, we have a future value of $100 times 1.05, because 5 is half of 10%, to the power of 2, because there's 2 half years in a year, which means at the end of the day, I have $110.25. Now let's look at the next one. So that's going to be J1 equals 10.25%, and that is called the accelerator. So at the end of 1 year, we have $100. And here, because it's only compounded once a year, we don't have to divide that J to get an I. And we put that to the power of 1, which means at the end, we have $110.25. So which one is better? Well, it makes no difference whatsoever. They're the same, or they are equivalent. So I'm going to write that in a few different ways. J2 equals 10% is equivalent to J1 equals 10.25%. J2 equals 10% is effectively, you'll see this given a lot. Effectively means the same as, but here we're meaning it as equivalent to the effective rate of 10.25%. When we put the word effective in, we don't need to put that 1 in because it is assumed. You're also going to see the term APR, or annual percent return. We're not going to use that overly in this course, but know that that means the same thing. And either way, we are going to get 10.25% interest per year. Okay, let's talk about converting rates with your BA2 Plus calculator. This is going to be the easiest way to do converting between equivalent rates because it's already given in our calculator. To do this, we're going to use the ICONV, or interest conversion worksheet. You get to that by pressing second and finding interest conversion, which lives over the number 2. And that stands for interest conversion. So I go second, then I type in interest conversion. And we've got 3 things in here. And at this point, you should be getting used to entering things in your BA2 Plus calculator. Enter things, compute one thing. And there's 3 things here. So if you see NOM, I'm going to scroll down, EFF, that stands for effective, scroll down one more time, and we get CY. And that stands for the nominal rate. So that's J N, whatever it is. The effective rate, I'm going to write that in. The effective rate is J1 and CY is N, whatever the subscript is. So let's convert from 10.25. Sorry, let's do J2 equals 10%. In that case, to convert it, what I'm going to do is CY, let's go back to nominal. It's 10, enter. Scroll down. EFF, I'm going to scroll down again because I don't care about that. CY, so let's put nom equals 10. CY equals 2, and then we type in enter. And now we scroll back up to nominal, effective, and press compute, 10.25. And that's what we had. Everything here goes through effective. So I'm going to go on a long-winded metaphor. Let's pretend we have our train system. The train system is based in Vancouver. If you want to get to Nanaimo, you have to stop in Vancouver. If you want to get to Prince George, you're routing through Vancouver. This is something in the north. And then we have Kelowna. So these are 4 cities in British Columbia, and everything is going to pass through that middle one. That's the effective rate, J1. So if I want to go from J2, that was 10%, and I want to go to, let's say, a monthly rate, over here, I have to convert into effective, and then I have to convert to monthly. Let's say I want to go from a quarterly rate to a monthly rate. I'm going to have to convert from quarterly to effective, and then over to monthly. So we're always going back and forth, but we're always routing through that middle. To practice, we're going to convert a whole bunch of these things just using the calculator. I'm not going to do everything on camera because that's incredibly boring in my opinion. So I'm going to let you fill in some of it. But let's start with J1 equals 12. So what I'm going to do, that's an effective rate, remember? So I'm going to set EFF equals 12, and I want to convert that to semi-annual. So that means that CY is 2, and now I go down to nominal and I press compute, and I get 11.66%. And that's a J2. Let's do it again for quarterly. We go up to CY, we change to 4, and now we recompute the nominal, and we get J4 equals 11.49, etc. %. Now let's do one more, monthly. I change that to 12. I change nominal by using my compute button, and I get J12 equals 11.3865. I'm just going to put some ... so I don't have to round. Fairly simple. So now let's do J2 equals 8%. So I'm going to go back up, and I don't have to clear this, but I want to. So what I'm going to do is press second, clear, and that sets everything back to the base. You don't need to do it because you can overwrite, but it's useful. So this time I'm going to start with a nominal, and that's 8. I start with a nominal rate of 8%, and I change my CY to be 2 because it's semi-annual. Now I go to the effective, and that's what I'm computing. J1 is 8.16%. Now that I have the effective rate, I can find the quarterly and monthly. So to find quarterly, I set that to be 4, and my nominal is now 7.92. One more. CY is 12. Nominal is 7.86. Just going to put some ... One thing to notice, our rates are changing in size. This is a smaller number. Because we're compounding more often, which we know gets us more interest, a smaller interest rate gets us the same amount of number as the bigger. So in this case, these two numbers are going to be bigger than 10%, and this number is going to be smaller than 10%. I'd like you guys to pause the video and continue to fill out the table. I'm going to unpause and everything will be magically filled in. See? Like magic, it's all nicely filled in. So make sure that you get the same answers as me. Mortgages charge interest on a semi-annual basis, but payments are usually made monthly. Change a mortgage rate of J2 equals 7% to a rate compounded monthly. We're going to come back to this again when we start talking about mortgages. This is one of the big differences between banking in Canada and banking in the United States. Canadian banks compound mortgages semi-annually. They don't really though. They actually advertise semi-annual rates, but compound usually using an equivalent rate every time you make a payment. That's as opposed to American banks that report with monthly rates. That's how they advertise. This wasn't always true. Once upon a time, before computers were widespread, it was actually compounded every 6 months. So every payment you made before 6 months, no interest was accruing. They all went towards principal, which was a different type of mortgage, and you would end up paying for a different amount of time and paying less interest. Things are different now that computers make this very simple. So if you pay monthly, they use an equivalent monthly rate. If you pay bi-weekly, and we're going to come to this again more when we get to mortgages, but bi-weekly is the way a lot of people are paid, and that means you're paid 26 times a year. Then they're going to use the equivalent J26. Often people do this because it works out with your payment scheme if you are paid that way. Okay, so what we're going to do is find the monthly rate. And again, we did this in the last one. J2 goes to J1, goes to J12. We're always going through that effective rate. So let's start with J2 equals 7%. And I'm going to use the calculator. So we go to second, interest conversion. Our nominal rate is 7. My effective rate is what I'm looking for. Right now I have 2. Go back to the effective rate and it's 7.1225. I'm not getting rid of any of those decimal places for now. Now I'm going to change CY to 12 and compute the nominal rate, which is around 6.9. There we go. Okay, but let's do it a different way. And I'm going to say this is a check because I started at the beginning and said, if I start with $100, how much do I have at the end? So I'm going to start with $100 and I'm going to invest it at 7%. Dividing 7 and 2 gives me 3.5. So I do that and I end up with $107.12. Let's do that with the effective rate in the middle here. 100, 1.071125 to the 1 is, when I round it, 107.12. Same thing. And finally, let's do the last one. I start with $100, 1 point. I'm going to put that entire thing in here. Over 12, I'm going to say 1 plus that to the power of 12. Okay, I'm going to use the calculator for this because I don't want to round it at all. So I'm going to clear, and clearing lets me save that number. I'm going to divide it by 100 first to make it a percent. Then I'm going to divide it by 12. Now I'm going to add that to 1. Now I'm going to take that to the power of 12 and multiply it by $100. And I get the same thing, $107.12, or 12.25. They're all the same. Not only are they all the same, when I did the rounding there, notice that I had these. This is 7.1225. The amount of interest I get is the effective rate. The effective rate is exactly the interest you get on $100. If you don't want to divide by 100, do it on $1. That will give you 7.1225 cents. But it's easy enough to see it in percent. Let's do one more. Your credit card charges interest at 1.5% per month. Find the effective rate. Credit cards. One thing to remember is unless you're told differently, all credit cards are monthly. This is a piece of what we call domain knowledge. It's knowledge that you really should have. A question will not necessarily tell you that credit cards are monthly, so that's something you need to know. Let's find the effective rate. So first,
I can learn
per. That means periodic rate. Anytime you see that word per month, you know that that's the periodic rate, at or per. So that's the periodic rate. So I equals 0.015. That means that J12 equals 0.015 times 12, or 18%. That's a lot. That's more than 1.5. It looks small when you say it monthly, but you do have to end up multiplying that. So let's see how much we have after 1 year. And this is the same thing that we've been doing. We start with $100 and we put it at, well, we know that it's 0.15 to the power of 12. So 100 times 1.015 to the power of 12. And that is going to give me $119.56. So the effective rate, or J1, it's 19.56%. And you can check this using the interest conversion worksheet. In part 2 of this lesson, we're going to talk about average rates. The big idea on this unit is that our interest rates are not stable. They change over time. And this is what happens when you invest in something like the stock market or in mutual funds. The rate is not fixed for a 10-year investment. It's going up and down with the market. Let's say not over time, but over the course of our investment. In this case, I don't really care what it's doing every single month. I care what it's doing on average. And just so you know, there's lots of types of averages. When I talk about an average rate of return, I'm definitely not talking about taking all the numbers, adding them and dividing by the number of rates or the arithmetic mean. When you take statistics, you'll learn more about that. But here, what I care about is how much I get on average. So if I invested at that average rate, I want the same present value giving the same future value, or they are equivalent. So we're looking here at equivalent rates. As usual, the best way to learn a concept is to actually go through an example. So let's start with example number 5 from the lesson. Premium savings bonds have the following rates, all annual. In the first year, you make 2%. In the second year, you make 5%. In the third year, 12%. In the fourth year, 15%. And by year 5, you're making 24% per year. And I'm just going to do an aside. These are exaggerated rates so that we can do the arithmetic easily, not because I know of an investment that pays 24%. So the first thing we're going to do is figure out how much a $1,000 investment would be worth at the end of the 5th year. And we can do this with $1,000, $100, anything, but the question says 1,000. So after 1 year, well, we start with 1,000, and after 1 year, we say 1.02 to the power of 1. That's how much money we have after the first year. Let's see how much that is. 1,000 times 1.02. So I've made $20 in interest. Okay, now let's look at that second year. In the second year, we make 5% interest. So I take everything I did before, I'm going to put brackets around it, though that isn't necessary, and I'm going to multiply that by 1.05 to the power of 1. So now I have 1530. I think I did that wrong, so I'm going to stop following along with the calculator right now. And now I'm going to say 1.12 to the power of 1. So this is the second, third, fourth year, 1.15. Finally, 1.24. So let's do the entire thing with the calculator. 1,000 times 1.02 times 1.05. Indeed, I had made a mistake there. 1 times 1.12. At the end of the third year, we have $199 in interest. Fourth year, we have $1,379. And finally, a whopping, let's put a 1 there, $1,710.52. And I'm going to leave this whole unrounded number. Okay, so that's how much money I have. That's my future value. And I'm going to write the whole unrounded number down because I'm going to use this in the next part. When we use things, it's best not to round them. Store 1. I like to put a 1 in square brackets to remind myself of where I stored that in my calculator. So now let's look at the average rate. The average effective rate is the rate I would need to get to that future value. So it's I where, let's look at this. If I take $1,000 and I go 1 plus I to the power of 5 years equals 1710, and I'm going to put in all those decimal points. This is solvable. All I need to do is use a 5th root, or 1 to the power of something to the power of 0.2. But I'm not going to do that. I'm going to use the calculator because, as we've seen, that TVM button on our calculator is really, really useful. That's a V. Okay, N is 5 years. The rate is what I'm trying to do. It's effective, so 1. I start with 1,000 and I end with, remember this has to be negative, and that's so our equation can balance correctly. So let's go into that. And now I'm going to make this negative and put it straight into the future value. 1,000 is the present value. 0 is our payment. Our interest rate is what we're going to find. Make sure our PYCY is 1. Nice. And our N is 5. In that case, I worked backwards, but usually I work forwards. So let's compute IY, and we end up with 11.33%. So I averaged 11.33% on this investment. That means that on average, even though sometimes we were making 2% and sometimes 24%, had we invested at 11.33% for 5 years, we would end up with the same thing. So they're effective. Now I'm going to write down a bad idea. I'm going to write bad idea first so you don't get a still of this and end up with a mistake. 2%, 5%, 12%, 15%, 24%, Well, there's 5 years. We divide that all by 5, and what do we get? 11.6%. That is not the answer. It doesn't work that way at all. When we're talking about average rates, we're talking about a particular kind of average, a single number that is equivalent. We're not talking about the arithmetic mean or that type of average. Let's just do a little one to illustrate what's going on. Our investment earns 100% return in the first year and loses 50% in the second year. What is the effective rate of return over 2 years? In this case, we don't have a number. So let's make something up. You've probably noticed by now that when I have to make something up, I start with $100. Some people use $1, some people use $1,000. You could use $312.52, but that seems a little difficult for me. So let's start with $100. At the end of the first year, our future value is now $100, and it's earned 100% return. So that means it's 1 plus 1. That's our markup, or percent change. And that means that now we have $200. At the end of year 2, it's lost money. It's lost 50%. This is the same as a markdown. We haven't overly talked about negative interest rates, but negative interest rates happen a lot, especially in the stock market. We lose money over time. Hopefully, we make more money than we lose, but from month to month, we might lose. That's a negative interest rate. This is a rate of negative 50%. When I dump that in, I end up with $100. So what's my average rate? Present value is 100, and at the end of 2 years, I still have $100. That means that we averaged 0% interest. So this investment was equally as good as taking your money, putting it in a box, and putting it under your bed. In general, we say that we've lost money on something with a 0% interest because we have inflation going on where money is worth less over time. In 1989, to buy a chocolate bar might have cost me about 50 cents. Now a chocolate bar probably costs about $1.75. That's a huge change. Over time, money is worth less, and when you take econ, you'll learn more about that, how that is going to change things. Finally, question 7. A mutual fund had returns of 12% compounded monthly in the first year, 18% compounded annually in the second year, and 4% compounded quarterly in the third year. What would a $1,000 investment 3 years ago be worth today? So we can do this in multiple ways. I'm going to confess I'm a big fan of algebra, so I would probably write this out algebraically. Well, I started with 1,000. Then I have 1 plus 12% over 12, first year to the power of 1, multiplied by 1.18 because it's annual, and then 1 plus 0.04 divided by 4 quarterly for the third year. So that's going to be 4. Sorry, this is 12 because it was for 12 months. That's the way I would think to do this in my head, and I would get the right answer. However, a lot of people, most people, prefer to use something like a calculator. So what we're going to do is look at this by using our BA2 Plus calculator and also by keeping track. So I'm going to add one extra column, and that's the year. In the first year, we earn 12% compounded monthly. I'm going to write J12 equals 12%. In the second year, we have 18% annual, and I'm writing that in. And in the third year, we have J4 equals 4%. And sometimes these can happen for multiple years. The textbook, whose PDF is up on our website, our Learning Hub class, has an example where things take place over multiple years. So expect to see that as well. Okay, so for the first year, That's 12 months and a monthly rate. Our interest rate is 12. That's a lot of 12s in a row. And our present value was $1,000. And this is what we're going to compute. Next, in our next year, whatever my future value is, I'm going to move that over to present value. It's annual, but it's an 18% interest rate. Payment is always 0, and I'm still going to compute. Finally, I'm going to do this again for 4 quarters. Quarterly, 4, and whatever I got here, I'm going to put there. So let's try this. I start and I go 12 for N. My interest rate also 12, and I'm going to make sure my PYCY turns to 12. And when you change PYCY changes automatically. We start with $1,000. Make sure our payment is 0, and at the end of the first year, we have negative 1126.825, and we store everything. I'm going to make this positive because I'd like my present values to be positive, but you don't need to do that. I'm going to press present value. What I've done here is put this into the present value. So now let's clear and start at the beginning. N is 1. IY is now 18. PYCY is back to 1. Present value I did. Payment I don't have to put in 0 every time, but I like to. And I go compute future value, and now I have 1326. And that's negative. Sorry, 1329 and 65 cents. I like to make it positive by just pressing that plus minus button, and then I'm going to press present value. What I've done now is store this in my present value. Clear that. N is now 4. Our interest rate is also 4. And my PYCY has gone to 4, enter, and I clear. I've done my present value and payment already, so I'm just going to compute the future value, and I get 1383.642. Anytime I see this, I'm going to save it. So store 1 in case I need it again. And you never know when you're going to need it. So the answer for A is the future value is $1,383.64. And you can go up here and see, I've done this on my own off camera, and I did get the exact same answer, which is nice to know. Part B. What was the average rate compounded monthly of return earned? So we're trying to find the average rate. One advantage is we already have this future value here. So it's monthly for 3 years. That means we're investing this for 36 months. IY is what we're going to be looking for. PYCY, well, that's monthly. And I start with what I started with at the beginning, $1,000, and I'm going to end with my future value, $1,383 and change. So let's put that in, 36N. Let's go to our PYCY. I already actually set that to be 12. Good for me. Start with $1,000, PV, 0 payment. It's always good to recall. So I'm going to say recall future value and know what I have. Recall is how you check things out. So let's compute IY, and then we find out that J12 equals 10.87% and change, and that's our average rate. So if I had taken $1,000 and invested it at 10.87% compounded monthly, after 3 years, I would have $1,300. Okay, let's do one more part. Part C. The fund lost $100 in its 4th year. What was the average effective rate of return for the 4 years? So what we're going to do is look at just that 4th year. I don't need to use my TVM buttons. We lost $100. So we started with $1,383.64, and we lost 100. So we end up with $1,283.64. Here, I'm going to say it doesn't matter as much if we hold on to our rounding, because now we're on a specific number, and it's always good to hang on to our interest, hang on to all those decimal places, but it's less important in this particular example. So now our future value is going to be always negative. Our payment's always 0. We started out with $1,000 and we invested it, and this is effective, so it's annual, over 4 years. And our interest rate is what we're looking for. So let's start. N is 4. IY we can leave alone. PYCY now changes to 1. Our present value is still $1,000, but our end or future value is, we have to clear out a PY. Negative at the end. Our future value is now 1,200 and change. So our interest rate's going to be smaller. So we end up with 6.44%. And that's how we do average interest rates. Importantly, I'm going to say that you should be practicing this. There's questions on the online homework as well as questions in the textbook. This is a good thing to practice. Lesson 10, payment plans and making choices. Let's start with a question, and we're going to work through this question and learn how to make decisions using interest rates. For your first job after graduation, you have decided to accept a contract position. The manager is offered to pay you $30,000 at the end of the first year and $35,000 at the end of the second year, or to pay you $22,000 now, $20,000 at the end of the first year, and $20,000 at the end of the second year. Which option is better and by how much if interest is at 10% simple? Use today as your focal date. So let's talk about comparing two choices. What we do is we pick a focal date, or one is given to us. And in the truth, it doesn't matter which one we choose. The better choice is the better at any time. Usually or often we use today. Today is a good focal date because computing it is nice. Then what we do is we compute all values at this date. And then we pick the best one. And the best one is the one where either we have the most money or we pay the least money, depending what it is. What we're going to do to help us is draw what's called a timeline. Timelines are something we're going to be doing a lot of in this course. So I'm going to draw 2 of them. One of them was perfect and one of them was not. And I'm going to put in the times. 0 is today. All the times mentioned in the problem. 1 year, 2 years. 0, 1 year, 2 years. And I've drawn 2 of these because I have 2 options. My options are A and B. Okay, let's put in our money. I like to say that money into my account is going to be an arrow down. So this money goes into my account at 1 year. In option 1, I get 2 payments, one at a year and one at 2 years. So I get $30,000. And then I get $35,000 2 years from now. $65,000 in total, but not for a while. In option B, I'm getting $22,000 right away. $20,000 in a year and another $20,000. Looking at this, just so you can see the total, here it's $65,000 over the 2 years, but I have to wait a while until I get it. In this one, it's 40 plus 22 is a little bit less. It's $62,000. But the fact that I'm getting some of it today is good. So now I'm going to use some arrows to show that I'm going to move everything to the focal date. Circle the focal date, that's today, and I'm going to move this over. When we move something backwards, we are starting with a future value and we're ending with a present value. So what I'm going to do is find the present value of each of those payments and then add them together. So here I've got present value 1 is $30,000 and it's going backwards 1 year at simple interest, and that was 10% interest. So that's what's happening. Present value 2 is $35,000 over 1 plus times 1. Let's just pull the calculator back up. So let's look at those together. 30,000 divided by 1.1 is 27,000-ish. Here, sorry, this should be a 2 here because it was 2 years. Just going to highlight that 2 because it's going 2 years. I'm going to store this as well. And then I'm going to do my present value 2 is $35,000 divided by 1.2. And that gives me 29,166. So my present value, how much this is worth, is found by adding those two things up, and it's $56,000. So you can use the calculator. I've already worked this out ahead of time, so you can believe me that it's $56,439.39. Let's go on to the second example. So I'm finding present values for each thing. Future value 1 was 22,000. Future value 2 is 20,000, and future value 3 was also 20,000. So present value 1, well, that's just 22,000. It's not moving anywhere. When something stays still, we don't need to worry about interest. Present value 2 is going to be that $20,000 divided by 1 plus 10% times 1. And present value 2 is going to be the same sized payment, but it's worth a bit less because I'm multiplying that 10% times 2. So my present value for this is going to be adding all those three things together. And I'd like you guys to try this in your calculator, and you should end up with the same answer as me. And that is 56,848.48. So what would you choose? Well, I don't know about you, but I would choose this one. Let's put a sentence down there. And that sentence is option B is worth more in what we call today's dollars by today's interest rate. So it is a better option. And part of that is, the big part, is that upfront money. Getting that $22,000 today is really worth a lot. Now we're going to talk about a payment scheme, and we're going to be doing more of this in lesson 11, but we're going to start now. You have two debts coming due. A debt of $1,000 in 6 months and another of $1,500 at the end of the year. Interest is charged at 12% simple. You speak to Mr. Hammerhead, the loans manager, and discuss several different payment options. So let's start with A. How much would we have to pay it off today? So for this, what we do is we start by drawing a timeline. So timelines are the way we start a lot of these. We say today, 0, 6 months, and I like to put in simple how many years it is, because that's easy to put into the calculator, and 1 year from now. Okay, so we owe $1,000, and I'm going to put this as an arrow out to show that I have to pay that money. It doesn't matter how you put it, but we're going to see next time that you need to, when you have both incoming money and outgoing money, inflows and outflows, you do have to pay attention to that type of thing. So we'll talk more about that in the next series of videos. So we owe $1,000 now, or in 6 months, and $1,500 in a year. So somehow we are going to pay the whole thing off today. Just like we did before, we're going to move everything to our focal date. And that's today because it says so in the problem. So we're going to pay them both. So same as we did before, let's make that a future value. Future value 1 is 1,000. Future value 2 is 1,500. So present value 1 is then 1,000 over 1 plus 0.12 times 0.5. And present value 2 is going to be 1,500 over 1 plus 0.12 times 1. I'm going to simplify this a little bit because it's easier if this goes into my calculator like this. And over here, it's easier if it goes into my calculator as 1,500 over 1.12. So we're going to put that in the calculator together, and I put them in at the exact same time, and we come out with those two things added together, which is going to be 22,080, not 22,000. Sorry guys, I'm reading my notes wrong. It's 2,200. And I'm going to do that by putting that in the calculator as well. 1,000 divided by 1.06 plus 1,500 divided by 1.12. Putting that in together, I get the same answer. We're going to do the exact same one for part B, but now we're going to pay in 18 months. So we're going to do the same problem, different focal date. So this time, let's draw in this equation. I've got today, 6 months or 0.5 years, 1 year, and now I'm going to add 1.5 years or 18 months. And this isn't to scale. Your diagrams do not need to be perfect. Mine certainly are not. Sorry that I wanted that to go upwards. We owe $1,000 at 6 months. We owe $1,500 in a year. And what we're going to do is pay everything off here. So I'm going to move everything over, but this time I'm moving it to 1.5 years. So I'm going to have to do some counting. 6 months to 1.5 years. I'm going to write this here so I remember. 1 year to 1.5 years is 0.5 years. Now, remember, this is now a present value, and I'm going to be finding future values. So FV1 is going to be 1,000, but this time I'm moving it forwards in time. I'm going to be paying more interest on this loan. So it'll be 1,000 times 1 plus 0.12 times 1 plus 1,500 with 6 months interest. This is actually, I'm not going to even put the 1 there. I'm just going to say future value equals this thing. I'm going to simplify it a little. And I can put this in the calculator just like this. 1,000 times 1.12 plus 1,500 times 1.06. And that is 2710. So what would you prefer? 2710 in 18 months or 2282 right away? Well, if we wait 18 months, we have to pay more interest. That's what is happening here. The interest is a lot more. So if I had the money, I'd choose today. If I don't have the money, then I'm going to choose 18 months because I don't have $2,200 to pay right now. Let's do another one where we're making choices. This time, however, instead of using simple interest, we're now using compound interest. However, nothing changes, just the interest formula. Everything else is the same. So, Sagir received 2 offers for a property he is selling. Offer 1 consists of $700,000 immediately, and offer 2 consists of $500,000 now and $110,000 per year at the end of the next 2 years. Money earned 6% compounded semi-annually. Which one is better? And how much? Economic advantage just means which one is better for us economically, and that's always how we're saying. And by how much, that's going to be the difference between the offers. So let's write in the offer. Offer 1 today, and we have 1 year and 2 years. And for our next offer, we've got today, 1 year, 2 years. Offer 1 is $700,000 now. So I write in $700,000 and an arrow going in to my account. And that's it. That's actually easy to figure out. The present value of offer 1, I'm putting a 1 there to mean offer 1, is just that $700,000. That's how much it's worth. Offer 2 is a lot more interesting. It's going to be only $500,000 now, but there's extra money added. We also get $110,000 a year for 2 years. So we get some extra payments, an extra $20,000 in total versus offer 1, but we have to wait for a while. One thing that I like to do when I draw these timelines is write my interest rate right in. Just so I remember what's going on there. So offer 1, we've gotten that. We don't need to do any interest. But for offer 2, it says in today's dollars, and that means that focal date is today. And that is often the way we do these choices. It makes sense to use today's money. Okay, so what we end up with is our present value is going to be, well, $500,000 today is worth $500,000 today. $110,000 in a year is going to be worth $110,000 plus 1.03, and it's 1 year. I'm going to say that's 2 half years. So to the power of 2. And my last payment, well, that's going to be over 1.03 to the power of 4. Put that into the calculator and we will see our answer. I'm going to actually do this entire thing. Feel free to stop the video if you want to just know. I'll give you the answer, 701,419.13. In the calculator, 500,000 plus, oops, I'm not doing this correctly. 500,000 plus 110,123 divided by 1.03 squared equals plus 110,123. Might have been better, now that I look at this, for me to store all these numbers. So forget me putting it in. I can't work the tiny little calculator today. It's 701. I did it on a real calculator. So this one is better. It's a better one, or it has a more economic advantage, and it's better by exactly $1,419.13 in today's dollars, because the present value is worth exactly $1,419.13 more. Anna borrowed $1,000 from a local loan shark on January the 1st, 2010 at J12 equals 24%. On January 1st, 2012, Anna paid the loan shark $500 and the loan shark agreed to lower the rate to J12 equals 18%. How much money will Anna owe as of January 1st, 2014? And if Anna pays the balance, how much interest will she have paid? So let's go over this question in a little bit of detail. We have more complicated things going on than the others because our interest rate is changing. This is going to take some more careful planning. So I'm going to write January 1st, 2010. Everything is January 1st, so that's okay. 2012, let's just extend this, and we're going to 2014. And I could say that's 0 years, 1 year, 2 year, 3 year, 4 year, if that's what I would like. Okay, so Anna borrowed $1,000. So she borrowed it. I like to say that it goes into her account. And then in 2012, she paid back $500. So we're going to do this by checking the balance, but we're also going to see next time that we could do this as what's called an equation of value. So we're going to see this in a couple different ways. Let's look at January 1st, 2014. Actually, before I do that, let's look at the most important thing that's going on here and making it crazy, the interest rate changes. So in the beginning, we have J12 equals 24%, otherwise known as I is 2%. That's 24 over 12. In the second half, the interest rate changes to only 18%. Dividing that by 12, it's 1.5%. So things are changing. So let's see what happens if we go through her balance. On January 1st, 2010, Anna owes $1,000. In 2011, she now owes $1,000 plus interest. That interest, well, it's going 2 years into the future. 2 times 12 is 24 months, in which case she now owes 1,000 times 1.02 to the power of 24. So she owes $1,600. I'm going to write what she owes. But she pays $500. So she owes less. Okay, so she only owes $1,108. But now it's going to accrue some interest. So this is not 2011, it is 2012, because that's what's happening here. In 2014, she now owes $1,108 plus another 2 years of interest. But this time, she's only being charged 1.5% per month. So this, and I'm going to leave it unrounded, though that is one of those things that I'm going to have to talk about in a different lecture. The truth is, some people keep track of all those decimal places and some people don't. And in this class, I'm going to let you do either. 0.015 to the power of 24 equals 158451. Here we go. So that's how much money Anna owes on the 14th. If she pays it off, how much interest should she have paid? Interest is going to be money paid minus money borrowed. And we're going to see this in lots of different ways. Money in, money out, money paid, money borrowed. So Anna paid, looks like she made a payment of $1,000, and she made that payment of $1,584.51. cents. Sorry, she didn't pay $1,000. She paid $500. Correct? But she borrowed $1,000 in total, which means in the end, she paid $1,084.51 in interest. Lesson 11, Equations of a Value. We've talked a lot about interest rates, compound and simple interest. This time, we're going to balance everything into an equation. An equation of value is a fancy way of saying that we need to balance our account. So that means that all of the inflows is the same as all of the outflows when we count for interest. In other words, all the money in equals all the money out. Or, in other words, money borrowed equals money paid. Those things balance as soon as we add in interest. When we do an equation of value, we're going to look through a story about either borrowing money or lending out money, and we're going to move everything to the same time, and then we're going to solve this equation. So I'm going to tell you what the basic tools are. The first thing we're going to do is draw a timeline. Those timelines really help. It's hard to do it without. We're going to circle the focal date. Here's a rule. Simple interest, you must be told because the answer is going to be different depending on what you choose as a focal date. For compound interest, choose the easiest one. And we'll talk about what makes it easiest, the one that the algebra would be easiest for. Put in all the monies, paying attention to the direction. And that really means, did I borrow the money? Did the money go into my bank account? Or did I pay it back and I lost the money? Then we're going to set up equation. And we're going to find a bunch of PVs and FVs. In general, if we're moving forward in time, we find the future value and we multiply. If we are moving backwards in time, we're finding a present value and we divide. It's the same as it was in our partial payments back in chapter 1. Next, we're going to solve the equation. And then we're going to state the answer. Example 1. Today you take out a $5,000 loan at 10% simple interest, which is to be repaid with 2 equal payments at the end of the first year and at the end of the second year. Find the size of the payments using today as your focal date. So let's put in some of our items. 10% simple. These questions could deal with simple or compound interest, and it's important for us to know which one. $5,000 loan and then 2 equal payments. So let's start with a timeline. There we go. Nice and neat. Let's put in our times. Today is always 0, 1 year, and 2 years. So those are the times that are important. We borrowed $5,000 and we're going to repay X dollars. And that's because I have to choose any kind of variable and I choose the letter X. That's often what we do. It says use today as your focal date, so I'm going to go ahead and circle that. Importantly, I have to say whether everything is money in or money out. That $5,000 is a loan. It came into my account. Well, those payments are leaving my account. It doesn't matter which way you decide to draw your arrows as long as you're consistent. After all, $5,000 coming into my account means the person who loaned me the money had $5,000 leave their account, and the payments will come to them as income. Every question has both people, and it can be done either way. Let's move everything to the focal date. And then we set this up. So X is the size of the payment, and we're going to set this up as money in equals money out. Or money borrowed equals money paid. So let's start with that money that we borrowed. We borrowed $5,000. And the $5,000 isn't moving at all, so it gets to stand alone exactly where it is. That's going to be equal to this first payment of X. That's moving backwards, and we know that then we're dividing. We're finding a present value, and that is X over 1 plus 10%, simple, times 1. And then we're going to take the present value of this guy. Again, we're moving backwards, so that second payment of X is 1 plus 10% times 2. When we come up with something like this, it makes a lot of sense to simplify before we start to do anything. If you love algebra and this is really something you're good at, pause now, do the algebra to solve for X. If you're struggling, keep on watching. Okay, I'm going to make this a little bit simpler. Now, I have two different fractions on the bottom. I'm actually going to move this over a little bit, and you will see why. I have two denominators, so what I'm going to do is multiply both sides by 1.1 and 1.2. And because there's a plus in here, I'm going to multiply everything. Let's just move this over here. 1.1, 1.2. Perfect. Now I can do some simplifying. There's a 1.1 on the bottom and the top, and there's a 1.2 on the top and the bottom. This is a good way of clearing out those denominators. I'm going to rewrite this expression without doing any arithmetic. Well, that looks a lot nicer. Next, I'm going to actually move those sides over because I personally always like my X to be on the left and the other number to be on the right. Let's do $5,000 times 1.1 times 1.2, and I get $6,600. When I add these together, because remember, I'm distributing this through. So 1.1 plus 1.2 is 2.3. So I have 2.3x equals 6,600. I'm going to go ahead and divide both sides by 2.3, and that will clear that 2.3 from the x, and what I'm left with is just x over equals 6,600 over 2.3. 6,600 showing up on my calculator, divided by 2.3, and I get $2,869.57, remembering to round up. And that is the answer. And I'm going to finish by writing a sentence. Each payment is going to be $2,869.57. Let's do one more part. It's not written in this question, but we care about interest. In general, this is really important. We do want to know how much we paid. In this case, interest is going to be money paid minus money borrowed with no interest calculated. And I'm going to say no PV or FV. So the money I paid is going to be 2 payments of $2,869.57, and we borrowed $5,000. I'm going to clear this because I don't want all those trailing decimal places. One of the frustrating things about business math is even though we always end up with fractions of a cent and we carry them through, you can't make a payment that's less than a cent. So you always have to round when you make a payment. So I'm going to multiply that by 2 and subtract 5,000. And it looks like I paid $739.14 in interest. That's how much this loan cost. Question 2. Today you take out a $5,000 loan at 10% compounded quarterly, which is to be repaid with 2 equal payments at the end of the first year and at the end of the second year. A, find the size of the payments, and B, how much interest will be paid. If this question looks familiar, it should. It's the exact same question that we did in question 1, except that now we have, I'm just going to circle 2 equal payments. Now, instead of having simple interest, we have compound interest. As before, I'm going to start by drawing in my timeline. Today, 1 year, 2 years. But everything here is quarterly. So I'm going to say J4 equals 10%, which means that I is 10% divided by 4, or 2.5%. In case you're wondering how I did that, 10% is 0.1, and I divided that by 4. So let's use today as our focal date, just because that's what we did last time. Here, though, we get a lot more leeway. In compound interest, no matter where you choose your focal date, you're going to come up with the exact same answer. That means that we could choose something where the equation looks nice in algebra. But what we're going to do today is just do the same thing we did before, except now we're using the compound interest formula. I'm going to state what X is. So X is the size of each payment. And I'm going to put a note. Any focal date will do in compound interest. This isn't true in simple. Simple interest is not as elegant, and it does matter where we choose the focal date. So the 2 people that are arranged in the lending, have to choose one together. So let's put our money borrowed equals money paid, or money in, money out. Our money borrowed was $5,000, and our money paid was that first payment of X, but it's going back in time 1 year or 4 quarters. If you're not sure about these payments, these measurements, go ahead and put those quarters in. So this is 1 quarter, 2 quarters, 3 quarters, etc. That helps. Now let's add that second payment, also 1.025, but this time it's going 8 quarters into the past. Let's calculate this. There are lots and lots of ways to calculate this, but I'm going to do just one way. What I'm going to do is actually I'm going to move everything over to the other side. I'm going to note that X over 1.025 to the 4 is kind of like this fraction times X. And now I'm going to use the calculator. Scroll up a little. 1 divided by 1.025 to the power of 4. That's a big long number, so I'm going to store it. I press store and then 1. And that is 0.9059 ... x. Anytime I store something, I like to write down what I stored it as so I can get it back. Let's do the next part. 1.025 to the power of 8, and then it was 1 over that, so 0.82. And I'm going to store that as 2. And again, let's write down that that was stored as 2, and that whole thing equals $5,000. Now I can factor out that x. So this thing here, well, that's going to be recall 1 plus recall 2, and it's 1.72666. Another big number. Every time I get to these big messy numbers, I like to store them. Store 3. So now I have, let's scroll up a little, 1.72669 x, and that's the same as store 3, and that equals $5,000. And now we're back to a similar place where we were. I can divide both sides by that. So now I have x equals this guy. So I have 1.72669. I'm going to clear $5,000 divided by recall 3 is this. 2895.70. It's different than we had before. And I'm going to end this with a sentence. Each payment is $2,895.70. Interest is the same way. So we paid, well, money paid minus money borrowed in interest. Same thing here, only we have a different payment. We borrowed $5,000. So I'm going to clear this just so that I don't have to worry about those trailing decimal places, though if you use the decimal places, it's not the end of the world. Okay, we paid $791.40 in interest. That's not dramatically different than before, but if I'm going to scroll up to question 1, we paid $739, so that's a lot more. In general, that's going to be true. The longer a time period we invest for, the less we're going to pay in interest charges with simple and the more interest in compound. If we're investing the money, compound is going to be better in the long term because we end up with more money. Question 3. You must repay a debt of $6,000 at 6% simple borrowed today. The finance company has agreed to allow you to make 3 yearly payments with the first payment in 1 year. The first 2 payments will be equal and the third payment will be $500 more than the first 2 payments. Find the size of the payments using 3 years from now as your focal date. First, this is a simple interest question, which means it's important that we note the focal date because we don't really have a lot of choice. Let's draw a line in. Okay. Our timeline goes from now, or 0, 1 year, 2 years, 3 years. The focal date is at 3 years. I'm going to circle that, and I'm going to put everything there. We borrowed $6,000. I like to show that as $6,000 going into your account, and we repaid it in 3 payments at 1 year, 2 years, and 3 years. everything here is going to be 6% simple. Let's let X be the first payment. Then we have X here, and the second payment is the same, and the third payment is $500 more than the first one. So it's X plus $500. When we have a choice, if there's anything with an addition there, it is easiest to put it at the focal date. So if we could have chosen a focal date, I would have chosen this one. This time, everything is moving forward, so we're going to be finding future values for all of our items. So we have, again, money borrowed equals money paid once we account for interest. So we borrowed $6,000, but we're moving that forward in time 6%. 3 years times 6%, because it's going 3 years into the future. That's going to be the same as this X is moving 2 years into the future. And this X is moving 1 year into the future. And finally, our last payment is staying the same. I'm going to put that in brackets just so we know it all sorts together. I'm going to simplify this a little, and then, like I often do, I'm going to move all the X's to the same side. So here, once I simplify this, I have 1.18 times 6,000 equals 1.12x plus 1.12x plus 1.06x plus x plus 500. Moving all the x's together, 1.12x plus 1.06x plus x equals 1.18 times 6,000, and I'm going to do that in a second. And then I have this minus 500 because it really switched sides there. Adding these things together, 1.12 plus 1.06 plus 1. And remember, when it's just x, it's the same as 1x. This is 3.18x equals 1.18 times 6,000 minus 500 is 6580. Okay, I am going to divide both sides, switch colors because we might as well, by 3.18, and we end up with x equals 6580 is showing up, divided by 3.18 is going to be $2,069.18. And this is the first payment. But if I scroll just a little to look at our timeline, we had 3 payments. The second payment was also X. And the third payment was X plus 500. So it's going to be $2,569.18. Those are the payments. Now let's look at the interest. Money paid minus money borrowed. Well, we paid one payment of $2,069.18, another payment of $2,069.18, a payment of $2,569.18, and we borrowed, I'll put that all in a bracket, $6,000, which means once we dump that into a calculator, which I'm not going to do on screen, we end up with $707.54. That's the interest. I'm going to note that sometimes we call this the cost of borrowing. This was how much the loan cost us. Over the 3 years, we paid $707.54 in interest. Question 4 is the trickiest one of this whole bunch because now we're going to have multiple inflows as well as multiple outflows. You borrowed $3,000 from your line of credit 8 months ago and a further $5,000 3 months ago. You arranged with the bank to pay off the line of credit with 2 payments. The first payment, 6 months from today, will be twice as large as the second payment made 1 year from today. The bank charges you 9% interest compounded monthly. Suggested focal date, 6 months from today. Find the size of each payment and then find out how much interest you paid. I'm going to say it is a suggested focal date because with compound interest, it actually doesn't matter. We can choose whichever one we want. So I'm going to draw in a timeline and start by putting in some months. I usually like to put today right at the beginning, and now I'm going to highlight every date we have. 8 months ago, 3 months ago, 6 months from today, 1 year from today. Those are all the points we have. Ago means in the past. So I would put this down as minus 8 months, and we also have minus 3 months. Don't worry about it being to scale. This timeline is meant to help me, not to be super accurate. 6 months, 12 months. Okay, we do know that the bank is going to charge us 9% compounded monthly. I'm just going to write that over here. J12 equals 9%, which means I is going to be 0.09 over 12 is 0.0075. And this is a compound interest problem. Let's let X be one of the payment. Let's let it be the second payment. And I've chosen that. You could choose any one you want because the first one is twice as large as the second. So that way, it makes sense to have X to be the second payment. So let's put in the money we borrowed. We borrowed $3,000 8 months ago. Again, that's going into our account. And we borrowed more money, an extra $5,000 3 months ago. We arranged to pay off the bank line with 2 payments, and those are at 6 months from today. I'm actually going to change the color there so we can see that it's a different side. And one at 12 months from today. We said this was the second payment, X, which means that 2X is the first payment. Suggested focal date is 6 months from today, but it could be anything. Today doesn't make sense because there's no payment happening today. So I'm going to stick with that 6 months, but with compound interest, it's actually your choice. Now I'm going to move everything backwards, remembering we divide when we go backwards, we multiply when we go forwards. Money borrowed equals money paid. So let's start with the money that we borrowed. I'm going to scroll up a little so we've got some extra space. We borrowed $3,000. And actually, let's take a moment before we really get started and write in those times. 8 months ago to 6 months from today is 8 plus 6 is 14 months. 3 months ago to 6 months from today is 6 plus 3 is 9 months. 6 months to this, that's 0, and 12 months from today, 6 months from today, that's 6 months. Sometimes it helps to have those n values written in already. So we've got $3,000 is moving 14 months into the future. That $5,000 is moving 9 months into the future. Now that 2x, it isn't doing anything, but the x is moving backwards. And it's moving 6 months into the past. There's lots of ways to solve this equation. I'm going to just do one way, and I'm going to use the calculator heavily. So first I'm going to rewrite this by moving the x's to the left side, and I'm going to note that this is 2 plus 1 over 1.0075 to the power of 6. And then I have this whole mess, and I'm going to put that in the calculator in a minute. There's lots of clever algebra you could do by using rules of exponents, but I'm not going to do that in this class. But if that seems like something that you can do, go ahead. First, let's calculate this guy. So that is, I'm going to go backwards, 1.0075 to the power of 6. And then I'm going to take 1 over that and add 2. And just like before, I'm going to save this, store 1. So this is 2.95615x, and I'm going to put store 1 there. That equals, I'm going to put the entire second side in the calculator. 3,000 times 1.0075 to the power of 14 plus 5,000 times 1.0075 to the power of 9. I get 8678.63. I'm going to store that, though in the next line, once we divide out by this guy over here, I'm going to have this number, 8,600-ish, divided by whatever I stored under 1. And I get $2,935. Now, at any time, if you're having trouble making this algebra work, this is a good reason to come talk to me or do some of the algebra work provided online. Talking to me is always going to help. That is the second payment. So let's do the first one as well. That's 2x. Well, I'm going to clear it because I don't want to worry about those decimal places, but it is not overly concerning. 5871.56 is the first payment. Now let's do the interest. So again, money paid minus money borrowed. So we paid in this side $2935.78, and we paid $5871.56. I'm going to put that in brackets. The money we borrowed was those two payments together, and I'm putting those in brackets to show that we're going to add those first. $3,000 and $5,000, so we borrowed $8,000. Running that through a calculator, we come up with $807.34. And again, we call that the cost of borrowing. Today we're going to start talking about annuities. The key to annuities is that we're taking a compound interest problem and we're adding a payment. What is an annuity? I'm going to write out this definition and then read it out loud. An annuity is a sequence of payments at regular intervals for a set time. And to make it easier, all the payments are equal. Let's go straight into a few examples. One example is saving. So what if I put $100 a month into the bank for 3 years? That's one example. How about another example? I'm living off of credit, and every year or every semester, that's twice a year or semi-annually, I am going to borrow $5,000 for living expenses. This is a particular example of what we call accumulation. The key here is that the balance is growing. It gets bigger every month. So my bank balance is higher every year, every month. And my debt is growing. So every 6 months, my debt is a little bit bigger. Let's look at some more examples of a different type of annuity. I have a mortgage of $300,000. Every month, I pay $2,000. And here's a second one. I saved money to take a year off. Every quarter, that's 4 times a year, I take $6,000 out of savings and in this case, I have a second kind of annuity. This is called an amortization. Big fancy word, which we're going to see a lot of, but the gist is the balance is shrinking. It gets smaller every month, every period. So here, my debt is lower every month. So every time I make a payment, I have less money owing on my mortgage. In the second example, my bank balance is shrinking by $6,000, and that was a misspelled bank. Bank balance is shrinking. So those are 2 kinds of things: accumulation, growing, amortization, shrinking. 2 kinds of mortgages. Mortgages are divided into even more type of things. So let's look at when the payment happens. If it's at the end of the month, or the end of the quarter, or the end of the year, we call that an ordinary annuity, because ordinarily we pay at the end of the month. Oops. So here we have end goes with ordinary. We also have beginning. So in this one, actually, let's give an example. I pay my credit card bill at the end of the month. Usually when you're paying back money, you pay back at the end because it seems silly to pay back the day that you borrow it. When we have the beginning of the month, we call that an annuity due. Beginning due, and you can call that a begin annuity, even though it's technically called an annuity due. And often with a savings program, the day you decide to start saving, you actually start saving. That's the day I'm going to put the money in, and that means it's going to be begin. I'm going to put this in to show you the calculator buttons, and this will make more sense a little bit later when we talk about how to do this. Okay, we've got one more step to go over, and that's how often do I compound? And how often do I pay? So PY, we've seen this before. This is payments per year. And CY, we're going to go over this in your calculator. That's compounding periods per year. In a simple annuity, those things are the same. So I deposit monthly in my bank account. Interest is compounded monthly. That's the easiest type. That's why we call it simple. Then we've got general. The opposite of simple is general. And those things are different. And in the end of this unit, we're going to see a lot of mortgages. Mortgages compound semi-annually in Canada, but usually people pay monthly. So those are the different types of annuities. By now, you've seen me write this down a lot of times. These are the things that go on that TVM row of your calculator. I'm just going to quickly show that we've got this TVM button row here that we've seen when we talked about compound interest. PY is going to be the payments per year. So how many times per year do we pay? And this is the compounding. So this is the M from JM. It's how many times we compound per year. N is the number of payments. This we're going to get to. When PY and CY are different, N is a little bit harder to do. We're going to talk about that in the next lesson. IY is the nominal rate, same as it was in compound interest rate. Present value is, well, that's the balance at the beginning. I'm going to put a little plus sign here to say when the present value is positive, the payment is going to be positive when we accumulate and negative when we amortize. So balance growing, it's a plus. Balance shrinking, it's a negative. And in this case, the future value is always going to be negative. Just to make things complicated, we can always do it the opposite way. So we could say that if you wanted to say your debt was a negative at the beginning, then you'd add a plus because you're digging yourself out of that hole. And in that case, every single thing is opposite. Begin. When begin is off, that's the ending mode. And begin is on, and that is the begin mode. And we're going to go over that and how to use that on the calculator later. Starting with example 1, you decide to begin a savings plan. Starting in 1 year, you will deposit $100 each year into an account that pays J1 equals 12% interest. How much will you have in 3 years? How much of that is interest? Let's start by drawing a timeline. When you're first beginning, it's really useful to draw in these timelines. Once you've done it for a while, these basic annuities don't need them anymore, but we will talk about more advanced ones. So let's say that we start with no money. Then we're going to deposit $100. I'm putting the arrow down to show that that money is going into my account. What we're doing is evaluating this at the last minute, at time 3. Algebraically, using the compound interest formula, that's the same as saying I've got $100 that I invest for, looks like 2 years. I've got $100 that I invest for 1 year, and then I've got an extra $100. So when we put those together, I can evaluate how much money I have at the end of the time. That is $337.44. Please try this in your calculator if you would like. 3 payments, I can do that. But let's say I had 100 payments. I'm not going to calculate 100 different things. That's why I'm going to use the payment button for annuities. So let's look at our types of annuities. So the first thing I want to look at is, are we accumulating or are we amortizing? So here, every month, every year, I have a little bit more money. So I'm accumulating. And that's because the balance is growing. Next, I always want to look at, well, is it ordinary or due? And those are funny words. So ordinary is at the end of the year and due is at the beginning of the year. Here you can see I'm getting my first payment at the end of the first year, at 1, not at 0. So this is ordinary. And finally, I've got simple versus general. And I'm going to actually just write that. That is at the beginning, end of the first year. Simple and general, well, my payments, I put in a payment every year. And my compounding period, it compounds annually. J1 equals 12%. So those things are the same. That makes this a simple ordinary annuity. And now I'm going to put this in the calculator. So let's start at the beginning. I said that the payments were once a year and it was compounding once a year. Those are both 1. N, well, N here is 3 years because there are 3 payments. The interest rate is 12. I start with no money. This is very common in a savings, and I'm going to put in $100 every year. I'm putting a plus sign because my balance is growing. This is an accumulation. My future value, I'm going to compute that, but I'm going to hope that it's negative at the end. Begin is going to be off, and we'll worry about how to use that on the calculator in the next lesson. So let's calculate this. I'm going to put everything in. Starting with PYCY, I make sure that that is 1. It is. N is 3. Our IY, again, was 12. Present value, I put in 0. Now I'm going to actually put in that payment of 100, and I'm left with computing the future value. And I get negative 337.44, which is exactly the same that we got by algebra. Often in an accumulation, present value is going to be 0 because we assume that we start with no money. If we had money in our account, we'll deal with that next lesson. It's just a matter of putting a number into PV. Let's calculate the interest. Interest is money out minus money in a savings situation. How much money did I have at the end? Well, that was $337.44. Money in, that was 3 payments of $100. When I run that through a calculator or do it in my head, I get $37.44. That's how much interest I earned over the 3 years. $37.44. Example 2. Financial planners estimate you will require an income of $2,500 per month to retire. You dial a psychic and discover that you're going to live exactly 15 years. How much money will you need to retire if your first withdrawal will be in 1 month? Interest is going to be 9% compounded monthly. So let's draw a bit of a timeline here. Start with a line, and I'm going to start with today, and then write in 1 month. I haven't left myself a huge amount of room. And I'm not going to do the whole thing. I'm going to go up to here and say that's 180 months or 15 years. And then here is 179 months. Let's start putting in some things. I'm going to put some money in now. I have to put some money in, and I don't know what that is. Then I'm going to take out $2,500 every single month, starting 1 month from today and ending exactly 15 years from today, where I take out my last payment and then I am going to no longer need any money. At the end of the day, I don't have any money left. That's important because otherwise I couldn't calculate this. So let's look at this. I'm putting in a bunch of money now, and at the end I have 0. In this case, my balance is definitely shrinking, so I would call this an amortization. looking at my chart, you can see that I'm taking those payments out at the end of the month. And one thing is, if it's unclear, we treat it at the end of the month. That's what we mean by ordinary. That's the normal course of events. Finally, we've got our PY and CY. So I'm taking out monthly payments and I'm compounding monthly. Those are the same, and that's because I have J12 equals 9. Let's put this into the calculator, and you should get used to drawing this out because we do this for every example. Okay. In this case, I said PY and CY were both 12. I can write 12, 12, or I could write those together. Either way. It's going for 15 years, and that is 180 months. And I'm just going to put in that that's 15 times 12. Our interest rate is 9, and I'm going to start out, well, that's what I'm trying to find. I don't know how much money I start out with, but I'm going to take money out, so I'm going to make this payment negative because my balance is shrinking. My future value, I said that should be negative as well, but it's actually 0, so it's a negative 0. It's coming at the end of the month, so begin is off. So let's put this in. I'm going to show you by pressing recall. I still have everything in from my last example. I can overwrite that, just start putting it in, or I can press second clear TVM. And then if you look at it, everything is now 0. But PY/CY will still need changing. They don't clear when I clear that. If I change PY to 12, notice that CY changes as well. That's very handy for us when we're working on a simple annuity. N is 180, IY is 9. The present value is what I'm computing. 2,500 negative is the payment, and future value is 0. So I'll compute the present value, and we get a very big number. I need to have $246,483.52 to retire today. That's great if I have that much money. Later on, we're going to talk about how you would go about trying to save that much money, which makes a lot more sense. Let's do the interest calculation. We call that interest. When we borrow something, we call that cost of financing, cost of borrowing. You're going to see this a lot. And that's going to be money out minus money in. Or the money we pay minus the money borrowed. There's lots of ways of doing interest, but in the end, you should get a positive number because it doesn't make sense to have negative $5 of interest. So in this case, let's look at this question. Our interest payment is going to be, well, I took out 180 payments of $2,500 and we deposited $246,483.52. And I'm going to round that. So if I do this, I go 180 times 2,500. Oops. Minus 246,483.52 equals $203,000. So we actually made quite a lot of interest, and that's because we had a fairly good interest rate of 9%, but also this was invested for 15 years. That's a long time for money to compound. Example 3. You've just purchased a new house for $250,000. You can afford to pay $2,600 per month on your mortgage. How long will it take you to pay off your house if interest is calculated at 12% compounded monthly? Let's just take a second to draw this. I borrowed $250,000. That's going into our account, and then we're going to start paying payments of $2,600. Those are going to come out at the end of the month, monthly, for a bunch of time, N months. And what we're going to do is find that N. So firstly, I borrowed money and every month I pay it back. My balance is shrinking when I repay money, which means that this is an amortization. I'm paying at the end of the month, so this is an ordinary annuity. Also, I'm paying monthly, and I'm compounding monthly because I have J12 equals 12%. So this is a simple ordinary amortization. Let's take all the numbers from here and put them in. In this case, some people really like to see this as a negative number under your present value because you've borrowed that. That's your debt. I prefer to make everything positive in present value, so I'm going to continue to do that. And then, because my balance is shrinking, that $2,600 becomes negative. My future value, well, it doesn't say, but assume that I'm paying off all that money. So my future value should be 0 in the end. My begin is off because it's at the end of the month. J12, well, everything was 12 and the interest rate was 12. What I'm trying to compute is N. Now, just like in compound interest problems, with these annuities, I can calculate N, IY, PV, payment, or future value. As long as I know 4 out of 5 of these things, I can compute the other one using a calculator. Here, let's just put this into our calculator. So our PYCY still says 12, and I'm going to compute 12 is the interest rate, $250,000 for the present value. I'm making my payments of negative $2,600, and my future value will be 0 at the end. When I compute N, I get 327 months. And that means 327 big payments plus one little baby payment at the end. And we're going to talk about those final payments later on in the course. And just so we know, that's around 27.3 years. I'm going to be paying off this mortgage for a while. I'm going to do one thing. I'm going to make my payment positive. And I'm going to recompute N. Notice that N is a negative number. In this case, N is negative 67.709. That makes very little sense. It says I'm going to pay off my mortgage in negative 5.5 years. Negative years, negative time, that doesn't make a lot of sense. If you see a negative N, means that you put an entry error in wrong. When you see an error or you see something that makes no sense like a negative N, you know that you've made an input error and you've pressed the wrong button. Example 4. Your new car loan has payments of $499 at the end of each month for 5 years to pay for a $25,000 car. What rate of interest is being charged? What is the effective rate? What is the cost of financing? So let's look through this one as well. We borrowed $25,000 and every month we're going to pay back $499, etc. And that's going to go on for 60 months or 5 years. Every month, the amount of money we owe on that car is shrinking. That makes this one also an amortization. We are always making our payments at the end of each month, and it says that right in the problem. So it is an ordinary annuity. Finally, simple general. Well, that's a little more tricky because this question is asking 2 things. So let's do this with just a monthly rate. And then we're going to do this again and see what happens if we treat this as a general annuity. So let's start with PY and CY both being 12 because we're making those monthly payments, 60 of them. We're trying to find the interest rate. We started by owing $25,000 and we're making payments of $499. Those are negative because our balance is shrinking. At the end, we owe nothing on the car and we're paying at the end of the month. So we go into here, it's clear, and our PYCY should still be 12. Our N is going to be 60. Our interest rate is what we're trying to find. We're borrowing $25,000 and making payments of negative $499. And at the end of the day, we'll owe no money. When I compute the interest rate, I get 7.33. Now there's a few things we can do. I could take this interest rate and store it and then use that interest conversion worksheet that we talked about in the last section. So the nominal, let's put recall 1, enter. Now I go down, I'm going to find my effective rate, but I need my CY to be 12. I'm going to compute that, and I find out that I have 7.5875%. But I can treat this separately. I'm going to do this as a general annuity because we're going to start doing this in our next lesson. I'm still going to pay 12 times a year, but now I'm going to compound 1 time a year. N is 60, everything else stays the same. So what I'm doing is just changing one thing in the calculator. So let's clear out of this one, go to second PY. PY is 12, but now I'm going to go down and change CY to be 1. So when I scroll here, you can see 12, 1. Those are different. Clear out of that worksheet, compute the interest rate, and now I get 7.5875%. Exactly what I got through the interest conversion worksheet. So general annuities seem complicated. However, in the end, we can do them fairly easily given that we have a good financial calculator. Finally, let's do the cost of financing. Cost of financing is fancy for interest. So cost of financing or cost of borrowing is a fancy way of saying interest. When we borrow, we say our interest is going to be the money paid minus money borrowed. So in this case, how much did I pay? Well, we paid $499 60 times and borrowed $25,000. We can throw that into a calculator, which I did off camera, and I ended up with $4,940. That's the cost of financing. One more note on this. Cars. The sticker price on this car is actually a bigger number. Let's say this car is $29,940 with 0% financing. Where did I get that number? Well, that number was $499 times 60. If a car dealership advertises 0% financing, usually this is what they mean. The car is actually $29,000, or you get $4,940 cash discount. That's for paying cash right away. The real moral here is you're not getting something for nothing. So that 0% interest really means that the cost is actually $25,000. Lesson 13, more annuities. Today we're going to look at different types of annuities. Simple versus general, ordinary versus due. For completeness sake, here are the formulae that you can use to do annuities. In this course, we're going to be using a pre-programmed BA2 Plus calculator, but if you are a person who loves algebra, go ahead, knock yourself out. These formulas are also in the textbook. First, we're going to start with what we like to call five-finger problems. A five-finger problem just means you have a problem where PV and FV and payment are not zero. So we've got a present value and a future value going on. We're going to start with a car lease. You decide to lease a new BMW automobile. The vehicle costs $30,000 new, and you are required to pay all taxes at the beginning of the lease. The lease payments are $600 per month for 3 years. And you know the lease company charges interest at 6% compounded monthly. I'm just going to write J12 equals 6%. What is the residual value of the car, and how much interest do we pay over the lifetime of the lease? So let's pause for a moment and talk about car leases. In a car lease, you don't actually buy the car. All you're doing is renting it. This way, we pay less per month than if we bought the car outright, but the problem is, or the advantage, is we don't get a car at the end. This is great if 3 years after getting a car, you want to trade up to a new car. A lease is often the way to go. At the end of the lease, if you want to, you can buy the car for its residual value. Cars depreciate over time. Depreciate means they're worth less than when they began. A 3-year-old car, even a 3-year-old BMW, is not going to cost $30,000. It will cost less. To calculate that residual value, we find out what the balance is, or how much is owing at the end of those 3 years. So let's look at this problem. The balance, or how much we owe, starts at $30,000, but it goes down every month as we make payments. That makes this an amortization, but it's an amortization where FV is not going to be 0. The lease payments are $600, and unless you're told that the payments are at the very beginning, we usually assume that the payments are at the end of the month. Any payment we make at the very beginning, well, that goes with payments and taxes. And that's how leasing often works. Here, we're paying monthly, and the interest rate is a monthly interest rate. So that makes this a simple. This is a simple, ordinary amortization, but it's different than what we've done before because the future value and the present value are not both 0. Let's look at the numbers in this problem. The vehicle cost $30,000 originally. That $30,000 is the present value of the car. I like to leave this one positive. We make $600 payments. That's minus because the balance is shrinking. The payments are at the end of the month, and they are for 3 years. So 3 times 12 is 36 payments. And those payments and compounding are monthly. The interest rate is 6%. Our future value is what we're trying to find. We're trying to figure out what we owe on the car at the end of the 3 years. This will have been set up by the car company so that that's the value of the car. And if we choose not to buy the car, somebody else might want to buy our vehicle off lease. So let's scroll down and calculate this. So we start as usual by going to the PYCY. They are not the same. So we have to check PY equals 12, and now they're both exactly the same. N is 36. The interest rate is 6. Our present value is $30,000. And we're making $600 payments negative. Now we're going to compute the future value. Future value here is negative. That really means that a 3-year-old car is only worth $12,298.75. If we want to pay the car, that is how much we have to pay at the end of the lease. If we don't want to buy the car, we can walk away at this point, and we've just spent that money to rent the car over time, and then someone else can step in and buy a 3-year-old car for $12,298.75. That is the residual value. Let's pretend that we actually bought the car. How much interest did we pay over the lifetime of this lease? Well, our interest is always amount paid versus amount borrowed. Amount or money borrowed. Scrolling up over here, well, we paid taxes. We didn't borrow that. We don't have to worry about that. We made 36 payments of $600, and we paid off that residual value. How much did we borrow? That was $30,000, which means that our interest was not very much. It was $3,898.75 for our bottom of the line new BMW. 2. You are saving for your son's post-secondary education in 10 years. You have $27,000 in an RESP account and plan to add $1,000 at the end of the year for the next 10 years. How much money will your son have when he goes to school in 10 years if you receive a return of 4.8% compounded annually on the investments? This is another five-fingered problem, but it's different than the last one, and that's because we are accumulating money. We have $27,000 now, and it keeps on rising. It starts at $20,000, $27,000, and at the end, we will have more. Again, if we're not told, it's going to be ordinary, but here it says end. That's a keyword that we're looking for an ordinary annuity. Finally, we're going to make annual payments. I'm just going to put that in here, and we have it compounded annually. So let's put that one down right over here for CY. Now let's go back to the beginning and put in all of the information. We start 10 years, n equals 10. 27,000, well, that's how much money we have at the very beginning. We're going to add $1,000 at the end of each year. This is a plus 1,000 because our balance is growing. The payment is adding to the present value. How much money will we have? Well, that means future value is compute, and we know that this is ordinary, so we keep begin off. IY, 4.8, and now we have enough information to begin. Putting this into the calculator, we start with second PY, and we put in 1, check that PY and CY are both the same. N is 10. IY was 4.8. Our present value that we started with was $27,000. Our payment is $1,000 per year, and we're computing the future value. That gives us $55,610.68. I'm just going to show you that algebra equation that we did at the beginning, that actually works the same way. So if I use that equation, I've got payment 1 plus I to the power of n minus 1 over I. And then I'm going to add in that present value. I'm going to calculate that $27,000 separately. Trying that in a calculator, you'll get the same answer. So when we do one of these five-fingered problems, what we really have is two problems that are adding together. We have an ordinary simple annuity with the present value equals 0, and we have a compound interest problem. And we add those together. One of the advantages of a financial calculator is we don't have to explicitly do this. General annuities. You are shopping for a $100,000 mortgage and the bank has quoted you a rate of J2 equals 6%. You will make monthly payments for 20 years. How much will your payments be? Again, this is very typical of Canadian mortgages. We usually have CY equals 2 and PY equals 12. That makes this a general annuity. Because we have a mortgage, we're taking a $100,000 loan. That's our balance at the very beginning. We want our balance to shrink. It's an amortization. And unlike a lease, it It doesn't say what our end value is, how much we'll owe at the end. It should be 0. Unless you're told otherwise, assume that we pay off all of our loans completely. Our rate is J2 equals 6%, and it's a mortgage, so we're going to make the payment at the end of the month. Any money that we spend at the very beginning, that's part of a down payment. So this is an ordinary general amortization. We filled in most of this while I've been talking. And payment, well, that's what I'm trying to find. Finally, we just have N, and that's going to be 20 times 12. That's important. N always counts payments. Payments per year, not compounding period. So we're going to count how many payments we make over the lifetime of the mortgage, which in the end is going to be $240 payments. Let's run this through. We go into PY and we set that equal to 12. When I scroll down, you can see that CY has changed, so I have to set it to be different. When I scroll up, you'll see when you set CY, PY doesn't change. But when you set PY, CY changes. I always scroll around to make sure that everything has worked correctly. 100,000 present value, 0 is our future value. Compute that payment, and I get an answer of $712. And 19 cents. We're going to round out a little bit at the end. Let's talk a little bit more about general annuities. When we're using those formulas, what we do is we convert our interest rate to an equivalent one. So that we have PY equals CY. So what I would do here is I would say I've got J2 equals 6%. And I want to convert to J12 equals something. I'm going to do that. So we go to second, interest conversion. Our nominal rate is 6. CY is 2. I find that effective rate, 6.09. So let's write what the effective rate is. Then I take that effective rate, change CY again, and go back to the nominal rate. So this is what I would use in the calculation. No rounding, saving that entire thing. That's how it works in a spreadsheet like Excel, and that's how it works with the formula. We are lucky that we have a calculator that does that. It's doing that under the hood. And that's why we set it correctly, so that we can use our technology correctly. The important thing to always remember is that N counts payments, not compounding periods. So that's because things go together. So if, for example, let's say a 5-year mortgage, monthly payments, and J2 equals, let's go with 9%. N is going to be 12 times 5, 60 payments. And it's not going to be 2 times 5 equals 10 compounding periods. And that's because your calculator is actually changing that interest rate. I'm going to put a big X on this so that everybody knows that that's not there. Question 4. You want to have accumulated $4,000 for your European trip 4 years from now. If interest is 6.4% compounded monthly, Find the size of the quarterly deposits required for 4 years if deposits are made at the beginning of each quarter. This time we're going to go through our question and fill out what's happening as we go. You want to have accumulated. Well, to me, that makes this seem like an accumulation. And it is. We are saving money. When we save money, start with something positive, add something positive, end up with something negative. What we want to accumulate is $4,000. Think of that negative as in I'm going to withdraw it 4 years from now. I'm going to put 4 years under N, but we're going to have to change that once we find out what PY and CY are. If interest is 6.4% compounded monthly, 6.4 compounded monthly, find the size of the quarterly deposits. Well, PY is 4. Since those two are different, we're working on a general annuity. Find the size of the quarterly deposits required for 4 years if deposits are made at the beginning of each quarter. Well, beginning, to me, that looks like due. And it is. It's begin on. So what I'm going to do is put begin on. It doesn't say how much money I started with, so we're going to assume we start with nothing. Our payment, well, that's what I'm going to compute. So we have an accumulation that is a general annuity due. Let's go through the entry on this, and I'm going to show you how to turn begin on in the calculator. First, let's go into our PY and change it to 4, but now our CY has changed, so set it to be 12. Again, I like to scroll around the arrows a few times and make sure that everything is set the way I want before I clear out. N was 4 years, so N is going to be 4 years times 4 payments per year. That means we're making 16 payments. 16. The interest rate is 6.4. The present value, well, we start with nothing. Payment, that's what I'm trying to find, and my future value is $4,000. I'm making that a negative because I will withdraw it. Begin. Above the payment button, you'll see BGN. That stands for begin. So we go second, payment, or begin, and then we press second, set. That turns begin mode on. When begin mode is on, you'll see that begin in the top of the calculator. To turn it off, you do the same thing. Second begin, second set. That set toggles through begin and end. So here we've got begin. Now all I have to do is compute that payment. And the payment is going to be $217.70. I'm going to write that down. Second, payment, begin. Begin lives over the payment because it refers to the payment. Second, set, which lives above the enter. You'll be doing this a lot. End is the default mode. And you can see that when we have end, nothing shows up here. When begin is on, that makes it an annuity due. 5. You deposit $1,000 at the end of each quarter into an account that pays J4 equals 10%. Find the future value in 1 year. Let's go through this question. We are depositing $1,000, so our balance is growing. And we're depositing that at the end of each quarter. End or begin off. Let's draw that in. We put $1,000 in at the end of each quarter. And at the end, how much money do we have? We're going to assume we start with nothing. J4 equals 10%. 4, 10, and we're making quarterly payments. First of all, we're accumulating money. Our balance is growing. We're making our payments at the end of the month, so this is an ordinary annuity. Finally, PY equals CY. This is just a simple ordinary annuity, same as we have had many times before. Look at my calculator. Note that begin is still on from the last thing I did, so I'm going to start by going second, begin, second, set, and clearing that, making sure it's not on there. Then I'm going to fill in everything in the calculator, making sure that PY and CY are the same. N is 4 quarters in 1 year. 10 IY, our payment is $1,000. And we started with nothing, and I'm computing how much money we have at the end. I get a future value of 415.252. That's how much money I have at the end. Let's do it again. B, you make the deposits at the beginning of the quarter. How much money will you have at the end of the year? I'm going to draw this in and show you that it looks very similar, except one payment comes in right now at today, and the last payment comes in at 3 quarters, and we're still trying to find the future value at 1 year. I'm still accumulating, but now this is an annuity due. It's still simple. In fact, everything else remains exactly the same as it was before. The only difference is this begin toggle. I usually write on to mean begin is on, off for end, but you can write begin and end, or due in ordinary. Everything's still in my calculator, so all I have to do is go second payment, sort. I have now set that payment wrong, $1,000 payment. Second begin, second set to turn it on. Now everything is exactly the same, and all I have to do is compute that future value, which is similar. Let's scroll down and write down our future value. $4,256.32. It's similar, but it's bigger. That's because our payments had a little bit more time to grow because I started earlier. How much money do I have in 3 months? What about in 3 months? This time I'm going to take my initial answer from A and see what happens 3 months after the scenario from A ends, so at the 5th quarter. So I'm going to just use my equations here instead of the compound using the calculator, but you can do whichever you would like to do. So we've got $4,152.52, and we're going to invest that at 2.5% per quarter. That's 10 divided by 4 for only 1 quarter. When I run that through a calculator, I end up with $4,256.33. This is round off error from the fact that I rounded this $4,152. In fact, when you take your ordinary annuity and multiply it by 1 plus I, you get the same value as the annuity due. Question 6. You begin a savings plan. At the beginning of each month, you deposit $250 into an account that pays J12 equals 9%. How much money will you have after 5 years? This is a savings or accumulation. I'm going to go ahead and put in my signs. Present value and payment will be positive. Future value will be negative. At the beginning of each month, begin is on. That makes this an annuity due. You deposit $250, balance is growing, and it's the beginning of each month, so our payment is monthly, into an account that pays J12 equals 9%. J12 equals 9%. PY and CY are the same. That makes this a simple annuity due, and it's an accumulation. How much money will you have after 5 years? Well, 5 times 12 is 60. We make 60 payments. It doesn't say anything about starting with money, but it does ask how much we'll have at the end. Notice that my calculator says begin already. So I could change that if I didn't want it. Second begin, second set, but I want the begin to be turned on. Let's go into PY and set it to be 12. Check that CY is also 12 and clear out. 60 is N, 9 is IY, 0 is present value, 250 is payment, and I'm going to compute the future value, which is $18,997 and 45 cents. So I have $18,997 and 45 cents. Let's see how much interest we made. That's going to be money out, how much money we took out, minus how much money we deposited. So when I put this in, I took out $18,987.45, and we put in 60 payments of $250. So 60 times 250, well, that was $15,000. Which means that we have $3,997.45 that we've made in interest. We looked at a lot of different types of annuities today. We've seen annuities that are accumulation and amortization, annuities that are ordinary, and annuities that are due, as well as simple and general annuities. I'm going to conclude by writing in all of our calculator things again. PY counts the number of payments. CY counts the number of compounding periods. The important thing here is that N is going to be PY times years. So I'm going to put that in a different color. N counts payments, not compounding periods. When we have something like a JM, we put that in IY, and the M is the same as the compounding period. When these things are the same, that's called simple. And when they're not the same, we call that general. Present value, I like to always make it positive. Our future value then can just go ahead and be negative. Our payment is going to be positive when our balance is growing and negative when our balance is shrinking. And that's going to be an accumulation or an amortization. We can do this opposite, minus, minus, plus. And then this would end up being a plus. I'm going to go ahead and say there is an exception to this, but in general, present value and future value tend to be the opposite in the simple situations we go over in this class. Begin. When begin is on, it's an annuity due, and when begin is off, it's an ordinary. And when it's off, we call that end mode. You can see there's an end showing up on my calculator. Again, when we do an annuity, we always look, is it an accumulation or is it an amortization? Is it ordinary? Is it due? Is it simple or is it general? These are the three questions we ask ourselves when we start doing an annuity problem. Lesson 14, Deferred and Back-to-Back Annuities. Today we're going to do a series of two-step problems. These problems are going to have two parts to them. In some of them, the first part is going to be a compound interest problem. We call that a deferred annuity. And in some of them, the first and the second are both going to be different types of annuities. We call those back-to-back annuities. Let's jump right in with a problem. You plan to retire in 21 years. You will need 25 annual payments of $30,000 with the first payment to be received in 21 years. Interest is calculated at 10% effective. And this is, of course, an approximation because interest rates won't stay the same for 46 years, but we usually pretend they will in order to do calculations. A, how much money should we set aside for our retirement? I've started this with a timeline and I've already drawn it in. It has two parts to it. One, let's go to 21 years when our first payment happens. And then it keeps on going until our last payment, which is going to be at 45, because that will give us 25 annual payments. One at 1, one at 2, all the way to 25. Today, we're going to put some money in. So let's put some money in this today. And then I'm going to circle this because this is a very key point. We're going to invest it for 21 years. And then we're going to start pulling money out. So we have two problems here. Problem one is a compound interest problem. And problem two is an annuity. It's not just any type of annuity, it's an annuity due because it starts right at the beginning at 21. And it is possible to set this up so that it starts at 20, but in this case, it seems to make more sense to start at 21. So compound interest. Let's look at our values. We start off with, I don't know how much money. I make payments of, well, nothing because it's a compound interest problem. At the end of the day, I have some money. I don't exactly know how much. Let's change this color here to make it more exciting. At the beginning of this annuity, which is exactly at 21, I have however much money I saved in the first compound interest problem. My payments, well, those are going to be $30,000, and I'm going to make that negative because we can see that they're coming out of our account. I'm going to start writing 30K so I don't have to write a bunch of zeros. And our future value, well, that's going to be 0. Unless we're told otherwise, always assume that we have no money left at the end of one of these problems. So we have to solve these one at a time. And here we have two unknowns here, 2. And here we only have one unknown. So we're going to start with 2 because we only have the one unknown. So let's start by drawing in our calculator buttons. Okay, all nicely drawn, very fast. We're going to start with number 2. So I'm going to put a 2 in here. In this whole problem, our PY and CY are both 1. That makes these a simple annuity because everything in sight is annual and our interest rate is 10. This annuity goes on for 25 years or 25 payments. I want to figure out what the present value is. My payment will be $30,000 and my future value is 0. It's an annuity due, so I need to make sure that begin is turned on. I usually like to do that first. So let's turn that on here. And now let's put in the rest. PY and CY are both 1. Again, I always check that they both entered properly. Interest rate is 10. Present value is what I'm going to find. Did I get that 25N? Yep, I have these in the wrong order. I'm going to go ahead and fix that because it's going to confuse me. Better. IY, present value, our payment is $30,000 negative, and our future value ends up being 0. So we're going to compute that present value, and we get $299,542.32. What that means is the day we retire, I'm going to say we, could be you, we need to have saved a lot of money. $299,542.32. That could be around $30,000. So let's look at saving that much. So what we're going to do now is part 1 of our problem. So part 1, let's just scroll up to look at that, is a compound interest problem where I'm trying to figure out how much money to put in, 0 payments. Begin doesn't matter. When the payment is $0, it doesn't matter if I put $0 in my account at the beginning or the end of the year. So I can just leave that alone. We know that N is 21. Future value is $299,000. The easiest way to do this is while it's showing up on my screen, I press that negative sign, and now I just press future value, and it's stored in there. So let's go ahead and change everything. Begin doesn't matter, so I'm going to leave it. PYCY should stay the same. N is now 21. Our interest rate, recall IY is still 10. Our payment is 0. That's an important one. Remember, our future value has changed, so let's compute that present value, and we find out that we need to invest $40,000, $477.32 right now. If we do that, we put $40,000 in today, we will have enough so that we can have $30,000 a year for 25 years. So $30,000 per year. That is great. In part A of this question, we figured out that if we can save $40,000 right now, put that in the bank today, then we're fine to retire. The problem is I don't actually have $40,000 to invest. So instead of making one payment right here at the beginning, what we're going to do is put 21 payments in starting today. So I'm going to put in a payment every year and save slowly over 21 years so that I will be able to get that $30,000 at the end. Let's look at this again as a two-step problem. Step 1. This is now an annuity due. And it's an accumulation because we're saving. It's also still going to be simple because J1 is still 10% and PY is going to be 1 for everything. So everything in sight will be simple. So now I've got an annuity due that is an accumulation. I'm not going to save any money at the beginning, but I am going to start putting in payments. And at the end, I will have, well, we actually know that. So put a pin in that for 1 minute. Let's look at number 2. This is the same thing. And I'm going to write here that this is an amortization. Often these back-to-back problems are one accumulation followed by an amortization. A retirement scheme has us save, save, saving, spend, spend, spending. So we know at the end we have nothing. We know what the payments are. They are $30,000 and they're negative because it's an amortization. And actually we know what the money is that we should be saving. It is $299,000. Because we've done that already. So that's really useful. That means that we've already done half this problem. In general, it's important to save all of our intermediate values. So if I go back to that future value, we're going to use that. So I'm going to store that in 1 just so I have it just in case. Even though we've already done the second annuity, I'm going to still rewrite this so we can see everything all together. Remember, it was a 21-year annuity. We were computing the present value. We were taking $30,000 out. 0 begin was on. We computed that and we got 299, etc. Then we're going to go ahead and do number 1. This is also a simple annuity. PY and CY equals 1. Now our N is still 25 and our interest rate is 10, but our present value is going to be 0, and we're going to be computing those intermediate payments. The amount of money we need is still negative $299,542, and begin is still on. So looking at this, it's almost exactly what we did last time, only we're switching the present value and future value. We can just go ahead and check our PYCY. We know that stays the same. N should still be 25. Our IY has stayed the same, but our present value is now 0. And our payment is what we're going to find. So future value is still negative $299, and you can see there that that begin is on. So I'm going to compute the payment. $4,254.70. That's not so bad. That's how much money we need to save annually, starting today. So let's write that down. So if we have $4,200 and we think we can come up with that every year, we will have enough to retire. Let's start looking at some interest. Let's look at interest. Instead of just part A, I'm actually going to start with B. Start with A. Our interest is going to be the money out minus money in. So we took out $30,000 and we did 25 of those payments. And we put in, well, we know how much we put in. We put in exactly $40,477.32. Note, nowhere do I see that intermediate $299,000. That's because I didn't actually withdraw or deposit that. I left it in the bank, so it doesn't end up being part of this interest calculation. 30,000 times 25, well, that's 750,000, and let's subtract 4477.32. Well, I've made quite a lot of interest there. 709, 522, and 68 cents. And that's because I have a lot of time. We have 45 years on this scenario. That's a lot of time to save, and we end up with a lot of interest, especially at 10%, which would probably be an average. In B, this is almost going to be the same, except now I'm still putting in that same 30,000 times 25, but I'm putting in 21 payments of 4,200. So looking at this, let's go back to 30,000 times 25. We're going to subtract 21 times 4254.7. And that leaves us with $660,651.30. Not as much as an A because we didn't put the money in the whole time, but still quite a lot of money. I'm leaving this last part up to you. I would like you to finish this question, noting that the answers are at the back, knowing that in this case, instead of making our payments starting today, we're going to start in 1 year. Our last payment goes in at 21, and our $30,000 payments still come out at the same time. In this case, put our last $30,000 payment. This is going to be an ordinary annuity. And the second one is going to be an annuity due. So the second annuity stays exactly like it was before, but this time the first one is an ordinary annuity. The answers are going to be, they're in the handout at the beginning of this chapter, and we will go over this in lab. You are saving money for your retirement. Starting in 6 months, and for 5 years, you invest $1,500 every 6 months in a mutual fund that pays 6% compounded semi-annually. After 5 years, the rate drops to 4.8% compounded quarterly, and you decide to deposit $1,000 every quarter for another 5 years. How much money will you have at the end of the 10 years? This is another back-to-back annuity, but in this one, they're both going to be accumulations because we keep on saving. We're never going to amortize or take money out of that account. That's good to note. In our first one, it is going to be every half year, and we're going to start in 6 months, 1 year, 1.5, all the way 4.5. So for every 6 months, we're going to start depositing money. I'm going to draw that in. we're going to deposit $1,500. And our last deposit is going to go in right at that 5 years. After this, it's going to drop to quarterly. So let's do a quarter, half, 3/4, 6 years, etc., all the way up to 10 years. And that's a quarter less than that, so 9 3/4 of a year. Here, we're going to be putting in $1,000 each quarter. And it's going to be at the end of the quarter because we're not putting it in twice at a time. When we're not told, we're always putting it in at the end. Let's look at our 2 annuities. 1, this is still an annuity, but because it starts 6 months from now, it's an ordinary annuity. Okay, we start with no money. We put in $1,500 every 6 months, and at the end, we have something. Let's look at the second one. Over here, at the beginning of the second 5 years, and this is the important time, we have some money. The present value of that second annuity is equal to the future value of the first, and this is almost always true in back-to-back annuities. Because this one starts at the end of the quarter, it's still an ordinary annuity. Now we have payments of $1,000, and at the end we have money. Looking over here, we've got 2 unknowns, future value and present value, so we can't do anything. Here we have only 1 unknown. That's why we're going to start with number 1. Okay, we're going to put everything in our calculator, and I'm going to start with 1. I like to label these so I know which one is which. In this case, the payments are semi-annual, and the compounding looks like it's semi-annual. And you can even write the compounding up here on the timeline if you think that makes things easier. J4 equals 4.8%. I think it does. So in here, I'm going to put 6%, and my N is going to be 5 years times twice a year, so 10. My present value, well, that's going to be 0 because I start with nothing, but we're putting $1,500 in. The future value, that's what we're going to try to find, and begin is off. So let's go through the calculator. I'm going to start by turning off the begin because this is an ordinary annuity. Now we're going to set PY. And you are welcome to fast forward if you're tired of watching me put stuff in a calculator. Fascinating. 0 present value, 1,500, that's positive because we're accumulating, and I'm going to compute our future value. So $17,000-ish. I'm going to write that right in. I'm going to store this because I might need it for later. I don't know. Well, I personally do, but you wouldn't know. It's always good to store those intermediate values. Now let's start setting up annuity number 2. This one is quarterly payments, but also quarterly compounding, and our interest rate is 4.8. It's going to be 5 times 4, so we've got 20 payments, and our present value is $17,195.81. Payment is $1,000. Future value is a compute, and our begin is still going to be off. So let's input things into the calculator. Make this positive. Now that's the present value. Starting at the side, I have PYCY is 4. Our N is now 20. Important. 4.8 is the interest rate. The present value we've done. Payment is $1,000, and the future value is what we're trying to compute. We end up with an answer of $44,000. $44,281.83. That's how much money we have. Let's pretend we take that out of the bank. Let's find out how much interest we made. So our interest is money out minus money in. In this case, we took out our savings, our life savings of $44,281.83. We put in 10 payments of $1,500 and we put in 20 payments of $1,000. Running that through a calculator, we've actually made quite a lot of interest, which is $9,200. So $9,281.83. Follow along on your calculator to make sure you get the right answers. Question 3. You would like to save enough to take a 2-year sabbatical in 15 years. Starting today, you make your first of 180 monthly deposits of $500 into an account that pays J12 equals 9%. Write that in here. 1 month after making your last deposit, you take your first of 24 monthly payments. Find the size of these payments. This is, again, a back-to-back annuity problem. So I'm going to reiterate the important things that we need to do. One is we have to draw a timeline, and having a focal date and circling it right here on it is going to be really important in getting this right. We're going to take the time to identify our annuities and store all of our intermediate values, and an important thing is to pay really close attention to the begin and end on our calculator. So let's start by drawing in things. First of all, 15 years is when we start, and it's a 2-year sabbatical. And we are going to start making monthly. Everything is monthly. And that's okay. We can just put in little dashes for months, and we know what that means. Starting today, I'm going to make my first payment. So I'm going to say that this is right away, and it is $500. If I start today, then I'm going to end 1 month before 15 years from now. That's going to give me the right number of payments, which is 180. Because I'm starting right away, I'm going to note that this is an annuity due. And that's annuity number 1. For annuity number 2, well, 1 month after I make my last deposit, that's going to be exactly at 15. I'm going to start taking out my 24 monthly payments. And those, well, I don't know what they are, but I do know that at the end of this, I'm not going to have any money. So this is also an annuity due. Let's look at the steps of these. And these are both simple annuities. And what we have is we have an accumulation. We accumulate, save, and then we spend. Knowing this is going to get our signs correct. Starting, well, I'm going to assume, because I didn't say anything about this, I have no money at the beginning. We could have started with something, and then it would be as easy as putting that number in. I'm going to start making payments of $500, and at the end, I will have something. Second annuity. I'm going to start with, well, that same something I had last time, because those are at the same points. This is 2. My payment in this annuity is going to be something. And my future value at the end will be 0, because I'm going to spend all of that money. 2 unknowns here, 1 unknown here means I should start with 1. You'll probably get sick of drawing the same thing out over and over again, but I found when I don't write it and when I don't do it in the right order, which I occasionally do, I start making mistakes. So putting everything in the calculator, writing it out really helps us not make mistakes. I'm going to start with annuity 1. Everything here is going to be monthly. My N, well, that's 180 because it's written in there, and that's 15 times 12. The interest rate is 9 for the entire time. Start with nothing, and I put in $500, and then we're going to figure out the future value. Begin is on. I'm going to go ahead and start filling in the second annuity as well. And I like to sometimes set these up before I even start, so everything is very quick. 24 monthly payments. My present value is going to be this number. I'll put that in there. And here, that's what I'm going to be computing, and I'll end up with nothing, and it's still an annuity due. Starting with this. And again, fast forward if you're really good at putting stuff in your calculator. 12, I check that that's correct. N is 180, IY is 9, present value 0, payment is $500, future value is what I'm computing, and begin mode is not on, so let's go to set. Make sure that begin mode is on. Now I can compute the future value, and what I'm going to end up with is, let's use a different color, why not? I apologize if you are colorblind and cannot see all my beautiful colors. It's okay. $190,621.91. I'm going to store this again, store 1, because I might need it later. But I'm also going to just go ahead and plus minus, put that right into present value. That's very useful. Okay, let's do the second annuity. 12 should stay the same, but N is now 24. I usually press recall and then IY to make sure that it's correct, and then I haven't done anything. Recall present value is correct. Recall payment, well, I don't even know about payment, so I'm going to leave that alone. And I'm going to make sure that my future value is 0. Begin is still on, so compute the payment. I get $8,643.68. So we need, actually not we need, we will have $8,643.6869 per month. That's a pretty good amount to live off of. Let's look at part B. I've actually just copied everything we just did, and I'm going to redo it, except now 2 months after making our last deposit. That means instead of having a payment come out here at 15, our first payment comes out 1 month later, and our last payment comes out here. What does that do? Well, that makes this an ordinary annuity. Let's erase that, and I'm going to use another color. This time, it's an ordinary annuity. What else changes? The first part doesn't change at all. Still in amortization, everything is the same except for this begin right over here. All we're going to do to make this different is change this to off. I'm going to highlight these changes. That's it. All we've done here is change one button. That means that everything is already properly stored in my calculator. So if I go to second, begin, second, set, and turn that begin mode off, and now I'm going to recompute that payment with everything identical, I get the correct answer. We will have $8,708.51 per month if we start 1 month later. So these questions are almost the same. The only difference was in that begin on or begin off. Let's summarize what we've done today on back-to-back and deferred annuities. These are two-step problems. In order to get them correct, we are going to have to take our time and write things out. Having graded about 5,000 tests testing this, draw a timeline. When people don't draw a timeline and take the time to label it correctly, they usually make a mistake. Circle that focal date. That's an important day. Let's identify those annuities. And those annuities, the first one can often be a compound interest problem. We do it in the same way. We just set payment equals 0. So we look for the problem with only one unknown. And that's the one we're going to solve first. If we have something with two unknowns, then we should solve that one second because we won't be able to do it. An important point, we're going to store those intermediate values with their decimals because we keep those. Unless we're taking money out and putting it in a different bank, we can carry all those decimals with us. Pay really close attention to begin and end. So write that down on your piece of paper, put that in your calculator. Make sure you do that. Think about your counting. And at the end of the day, an important thing is to remember that interest is the money you withdraw minus the money that you put in. That's the same as money paid minus money borrowed. Out and in are just expressions. But if we're borrowing money, we usually write it this way. Intermediate values don't go in here. That's an important thing to note. And actually, I'm going to write one more thing. Round your payments. Because we're going to put in a bunch of payments, but we have to round to the nearest cent because we can't put in a half a cent. Lesson 15, bonds, perpetuities, and stocks. We're going to start by learning about coupon bonds. And I should put a date on this. When governments and companies want to raise money, sometimes they issue things called bonds. This bond has a face value of $1,000. And I'm going to explain what that means as we go. What that means is you buy, actually I'm going to write down the coupon rate is 6%. Okay. You buy the bond for $1,000 for however long the time period is. Every 6 months, and bonds tend to be semi-annual, you get a coupon payment. Or your interest is calculated and sent to you. So we're not compounding the interest. The person who owns the bond is getting that interest. I've written this as an old-fashioned coupon bond where there's literally a bunch of coupons, and when you pull them off, you get money. At the end of the time period, and that here is going to be in December 2025, you get your $1,000 back. So the money, the interest is being calculated every 6 months, and you get that. So this bond has a face value of $1,000, a coupon rate of 6% compounded semi-annually, and it has a maturity of 10 years. That means that for 10 years you get these payments. What's the semi-annual coupon payment? For this, we're just coming up with the interest after 1/2 year, or the simple interest. So the coupon payment is really the interest accrued in one period. Or here, it's going to be 6 months. And I'm going to say that often bonds are semi-annual. So our interest here is going to be I equals PRT because we're just using simple interest. Our interest is going to be the principal. That's $1,000. The rate, well, that's just going to be the periodic rate. So if it's 6% divided by 2. And T, well, that's where that divided by 2 comes from. So 6 months for 1, or is it 0.06 times a half? That's $30. And that's where I got this $30 up here. So every 6 months, you get a check in the mail for $30. let's look at this bond in a timeline. So this goes on for 10 years, and every 6 months we get a payment. So I'm going to put in a payment of $30. $30. Every 6 months, starting from there, we get $30. At the very end, we still get $30, but we also get $1,000. This is in fact an ordinary annuity. How much did we pay for this? Originally, we paid $1,000, the face value. The interesting thing here comes when we don't keep it for the full 10 years. Bonds are a financial instrument, just like stocks, and we can sell them on the open market, on the bond market. In this case, it's usually useful to calculate what we call fair market value. So, fair market value, how much somebody else would pay for the bond. So right now, it's 3 years later. So that means I'm just going to write in 7 years are left. Anybody can go and buy a similar bond, the same type of bond, at 8%. So how much do you think somebody would pay for our bond, which is in fact at 6%? So this is what we're going to be computing. So looking at this, we have the exact same timeline, except for the fact that we only have 7 years remaining. 3 years have already happened. So the timeline here just has to do with the fact that there's only 7 years left. Looking at this, this is an ordinary annuity. Ordinary, begin is off. It's also simple because it looks like our interest rate is 8% compounded semi-annually, and our coupon payments are semi-annual. That makes this a simple ordinary annuity. I'm going to go through and calculate all of this, and I'm going to note this IY isn't 6 anymore. It's changed to what the market is. So that's important. You're using your new interest rate. N, that's how many coupon payments are left. And that is, well, we have 7 years of twice a year payments, 14 payments left. Present value is what we're trying to compute. That's going to be our fair market value. The payment, well, that was that $30. And future value, that's the $1,000 we get at the end. This is important. These two are going to have the same sign. You can make them both positive or both negative, but they have to have the same sign. I'm just going to write down some notes on this so you remember. Payments left. Present value is fair market value. That's what we're computing almost always. This is our new rate. The payment, that's the old rate times the face value or future value. It's kind of nice that the face value and future value both have the same initials. I would say ordinarily, this is an ordinary annuity. I can't see very many opportunities where it isn't. And I am going to put in a little note here that these have the same sign. They're either both positive or they're both negative. And you can choose which it is, but they have to be the same. So let's just bump that in. So we go into PYCY, make sure it's 2, 14, 8%. Our payment is $30 and $1,000 is the future value. So now all I'm going to do is compute that present value, and I get that the fair market value is $894.37. It's less than $1,000. And that's because anybody can get $40 payment. That's 8% divided by 2 times 1,000. If anybody can get a payment of $40, why would they want our payment of only $30? And the answer is only if the price is discounted. Let's try one more. How much is the bond worth if you sell it in 4 years And the interest rate for similar bonds is 5% compounded semi-annually. That means anybody buying a similar bond has a coupon payment of $1,000 times 0.05 over 2, which is $25. So our $30 bond should be worth more now. 4 years means 6 years left, which makes our N 6 times 2 means we have 12 payments. Again, our PY and CY are 2. Our interest rate has gone down to 5. Present value is what we're going to compute, and our payment and future value stay the same and still an ordinary annuity. So all I'm going to change here, because I have everything already in my calculator, is 12N 5IY. And we can always go recall and then press something to make sure it is correct. Now I'm just going to recompute that present value, and I find out that the fair market value has gone up. It's actually $1,051.29, which makes sense. We've locked in at a higher rate. That makes it more valuable than bonds that are selling right now. A perpetuity is an annuity that goes on forever. How does this work? This works by paying out only the interest, which leaves the principal untouched. Our payment here is going to be, just like the bond, the amount of interest accrued in one period. So if we have a periodic rate of I, as we often do, and we have a principal of PV in the bank, we end up with this. Payment equals PV times I. And I'm just going to note that this is just like a bond payment. And just like a bond payment, that payment is coming out of the bank. So what we're doing is we're looking at the interest that accrues every month or year or 6 months. We're taking all that interest and we're spending it. I'm going to take this equation and I'm going to solve for PV by dividing both sides by I, remembering I can't be 0 or this doesn't make any sense whatsoever. Here I've got two important equations, and you will have these on tests. These are called the ordinary perpetuity formulas. Okay. A wealthy BCIT alumnus has decided to make an endowment to the School of Business to fund an annual scholarship for the best business math student. She will donate $15,000, and the funds will be invested at 6.6% effective. How much will the annual scholarship be? The first scholarship's in 1 year. So we're going to deposit $15,000, and then every year we're going to take out the interest. When are we going to stop? Never. This goes on in perpetuity, which means forever. We've got J1 equals 6.6%. Well, that's the same as a periodic rate of 6.6% a year. Here, using the formulas from above, our payment is going to be $15,000 times 0.066, which gives us $990. B, if they decide to give out the first scholarship today instead of next year, how much will the alumnus have to donate to keep the exact same scholarship from Part A? I'm going to draw this in one more time. Now we're going to put in something, and immediately we're going to take out $990. This is a 1 year, $990, etc. Forever and forever in perpetuity. This is a different type of perpetuity. It's called, unsurprisingly, a perpetuity due. Perpetuity due starts today. So the first payment is immediate, just like with an annuity due. So we are going to need how much money? Well, we need from our earlier one, this much to start in a year. Sorry, it's payment over I, plus one extra payment of $990 for right now. Let's put that in. So we're going to need $990 over 6.6% plus $990. That is, well, it's $15,000. That's what we needed before, plus $990. So $15,990. That's the perpetuity due formula. I'm going to rewrite this one. Present value equals payment over I plus payment. Moving this around and solving for payment, which I encourage you to do as an algebra exercise, but you don't need to. If you try to solve this for payment using some factoring, you end up with this. Payment equals I times present value, or present value times I, divided by 1 plus I. You're taking it back one period in time. These are the perpetuity due formula. So let's just write that down. And using these, we can do everything we want. If she decides to keep her endowment at $15,000, how much will the annual scholarship be if the first scholarship is today? So this is asking us to find payment of a perpetuity due. So that's going to be this equation over here. I'm going to write this down. I times present value divided by 1 plus I, which is 0.066 times that $15,000 divided by 1.066. Let's actually look at this. 15,000 times 0.066. That's that 990 we had before, and we're going to divide it by 1 year of interest. That gives us $928.71. It's going to be less because we have one less year to accrue interest. The Win It All lottery offers you two choices for a grand prize. Either a cash prize of $1.5 million or $7,000 per month forever with the first payment today. What should you select if interest is 6% monthly? So we've got two methods here. I'm going to use the first method and then I'm going to try the second one. Let's find the PV of both options. Well, option 1, so let's go A, $1.5 million has a PV of, well, that's $1.5 million. It's just getting that money up front. Now let's look at option B. That was $7,000 a month starting today. That is an perpetuity due. And our I is going to be, well, 6% monthly is 0.5% per month. And our payment is $7,000. So our present value is going to be payment over I plus payment, which is the same as $7,000 divided by 0.005 plus $7,000, which gives us, you can do that on your calculator, follow along. I've done this already, and it gives me about $1.4 million. So I don't know about you, I choose this. I'd prefer to have $1.5 million right away than something that has a present value of only $1.4 million. But let's try this again. So let's do method 2. If I invest that $1.5 million in a perpetuity due. So if I took that $1.5 million and I put it in the bank and I pulled out money every single month forever, how much money would that be? So if we took that cash and put it in, this is kind of a stranger method, but the interesting thing is that we're going to end up with similar answer. So I'm just going to use this formula. I is still 0.005. My present value is 1.5 million. And I'm going to divide that by 1.005. So let's just do that over here. 1.5 million times 0.005. And I'm going to divide that by 1.005. And it looks like I get a payment of $7,462 and 69 cents. And this is better. So I prefer $7,400 a month to $7,000 a month. The important thing is that no matter what we do, A is going to be the better option. That's most of what there is to perpetuities, but perpetuities could get complicated. We can get deferred perpetuities. That means perpetuities that start maybe 10 years from now or after an annuity. So we can combine perpetuities with an annuity or a compound interest problem to get something way more complicated. We can also get general perpetuities. So when PY and CY are different, this becomes really complicated. So what we're going to do is do a calculator cheat. It's a cheat or a trick because our calculator isn't really supposed to do this, but we can make this work by pretending that n is very big. So really, we want our money to last forever, but if we made our money last for 1,000 years, we're going to be okay. The round off between this is almost nothing. So let's do part C again. In part C, I'm going to do the calculator buttons. So in part C, we had something where the annual rate was 6.6%. Our payments were annual and our compounding period was annual, but we could change that. I'm going to make this last 1,000 years. Putting in a bunch of 9s will also work. If your n is too big, you might end up stalling out your calculator. So 1,000 years seems to get pretty good results. Our present value was $15,000. Our payment, that's what we were computing. We're pretending we run out of money. That's the important thing, and it's due. So here is an important thing. It's not going to be 0. We're pretending it's 0. Everything else is the same. I'm going to go with 1,000 years. So if we had PY was 12, N would be 12,000. So just multiply your PY by 1,000, and that seems to not jam out the calculator. So let's go through this, make our PY and CY 1. N is 1,000 years. 6.6 is our interest. Our present value was $15,000. Our payment was nothing, and our future value was 0. And begin is on. So let's compute what the payment was. And this was question 1, part C. That payment was going to be exactly what we got, $9.28.71. Stocks, or dividend stocks. This is a coupon bond basically that just goes on forever. So this is a combination of bonds from the first part of this lesson and perpetuities from the second part. So I'm just going to totally simplify the stock process. Obviously, it's always more complicated. So to simplify, we're always going to sell right after we get a dividend payment. Why do we do this? That makes this ordinary. If I do it that way, then I'm only calculating ordinary perpetuities, and that's always going to be easier. 2. Now here's the big if. Assume that our dividends are a constant number. And this is a really big if. If you guys know anything about the stock market, you know that stocks go up and down. The dividends will change as the company does better or worse, because dividends are part of the profits, and that is not going to be a constant. But for the purpose of assessing fair market value, we say, hey, the payment that's going on right now will probably go on forever. At the easiest, stocks are really just the easiest, simple, ordinary perpetuities. You purchase some preferred shares that have a semi-annual dividend of $1.25. How much should you pay for the shares if the interest is 5% compounded semi-annually and the first dividend is in 6 months? This is going to be a simple, ordinary perpetuity. So our interest rate is 5% compounded semi-annually, or 2.5%. And this is a simple, ordinary perpetuity. One note, I've put in some semi-annual ones here to make it more similar to the ones that we did earlier. In general, stocks tend to be quarterly, so expect to see quarterly payments and compounding. So let's look at this. Our fair market value is the present value, which makes it payment over I. In this case, that's going to be $1.25 divided by 0.025, or let's work this out, 1.25 divided by 0.025, $50. So those stocks are worth $50 each, and every 6 months you get a check in the mail for $1.25. Let's try it again. You purchased the shares in question 4 for $50 each. I'm going to write in each. And then interest rate rises to 8% compounded semi-annually. How much would you make or lose? And here it's going to be per stock because we don't know how many stocks there are. Our new fair market value, as the stock market has changed, is going to be $1.25 over our new periodic interest rate. 8% divided by 2 is 0.04, which gives us $31.25. That's how much each stock is worth. So that means we have a loss. I'm putting in brackets here capital because this is a capital loss of 50 minus 31.25 per stock, or $18.75 per share or per stock. Why would I say capital? Because if I have actually held on to the stock for a while, I've gotten a bunch of payments, and we don't use those payments when we're computing the profit and loss. That's more for tax reasons, and I'm not going to get into that. Just know here we're only looking at the value, not of those dividends. How much money would you make or lose if the interest rate was now 6% effective? And we're just still going to assume the first dividend is in 6 months. That makes this an ordinary perpetuity, but it's no longer going to be simple because we get payments twice a year, but we compound once a year. So now this is going to be a general perpetuity. Anytime it's general, we are allowed to convert that interest rate using interest conversion, but it's easier just to use the calculator. Again, future value is 0 and n is going to be 1,000 years, which is 2,000 payments. It's 2 times 1,000. And why do I do that? Multiplying by 2, it really does mean that the round off is less than a cent in almost all cases, and we don't get into trouble for using what's really an approximation method or a trick. Going into here, I'm going to start with my PY/CY, set my PY to 2. My CY has changed, so I'll make that different. I always like to scroll around there, make sure I did it properly. Our N is now 2,000, and our interest rate is 6. Present value is what I'm computing. $1.25 is the payment, and I need to make sure that I put in 0 for the future value. Compute the present value, and now I get a fair market value of $42.28 per share, which is still a loss because I bought them for $50, so I'm taking a loss, and that's going to end up being, well, let's make this negative and add 50. $7.72 per share is our loss. Lesson 16, Mortgages and Amortization, Part 1. The key to today's work is that balance is decreasing in a mortgage. That's why it's called amortization. It's when we are paying off a loan. Conventionally, mortgages are paying off a building or a house, but this could be anything. Paying off a car loan, an RV, a boat, any makes sense. What we're going to do first is go over some of the vocabulary. First, we have balance. How much do we owe at a given time? Next, we have principal. How much of the mortgage we have paid off. With those two, we have this formula. The balance, that's how much we owe right now, plus the principal, how much we've paid off, is the amount of the original mortgage, how much we borrowed originally. Next, we have interest, and we should be very familiar with this one so far. The interest is all the other money we paid, so we have all the money we paid minus the interest is the money we borrowed or original mortgage. For example, I bought a house that cost $600,000 with a down payment of $100,000. I've made $200,000 worth of payments, and today the balance is $450,000. The original mortgage was for $500,000 because $100,000 was money I paid in cash, and it's not part of this in any way. So principal paid is going to be $50,000 because it's worth $450,000 today. I'm going to use K for 1,000. That's how much principal we've paid. Interest is the rest of the stuff. The interest that we've paid is going to be $150,000. Finally, the balance today, well, we know that. That's $450,000. I'm going to put some abbreviations in because our calculator uses these. Balance is BAL, INT is interest, PRN is principal. And the original mortgage, I'm going to call that the PV because it's the present value of our equation. More things to talk about. We've talked about this word before, but we have to redefine amortization. The amortization is the full length of the loan, typically 20 to 25 years. So that's over the entire lifetime. This is different than the term of the loan. The term is the length of time that the interest rate is fixed and the payments are fixed. We usually say it's between 3 and 7 years. It's almost always 5 years. Over this term, you know what your payments are and you've locked in at an interest rate. At the end of a term, the interest rate could change, and odds are it will change. Let's start with an example. You've just purchased a new house and taken a mortgage for $100,000. The interest rate is 12% compounded monthly, and you will make payments for 25 years. Find the size of the monthly payment. So here we're going to assume that the amortization is 25 years, and so we're going to work out our payments as if we're paying for 25 years. We know, though, that our term is probably shorter. After 5 years, interest rates will have gone up or down, depending on what's going on in the world. So let's fill out our calculator. Our mortgage is for $100,000. I like to make my present value positive, but some people really like to make them negative to show that they're borrowing money. Either one is fine with me, as long as your present value and your payment are opposite signs. Your future value, though, should always be 0, because when you pay off a loan, you pay it off completely unless you're told otherwise. With a mortgage, any money you pay at the beginning is considered part of the down payment. So we're always going to treat this as an ordinary annuity. In this case, our interest rate is 12% compounded monthly, and we're going to make payments. Let's assume those are monthly payments because that's typical, for 25 years. So 25 times 12 is 300 years. In general, you're going to see that mortgages in Canada tend to be general annuities, but for now we're going to stick with something fairly simple. So let's work this out. Start with PYCY. Make that 12, already seem to be there. 300 is our month. Our interest rate is 12, high interest rate. We've borrowed $100,000. That's our payment, our present value, and our future value is 0. So when I compute payment, I end up with this number. This is really important. You can't pay 22.4 cents. If we rounded down a little, at the end of 25 years, we'd owe the bank money. The bank is not okay with that. So with our payment, we're always going to round up. Sometimes to the next cent. And then our payment would be, and we're going to do this, negative 1053.23, or even next dollar. Sometimes we might even round up to the next $100. In this case, it says in the next cent. Cent is 2 decimal places. We're going to be using our calculator to do a lot of the work for us, so we need it to be correct. In order to do that, we're going to have to re-enter our payment. It's a really important step. $1,053.23. Press payment, and then press compute N. Now you'll notice I've got a negative N. That's because I forgot that negative sign on purpose, but still, if your N makes no sense, you know you made a mistake. Let's go back to that payment and make it negative. And when I recompute the N, now I should get something a tiny, tiny bit smaller. 994987. So you're looking for something that's a tiny bit smaller than 300, or your original N. That means you're going to make 299 payments of the same size and one itty bitty little payment that will be different. Let's talk about amortization tables or schedule. An amortization schedule is just a list of all the payments that you make, along with the balance at the end of that period and the principal and interest that are part of that. There were 3 methods of constructing these, and we're going to actually look at all 3. The first one we're going to do is by hand. The second is using the built-in amortization table in the BA2 Plus calculator. And thirdly, Excel or another computer program. Spreadsheets are wonderful for this sort of thing. So we're going to look at them all. So let's start by doing one by hand. And we are not going to do this whole thing because I, for one, do not have the patience. At the beginning, we owed $100,000. We put that here under loan balance. The interest that we paid on this was $1,000. I found that by remembering that I is 12% over 12 equals 0.01. So the interest of the first month is going to be the balance times I, which is $1,000. So I take that $1,000, let's work that out here. I multiply that by 0.01 and it says that, it was $100,000 times 0.01 and I owe an extra $1,000. So now I owe $101,000. I made a payment of $1,053.23. We already worked that out, which means that $1,000 of that was interest and $53 was principal. This plus this equals this. My new balance is then $100,000 minus the amount of principal I paid, $53.23. So now we owe $99,946.77. So I'm going to start off this row that way. 99,946.77. How much interest do I owe on that? Well, let's multiply it by 0.01. And it says I owe 999.47. I'm rounding here at every step. Normally, a computer is going to do this, and every bank has its own rounding procedure. My payment is the same because we have even payments in an annuity. I'm going to write that all down, all the same, which means the principal, well, if I make this negative and then add my payment, 1053.23, it looks like I actually paid off $53.76, leaving me with a new balance of minus, and then let's add how much we owed, 99946.77. And that is now we owe 99893 and 1 cent. Perfect. That is our amortization table. In order to find the balance of the loan after 3 periods, I could continue on doing this by hand. But that is tedious and frustrating. So we're going to move on to method number 3, and I'm going to do the rest of this with Excel. Using Excel. I haven't done anything too fancy here except copy over the exact same thing we had, but now into Excel. So I'm going to make sure that I have the correct interest rate. I have to convert this for Excel. So I'm going to say that if J12 is 12%, then I is 0.01. We started with $100,000 and that 1,000 was actually 100,000 times the interest rate. For you guys who are Excel aficionados, pressing F4 here means that we've fixed that so that interest rate stays the same for the whole problem. Enter. Our payment, that's fixed. And our principal, that's going to be, well, how much we paid minus the interest. And our new balance is going to be that $100,000 minus the amount of principal we paid off. Here, what I owe at the beginning of month 2 is what I owe at the end of month 1. So now I can fill down. So I'm going to take all of these and fill them all the way down so that I'm filling out the entire thing at once. One thing to be careful of is sometimes Excel will fill incorrectly. So I'm just going to make sure everything is working exactly according to plan. Once I do this, you can see that here I've got the balance at the end of the third period. So let's go back to our question and say that we have a balance of $99,838 and 71 cents. Let's do another method. So here what we're going to do is use the amortization schedule on the calculator. So above the present value is the amortization button. So second amortization. What I'm going to do is say, let's look at the third row. If I want to look at the third row, I say from P1 equals 3. That means the beginning of the third row. And I go 3, enter. To the end of the third row, 3 and enter. The balance is now everything else I'm going to read off. The balance is 99,838.71. The principal we've paid is negative 54,299, that's 30. And the interest that we've paid is negative 998.93. When we add these things up together, you'll see that they are exactly that $1,053.23 negative because our payment is negative. It's decreasing the balance. That's the same thing that we got via Excel. Well, we've already done part D here. The principal was $54.30 and the interest was $998.93. So now let's look at how much we paid in the first year. Again, we're going to do two methods for this, and I'm not going to do it by hand because that's a lot of work, which seems a little silly. So going back to here, I'm going to sum everything. The loan balance doesn't make sense to add, but I'm going to go sum, bracket, and then I highlight everything I've paid. That's going to add all those numbers up together. My payments, well, it looks like I've made $12,000 worth of payments. How much principal have I paid off? Well, all those add up together. And now my new balance would be this 9938. So let's make everything here bold because that will look a lot nicer. So if we look here, you can see that at the end of year 1, then we have the balance is 99,324.91. That's the balance at the end of year 1. How much interest did we pay over the entire year? We paid $11,963 of interest and we only paid off $675 worth of principal. That's what happens when we have a very high interest rate, 12%. So how much did we pay in the first year? In the first year, we made 12 payments of $1,053.23. And you could see that in our Excel. So let's clear out of this menu. 12 times 1053.23. We made $12,638.76 worth of payments. So now let's look at our amortization schedule on the calculator. So second, amortization. When I'm doing the entire first year, that says from the beginning of the first month, so let's change that to 1, to the end of the year, the end of the 12th month, P2 equals 12. That's 1 year. Well, how much did we pay? Our balance, that's part H, was 99,324.91. Our interest was a lot, again, 11,963.67, and the principal we paid off was $675. Looking back at our Excel, you can see that this is exactly the same. The principal paid $675.09. Those are the same numbers. Balance $99,324.91. Same thing. And when we go to the interest paid, that's going to be $11,963.67. So again, we're getting the exact same answers no matter which method we use. How much interest did we pay in the third year? The easiest way to do this is the amortization table built into our calculator. The third year starts in the 25th month and it ends in the 36th month. That's because the second year ends at 24. So the next one starts and we say at the beginning. So let's go up here. So P1 must be 25. P2 is 36. That's 3 years. So over those 3 years, we paid less interest than we did in the first 2 years. In the first year, but we still paid $11,781.58 worth of interest. Finally, let's find our last payment. So what I mean by that is we have 299 payments that are exactly $1,053.23, and we have one littler payment. The more we round, the more different that is. There's several different ways that we can find this. I'm going to call this the harder method. That's find the balance at the end of the 299th month. Add 1 month of interest. This is actually not that bad if we do it in Excel. That's the harder method. Easier is to use our calculator. So pretend we overpaid. And use P2 equals 300. It is going to be much easier if I just show you. Let's go into our amortization. And P1, it doesn't matter what P1 is because I'm only looking at the balance. But let's only look at that final month. So P1 is 300, P2 is 300, that last month. And now I'm going to look at it. Balance is negative $11.01. That means we overpaid by $11. Had we paid $1,053.23, we would have overpaid by this. So we really should have paid, well, that regular payment minus $11.01. Let's do that. So that's already negative. So if I just say plus 1053.23, I should have paid $1,042.22. Let's do that again with Excel because Excel is actually a really good method for. So all I've done here in Excel is instead of putting in that total, I just copied it down one more month and then another month. Going to the end, and we could hide all those rows, which might be a smart thing to do. At the end of the 299th month, I owe $1,031.91. Let's just pull these down a little bit more. So I owe $10.32 worth of interest. That means that I should only make a payment of $1,031.91 plus $10.32 or $1,042.22. Pulling these down a little bit more, you can see that now I owe no money at the end. That's the same answer we got before. Alternatively, if I just copied what I had before and this changed up to 1,054, make that 1,053, you can see that I would have overpaid by 1 cent. Either way, this is the answer for the final payment. Let's end with a little bit more vocabulary because you'll see these if you start looking at mortgages or doing your own research. A fixed rate mortgage is one where the interest rate stays the same for the entire term, typically 5 years. The opposite of that is called a variable rate mortgage. In a variable rate mortgage, the payment is fixed, but interest varies according to the prime rate that's fixed by the Bank of Canada. In general, a fixed rate mortgage is very stable. It's safe. You know exactly what will happen at the end of the 5 years. A variable rate is risky. If interest rates go up, you could end up owing more on your mortgage. But if interest rates go down, well, that will be better for you because you will owe less. Then we've got the closed versus open mortgages. In a closed mortgage, if you try to prepay or pay off your entire mortgage or change your payments, there will be a penalty on that. So even if you sell your house mid-term, there's a penalty. In an open mortgage, you can do whatever you'd like. You can make extra payments. Sometimes you can make smaller payments if you need. You can pay off the entire mortgage whenever you'd like. Typically, because you have a lot more freedom in this mortgage, you might have a higher interest rate. Finally, I've said this before, the down payment is not part of your mortgage. It's the money that you pay right away. I'm going to say that a very typical one is 20%. It can be more or less. In Canada, if you have at least a 20% down payment to not borrow that money, then you don't have to pay what's called mortgage insurance, where you're taking out an insurance policy on the mortgage, and that goes to the CMHC. That's a Canadian institute. 20% means less fees, 15% you pay more fees. Lesson 17, Mortgages and Amortization, Part 2. We're going to jump right in with a problem, but this time it's going to be a general annuity as Canadian mortgages tend to be. Banks will apply the 30% rule. No more than 30% of your gross income may be used for your mortgage payment. If your gross income is $3,333.33, you're looking for a 5-year term on a 25-year amortization, and banks are charging J2 equals 6%. Find the maximum size of the payment and the maximum mortgage. What this means is that the size of the mortgage you can get really depends on your income. Banks are going to evaluate several factors. One of them is your income, and one of them is your debt to credit ratio, how much other debt you have and how much access to credit you have. If your gross income is $3,333.33 per month, and we can use 30% of that for a mortgage payment, then our maximum mortgage payment is going to be $1,000. So that's the biggest mortgage payment we can afford. If we end up having to pay $2,000, we wouldn't be able to afford it. When we try to calculate our maximum mortgage, we're going to use that as our payment. Let's fill in the rest of our annuity. In a Canadian mortgage, we're typically looking at a general annuity. CY tends to be 2 and PY is 12 because we're paying monthly. Our semi-annual interest rate is 6%. We're going to have this be a 5-year term with a 25-year amortization. When we're calculating that, that's just going to be a 25 years because we're going to pay it off in 25 years. In 5 years, we're going to have to reevaluate and figure out what's going on. We're going to try to figure out our present value here, and our future value is always 0. Begin is off because any money we borrow or pay at the very beginning is part of the down payment. So let's start with that. 12 and CY is 2. Notice when I enter that, PY and CY are now different. N is 300. Our interest rate is 6. Our payment is $1,000. Making that negative, and our future value is 0. So when I compute the present value, we can see that we can afford to borrow $156,297.23, which is a reasonable sized mortgage. That's our maximum mortgage. But if we have some cash to put towards a down payment, we could buy a house that costs $200,000. if we had about $44,000 down payment. So we'd have to put some money down, but we can afford to borrow $156,000. So let's say we got this size mortgage, and I'm going to leave it as is, but in reality, you would probably round that number to 23 cents. So let's look at what happens at the end of this mortgage. Well, we're not at the end of the mortgage. Right now, we're at the end of the term. Let's say 5 years has gone by. Let's look to see what happens. There's a few different methods. Method 1 is going to be to use the amortization, and that's going to be my preferred way of doing things. If we go into that second PV amortization, and P1 is now going to be, it's the end of the 5 years. So P1 is 1. And the end of the 5 years, P2 will be 60. So if I go down, now my balance is $144.12 and 28 cents. Method number 2, well, we could just set n equals 60 and compute the future value. And that would be the exact same thing. Method 3, because we always have another method, is to use Excel. Let's look at this with Excel. You might recognize this as the same type of sheet that we looked at in lesson 16. This is an amortization table or an amortization schedule for our mortgage. Except Excel does not deal with general annuities as well as our calculator does. So I put in my semi-annual rate and I converted it to effective using the effect command. Then I had to switch it to a J12 using the nominal command. Finally, I divided it by 12, and that's the interest that I used. You can see that one. So I took my loan balance, I found the interest, I put in my payment as a constant. Principal, again, is just payment minus the interest. And finally, whatever I have is going to be what I started with minus the principal paid is our new balance. And the next month, I just pull my loan balance down from the previous month at the beginning. This is exactly my amortization schedule, and now I can look up any payment I want. I've used a very interesting thing in Excel where I've frozen the panes. So if you'll notice, I'm just scrolling down, and I'm going to scroll down to month 60. At the end of the 60th month, I have $140,412.28. That's exactly what we got on the calculator, which is helpful. After 5 years, the interest rate has increased to J2 equals 8%. What's the size of our new payment? So what's happened here is 5 years have gone by. 5 years have passed, which means that I have 20 years left. And my new present value is actually going to be, well, this number, $144.12.28. Don't worry so much about the decimal and rounding here. If you're sticking with the same bank, you don't have to do an intermediate rounding step. But if you take your mortgage over to another bank, you would. What I'm going to do is take this and just press PV. And now, if we look over here, recall present value is exactly what I want it to be. That's going to be my new mortgage. So all we have to do is fill out the exact same table. We know that our present value is how much money we owe. Our interest rate has increased to J2 equals 8%, and we're still going to make monthly payments. We have 20 years left, so that's 240 payments. We're going to try to find our payment. At the end of those 20 years, hopefully we have paid everything off. Again, this is an ordinary annuity. So let's look at this. Our PYCY are the same as they should be, but now we only have 240 months left, but our interest rate is 8. Our future value is the same. We've reset our, let's make sure that future value is 0. So let's compute our new payment. Our new payment is going to be $11.63 and 12 cents. Here, we're going to assume that we're going to have to round up. So I'm going to re-enter that. So let's put that in. 11.63 to, oops. Let's make that our new payment. And just to check, I recompute the N and I get just under 240. That's what I was looking for. $11.66. That is just wrong. Oops. Let's re-enter that payment with the rounded amount. 1163.12, and that's negative. Let's press payment. There we go, and recompute our N. Our N is now just under 240, which is what we want it to be. So we're going to always round up and re-enter. And now we know our new payments. Let's go ahead and update our Excel sheet. So our Excel sheet now says this is $11.63 and 12 cents. Let's press enter, and then let's just spread this down. Make sure that it stays the same. Sometimes Excel starts to count upwards. That's probably enough because we're only doing this for a year. Let's go back to that 60 years, and now we can see that we're paying this differently. Of course, I have to change my interest rate as well, so let's just stop doing this in Excel. Let's do it again. 5 years later, the interest rate stays the same, but we can actually afford an extra $12,000 on the mortgage. Assuming we will amortize the balance over the remaining 15 years, what is the payment? So what I'm going to do is put in an extra payment. So we're going to use the amortization again and figure out what happens after 5 years. One thing to remember, the calculator doesn't remember the first 5 years. Those have been wiped out. It thinks it's a 20-year notebook. So P1 equals 1 and P2 equals 60. So we're doing exactly what we did in the last step, except now our balance is less. 122,671.40. But we're also going to pay some money. That's an extra $12,000 that we can afford to pay. So if we can afford to pay an extra $12,000, now it's only $110,000. I'm going to go ahead and make that the present value. So now I'm looking at a 15-year mortgage that starts at $110,000. Our payment is what we're going to be computing, but again, we're going to pay it off, and it's always an ordinary annuity. I'm making monthly payments, it's compounded semi-annually, and our interest rate stays at 8. That many months, 15 times 12, is going to be 180 months. So let's go ahead and work that out. Second PY is 12 and 2, that stays the same. Let's change our N to 180. Our present value I've already changed. Our IY stays the same. And so all I have to do is compute the payment, which is now $1,049.34, because remember, we're rounding up. And I'm going to go ahead there and re-enter. Negative payment, and now I recompute the N, and it's just under 180, which is exactly what I want to do. Let's look at this mortgage as a timeline. So if I have 6% and then 8%, what I have is a 25-year amortization broken up into 5-year terms. Originally, how much did I borrow? I borrowed $156,297. And I like to treat that as arrow in because that was money that I was getting from the bank. My payments come out of my accounts, and they're payments of $1,000. I make about 60 of those, exactly 60 of those, with the last one coming out at year 5. At that point, my balance or how much I owe, is around $140,000. Then I start making more payments. I've raised my payments because the interest rate has gotten higher. So I make a bunch of payments of $11.63.12, and my last one comes out exactly at the 10-year anniversary of my mortgage. At this point, I'm going to make one extra special at the same time deposit of $12,000, comes out of my account and goes onto my mortgage. So my balance goes to $110,671 after I make that $12,000 payment. Now I'm going to make some more payments. So I keep on going, and now I'm going to go all the way to the end because 5 of these is a lot, and each of these payments is going to be $1,049.34. So when I made that extra prepayment against the principal, which I'm usually allowed to do at the anniversary date or when I renew my mortgage, it reduced my payments. So that's how much I did. Now let's figure out what the interest was on this mortgage. Okay, well, the interest was money paid minus money borrowed. And I'm going to, let's ignore the fact that that last month is a little bit tinier. What we paid is going to be 60 payments of $1,000 plus 60 payments of $11.63.12 plus 180 payments of $10.49.34 plus $12,000. And that's really going to be $179 plus one extra one, but we're not going to worry about that tiny little extra. How much did we borrow? Well, our original borrowing was $156,297.23. So in the end, we paid $174,371.17 in interest. That's a lot, but borrowing is expensive. Let's go back to Part D. We made that $12,000 prepayment and we used that money in order to lower our payments. But what if we could afford the payment that we used to be paying? That is, we can afford to still pay $11.63.12. That's how much we were used to. It still fits into our budget. Our present value, if you remember, let's go back to recall present value. Remember at that time, we owed $110,671 on our mortgage. Interest rate was 8%, and we're making monthly payments and compounding semi-annually. If I change my payment to $1163.12, a higher payment than I need, I should be able to pay off my mortgage faster. So let's compute the payment. So compute payment. That is not what I meant to do. Compute N is what we're looking for. So our new N is 149.64 months. So 149 full months and then one small payment. If I divide that by 12, we find out that's about 12 and a half years. So we can save 2.5 years, pay it off faster, and in the end, we're going to be paying less of a mortgage if we do this. Example 3. Let's do the exact same thing again. This time, your gross income is $5,000 per month. That's your income before taxes. The rate is now J2 equals 8%. Let's write that in as we go. And we're looking for a 3-year term and a 20-year amortization. 20 years, and everything is monthly. That means we have 240 months on our mortgage. We can afford as our maximum payment, well, 30% of that $5,000. So let's multiply that by 30%, And now we know we can afford $1,500. And you can do this on a calculator. So I'm going to go ahead and write in that my payment is $1,500. We're always going to pay it off in complete, always an ordinary annuity. And here, because it doesn't say, we're doing monthly payments. Let's compute. Our PY and CY stay the same through this whole lesson, so I don't have to worry about that, but I do have to reset N, IY, present value, let's skip. Payment is $1,500, and the future value is 0. So when I compute my present value, it turns out I can afford, or you can afford, $181,000. And $181,081.24. That's the size of our mortgage. After 3 years, you renew your mortgage at the same rate, but are able to make a $10,000 payment, like we did last time. We're going to run through 2 scenarios. First, we're just going to assume that we're going to amortize over the remaining 17 years. This means our payments will decrease, freeing up cash flow for other things. Our other option, which we'll do next, is keep our payments the same and then our time will decrease, both of which are all right. So let's see how much money we owe after 3 years. We owe, well, that's going to be P2 equals 36. So P1 is 1, P2 is 36 or 3 years. Well, we owe $168,000. And 40 cents. So at the end of 3 years, we owe $168,000. We're going to make a $10,000 payment. So I'm going to take that number. I just pressed clear one time to make it just the number itself. I'm going to subtract 10,000. And that is going to be my new present value. So let's write that in, $158,441 and 40 cents. I'm going to recompute my payment. Everything else stays the same except for my N, because I have 17 times 12 is 204 payments left. So let's change that N to 204 and recompute the payment. And I get $1,410.95. Because I'm rounding that up. Now let's say we wanted to keep our payments the same. We know we can afford $1,500 even though we owe $158,441. We have a lower balance and we could get away with a lower payment, but we don't want to. Everything's going to stay the same except for the N, which I'm now going to recompute. Monthly payments, semi-annual compounding, etc., etc. So let's make our payment back to $1,500, which is higher than the $1,410 that we needed. Now, when I compute N, I get N is smaller. 180, it's a little over 15 years. It's 15 years and a tiny little bit. So we've now saved 2 years off of our mortgage. We've also saved interest. I'm not going to go through and compute the exact number of interest here. I'm going to do that in Excel instead. I've gone ahead and made this into an Excel sheet. We started with $181,081.24. Then we paid $1,500 a month, 8% interest. If we scroll down, note that I made one very large payment of $11,500 instead of $1,500, an extra $10,000. At the end of that month, the third year, 36th month, we owed $158,441.40. The next month, over in column A here, the lower payments, I lowered my payment to $1,410.95. Here, I left my payments the same. Notice that my balance is shrinking faster on this side. Let's zoom down all those months until the 218th month. That's about 18 years, where I make one smaller payment of $780. For the last one, I just added the interest to the balance owing, and that is $218. Going down over here, we pay for 2 more years, and this one is only about 70 cents less than the other ones. And in the end, we've paid $170,751 in interest over here with lower payments, but we've only paid $153,000 over here. So our difference is almost $20,000 worth of interest. In that case, it does make more sense to keep a higher payment.